Good morning, everyone. I'm Richard Picton Turbeville, Customer Success Manager at Wholesale Investor, welcoming you to the second day of our V&C Global Conference. I trust you've all had a restful night and are energized and ready for another day of insights and enriching discussions. Reflecting on yesterday, it is clear that we are a community united by the pursuit of knowledge and commitment to driving the global investment landscape forward. We dived deep into the heart of SaaS, fintech, and AI, engaging in thought-provoking dialogue and exploring the vast expanse of possibilities these dynamic industries present. We connected, learned, and grew together, each of us playing a vital role in this extraordinary symposium of ideas. As we embark on day two, I'm reminded of a quote by Albert Einstein, who once said, "We cannot solve our problems with the same thinking we use to create them." This is the essence of innovation. It challenges us to step outside of our comfort zones, to look at problems from new perspectives, and to embrace change as an opportunity for growth. Today, we will navigate through emerging investment trends, understand the crucial role of climate tech in sustainability, and explore the promise of circular economies. We have a roster of esteemed speakers ready to share their wisdom and experience, offering us the tools and perspectives necessary to shape the future of investment. Just as with day one, remember that our in-house networking platform remains at your disposal. It is a powerful tool, not just for making connections, but also for continuing the conversations that can inspire us to trigger innovative ideas. As we step into the new day of learning and growth, I encourage you to keep Einstein's words in mind. Embrace new ways of thinking, be open to innovative ideas, and seize the opportunity to learn from our exceptional lineup of speakers and your fellow attendees. So let's dive in, engage with enthusiasm, question with curiosity, and connect with an open mind. Here's to another day of learning, innovating, and growing together at V&C Global.
Good morning, everyone. It gives me great pleasure today to introduce our keynote speaker, Joe Schorge. Joe, as the founder and managing partner at Isomer Capital, brings an invaluable perspective to the world of VC, thanks to his vast experience as an LP, GP, and tech operations executive. Isomer Capital stands out for its steadfast commitment to nurturing high potential opportunities in European technology. The scope of its interest ranges from limited partner investment in funds to providing liquidity to firms and founders through secondary purchases. There's an important clarification that I'd like to share about the unique investment strategy of Isomer Capital. To the startups operating on the CRIS platform, please understand that Isomer can only invest through their general partners' portfolios. Hence, it is crucial that startups only approach Isomer for investment if they are already represented within Isomer's underlying portfolio. This approach ensures efficient and focused investment practices, and it is a vital part of Isomer's success. Previously, Joe held the position of MD for Business Development at Pomona Capital and provided insightful advice to institutional investors on private investment portfolios at Cambridge Associates. His career began in information technology operating roles, notably at Invasys plc, now known as Schneider Electric. This grants him a comprehensive and practical understanding of the technology sector. Academically, Joe holds a BS in Electrical and Computer Engineering from the University of Massachusetts, Dartmouth, and an MBA from the LBS, a testament to his solid academic background. So without further ado, please join me in extending a warm welcome to Joe Schorge. We're very much looking forward to your insights, Joe.
Thank you, Hugo. Really nice to be here today. Thanks for inviting me. And just to pick up on what you said, it's true. So we often have lots of startups approaching us for capital. We do invest directly in startups, but only through our VCs. So that's an important thing to note. We have about 1,900 companies now within our VC portfolios. So we love talking to startups, but we also realize we have to manage our time and our expectation, the expectation of startups. So Hugo asked me to talk a little bit about the evolution of European tech venture capital. When I hear him say vast experience, I also hear in there guys getting old. So I've been around the market quite a while and been a student of venture capital for many, many years. And so what I thought I'd do today is give a little bit of background on Europe and let that lead into why we started Isomer and how we approach the market and what we do. Europe, as we all know on this call, Europe has had now about 12 years of record KPIs. And no matter what metric you look at, capital going in, number of companies formed, amount of growth within those companies, exits. We had a big spike in 21, but if you look at the longer kind of 10 to 15 year arc, there's been an amazing growth, really kick-started after the global financial crisis. So there's a little bit of a temptation amongst investors around the world to look at Europe today and say, wow, look at that. It's amazing levels of growth. It looks like it came out of nowhere in a way, but it didn't. Of course, these things don't happen overnight. And in fact, Europe had a venture capital scene for quite a long time. If you think about tech more broadly, Europe has had great tech really going back to the Industrial Revolution. Don't worry, I'm not going to take my talk all the way back to the Industrial Revolution, but Europe has invented so many of the world's great technologies and things we use today, but markets have gone global, so we often forget that. But if you look back to, I would start probably thinking about venture capital in the 90s, although there was venture capital going back to the 70s. And a few years ago, as a birthday gift, a good friend of mine gave me a book from the late 70s, which was published by the Venture Capital Association of the time. And nobody remembers it now, including me. I'm not quite that old. But it's an interesting book to read because, there was no internet, there was no email. So information was distributed via paper, via books. And so this book kind of details all the venture firms around, particularly the UK. It's quite a UK focused book, but lots of firms and the things they were doing at that time and the kind of growth they were seeing and the problems they had. And there's a couple of fascinating things about it. First of all the problems they struggled with and raising capital, ownership stakes, follow on, it was all the same. And that's a real eye opener because, again, if you've started more recently or you've started investing in this market more recently, there's a tendency to think everything was invented recently, and not the case at all. However, you also won't be surprised to know that of all of those firms named in that book, most of them don't exist anymore. The one that stuck out to me was 3i, which was originally a government organization in the UK, which has lots of strategies, venture capital being one of them. But that's one of the few firms that's been around, in most people's living memory, and was active at that time doing venture capital. However, as you can imagine, the kinds of technologies and companies were very different. But why I find that interesting as a student of venture capital and investing is the fundamentals of finding companies, analyzing companies, looking at products and customers, and those were there, and those haven't broadly changed. What has changed a lot, and I'll come to in a minute, is how you build tech products, how you distribute them, how you find your customer, and so on. So anyway, let me skip through the 70s and 80s. There were pockets of success. There were some great companies created, but I'm going to skip over that and jump into the 90s. And the 90s is where there was, again, more activity. There was a new thing invented called the World Wide Web. And again, sounds very old and funny to say it, but the World Wide Web was invented, generally credited to an English guy who was working at CERN in Switzerland as a way to distribute documents. And so as the 90s progressed, it became clear that that was a pretty powerful tool, and we could do lots of interesting stuff with it. And there was this amazing run, and lots of venture money poured into what we now call the dot-com era. So taking businesses online, a lot of e-commerce, but a lot of other models as well. There were strange new companies, and I'll never forget my boss at the time saying, you can buy books online now. There's this new thing called Amazon, and they actually sell lots and lots of books. So you can go on there and search up a book. And again, it sounds really funny to say it, but nobody at that time could imagine what Amazon would become. This was a very, still pretty local American idea, and all about books. Nothing more than books at the beginning. So that was quite exciting that the boss sent his whole team a book, which he bought online, which was a crazy idea at that time. Bookshops were still things you went to and browsed and took home in a bag. But what that meant is there was an awful lot of excitement and activity, and lots of capital poured in to this new kind of company that was being created, this new way of transacting in business online. And of course, now with hindsight, we know that an awful lot of money poured in on not very sensible metrics. One of the big metrics back then was eyeballs. How many people are looking at your website? And I think now it's pretty clear that people viewing your website is not a direct line to sales, to revenues. But that was the big metric at the time. Who had the most eyeballs, had the most capital, had the highest valuation, and seemed to have the biggest business. In fact, what we know is, well, the guy selling books online did extremely well, because selling a book was real revenue. And if you could do that with good unit economics, you could scale that up. So, late 90s, early 2000s, we had this dot-com bust. And this was the air coming out of the balloon, if you will, that all of a sudden these businesses were not generating profitable growth. Also, the stock market took a dive and investors went away. And this is very damaging. This boom and bust idea is very damaging to tech in general to startups and to venture capital, because the providers of capital, they tend to pile in when things look great, and they tend to pile out when things don't look so great, which is actually damaging, because what we need over time is consistent, steady investing, consistent and steady building of companies. If you look back to those times, so we had over the 2000s really what I call that the hangover from the big dot-com party. And by the way, were there successes in the dot-com era? Of course, there were great successes. There were companies that sold. There were real businesses created, lots of real value there. However, net, the index level returns were not great. And all through the 2000s, we had what I'd call this hangover, where investors, the large pots of capital in Europe, were not going to invest more in venture. And I mean particularly the pension fund industry, the institutions. Those are the large funders of venture capital everywhere, particularly in the US. The endowment and foundation world is where a large portion of the venture capital comes from. In Europe, we had recognition by government that, well, this is important to fund startups. And so let's create a pot of money funded by our taxes, by the government. The biggest, most famous one called EIF, which started then in the early 2000s, really to help stabilize that industry. They've done an amazing job of investing consistently over time, more and more and more. And I really credit them with building the ecosystem across Europe. And now most European governments also have an investor. That's very different than the US, where there isn't really anymore a large central government investor. Anyway, so the 2000s were this hangover period. And when you talk to investors in those days, even 2010 onward, there was a historic criticism of Europe as a whole and creating great venture capital returns, particularly in three big areas. First of all, fragmented market. There's lots of countries in Europe, and there was not a mobility of capital. There was not a mobility of labor. You couldn't hire a great engineer easily from another country, for example. And especially, there was not a great mobility of product distribution. Before we had app stores, for example, you couldn't put your software online and expect lots of people to buy it. So that was a fair criticism, overcoming this fragmentation, which didn't exist in the US. There also was a big criticism, to be honest about it, in the ambition of European founders. I think we all would agree now that it's unlikely you can build a large company by being the best in a particular country. Also, finally, the stigma of failure in Europe. If you built a company and it failed, it was hard to recover from that on a career level. And so there was this kind of failure stigma, and also connected to that, or working together with that, a friction in labor markets. So if you had hired lots of people, it was difficult to fire them when the company wasn't doing well, or reduce the labor force. And so that friction of hiring and firing meant that labor was less fluid, whereas again in the US that's much more fluid. Well, so we had this hangover period of the 2000s up to maybe the 2010, 11 period, shall we say. And what we see today, in my view, really kicked off after the global financial crisis. Again, people sometimes think, oh, it came out of nowhere. Well, it didn't. We had this financial crisis, which was a real clear out in capital markets, but coincident in time, Europe was becoming a lot less fragmented, and we had real change, like the euro came in. We didn't have so many currencies. We could trade across border in a single currency. A lot of the taxation was harmonized. You could build a product in one country, sell it in the other. It was much easier and more clear. Labor markets started to get more fluid, and you have to credit the EU with a lot of these changes. And that meant by the time capital markets were recovering in 11, 12, 13, the entrepreneur in Europe had a very different platform to stand on. So this old criticism of the fragmentation, that really had gone away quite a lot. I mean, it's still there, and can talk about that. But the ability to work cross-border has completely changed from the 90s and 2000s. Coincident with that, the distribution of products, this app store, you can't underestimate the power of that. And then also both the ambition level and the failure stigma has changed. So when you talk to founders, even in the early 2010s, people had observed the great successes of the US, and they'd seen what Amazon did and what Facebook did and Google and on and on. And those companies are now, they all started as venture capital backed companies. They're now the largest market caps in the world. And so that's, the sky is the limit. Very exciting. But I need a unified market where I can sell my products and where I can hire the best talent and so on. And then I also need entrepreneurs with that kind of big ambition. I want to create a product that can go really large, ideally global. So you started to see that in the 2012, 13, 14 period. And I would call that, the 2010 onward, I'd call that the recovery, but in the renaissance of European tech and VC on top of that. So all these historic criticisms are not really there. I'm not saying problem solved. I can hear people jumping up and down saying, no, it's still fragmented and blah, blah, blah. However, when you talk to entrepreneurs back in kind of 12, 13, 14, what you saw was big ambition, ability to reach your customer much more quickly, much more cheaply, and therefore ability to build large companies much more quickly. Very exciting. So, and interestingly, I always think a little bit about what Charles Darwin said, that the survival of a species and the thriving of a species is not, in his observation, related to the current strength of that species, but it's related to the adaptability. So who can adapt or iterate faster tends to win in the long term. And to me, that's very true about early stage tech companies as well. The ability to iterate and absorb ideas and move quickly ultimately wins over strength today. So that's what we see a lot of in Europe today, which leads me to Isomer Capital, which we established in 2015. And if you think back to 2015, there were not 10 years of great returns in venture capital that you could point to and say to investors, well, look, this is a terrific market, you should invest. However, if you talk to entrepreneurs, you could see the seeds of greatness, and you could see that their ambition was indeed up. They were able to build digital products much more cheaply, much more quickly than ever before, and importantly, to reach their customers much more quickly. So I started to hear stories back at that time that I'd never heard before. Hey, we founded the company 6 months ago. We put in $100K of our own money to get it going. We have a few customers. They're paying the products out in the world. I mean, 6 months old companies with paying customers. That didn't really happen before. And that was made possible by all these trends, kind of the perfect storm of trends. So I got really excited. Wow, that's exciting to be part of, because if you roll that trend forward, you can see companies getting big. And I wasn't the only one to see that. There were lots and lots of VCs forming at the same time, people putting new funds together to back these new companies. But again, it was very hard to raise capital because you couldn't point to an industry that had generated strong returns. You can now, by the way. You can point to lots of great returns going back to those days. And so the other, what were you selling in those times as a new fund manager? Well, you were really selling that those seeds of greatness were there, that VC, venture capital investing and innovation investing broadly is not a bet on the past. So it's great to have 10 years of good returns behind you, but when you put new money in, you don't get the past. You're betting on the future. And therefore, one's ability to evaluate the fundamentals, which rolling forward could generate big returns, is actually more important. But that's hard. You really need to find visionary investors. And usually when we have our annual meeting every year and I talk to our investors, I really congratulate them in a way for being visionary, for starting a journey with us when it really wasn't obvious that European tech would be so great. I think it is obvious now, but the way that you invest in Europe as a strategy, I think, should also be different than the way you invest in Europe and the way you might invest in the US. So having said all those great things about fragmentation going down, ambition going up, labor, capital getting more fluid, we still have 44 jurisdictions that make up, Europe. We tend to use the Eurovision Song Contest definition of Europe. And that's what's exciting. What I love is that right now, everywhere in those countries, great things are starting. This is enabled by all the tech that we know and love. But this is also a big challenge. So how do you find, if companies start with 2 or 3 people in a garage or a kitchen or an attic, which is kind of often quite true. It's sort of an old joke, but it's often true. But that garage or that kitchen or that co-working center is in a city, a small city you've never been to, or a country you don't even know. How do you find that early and invest? That's the challenge. That's different than the US, where you have, Silicon Valley, the mega hub, Boston, New York, and a lot of the activity is clustered in those areas. I do believe in Europe, companies need to move to a large cluster as they scale, but they start everywhere. So if you want to be an early stage investor, you really need to think differently about how you go after that opportunity. So when we started Isomer, we started that with a recognition that, I don't live in Spain, I don't speak Spanish, but meeting people in the Spanish market, I see that really great outcomes are happening there, and I'd like to be part of that. And the same with France, and the same with Germany, and the same with the Nordic countries. And so we decided, wouldn't it be more powerful to partner with the best people on the ground, close to companies, close to founders, who are able to discover the fictitious garage early, go in the garage, help with the early product development, put the first capital in, that we could have a value to them later to help them internationalize, and we could then invest more as companies grew. And so that's really what we do at Isomer. We invest in VC funds that are on the ground in country all around Europe. We then follow those funds. We try to be helpful to them, to play it forward, to pay it forward, to be a good partner in helping them build value, but also to track and follow the companies they invest in, so that at some point those companies start to grow up and need more capital. So then we say, okay, well, we would love to, co-invest and help you on that growth curve. And then as a third leg to the strategy, we also say, well, from time to time, we know that investors also leave. This is a long game, investing early and building companies. And so if a founder leaves a company or an LP leaves a fund and they want someone to buy their position, then we'll be open to do that as well. Again, with our trusted partners, with our GPs. So it leads you to these 3 legs of our strategy: primary fund investing, co-investing in companies, and secondary purchase of funds or companies. That's broadly what we do. And the last question Hugo is asking me is, well, how's the firm grown and changed since those early days in 2015? It's funny to think back. It's not that long ago, but the market has changed so much since then. And we always say, if you think it's hard to raise a first-time fund now, try it in 2015. Amazingly difficult without those 10 years of great returns and this big ecosystem. And one of the things we thought at the time, we had a database of something like 250, 300 VCs all around Europe. That was our investment universe. And we thought, well, that'll probably grow, over time to 400 or 500 VC firms in Europe. And that'll be, within that, we'll pick 20 of the best that we can partner with and work with. That's already quite a big ratio. Well, no one would have predicted, including me, that actually our database now is about 1,300 VC firms. On average, they're all managing 2 to 3 funds. and therefore that's a much bigger universe than we thought at the time. And so it remains difficult to raise capital, although every year more capital is coming in. And so if you can demonstrate a powerful thesis on the company level, on the fund level, then there is increasing amounts of capital. And so our strategy hasn't changed. Our team has grown. The investment landscape has changed. It's growing up, it's maturing, and that brings with it some new challenges, also some new opportunities. One thing if I can share my screen, this is a little map from our website. Hopefully you can see that. What we think about is understanding all the local ecosystems that make up Europe. And what's going on in Spain is very different than what's going on in France, even its neighbor, the ecosystem, the founders, even some of the tech used is different. Germany is different again. The Nordic countries different again. And so you really need to have a program if you're going to be a pan-European investor to go and meet people. And that's driven us to have a larger team and a larger partner network. Eastern Europe, different again, very generative, very exciting. Southern Europe, different again. And so we put these stats out on our website, 3,136 funds screened across about 1,300 managers. The minute we write these down, they're already obsolete because we're meeting usually between 2 and 5 new fund managers every week. That still surprises me that this nonstop innovation continues, and people spinning out of big firms, entrepreneurs who exited, starting firms themselves. And so, but that's also very exciting. So new ideas, people going after certain subsegments of tech, think about crypto funds, climate funds, ESG focused funds of all different sorts. So within the big world of tech, there are all these different areas. And I think increasing specialization is also partly a hallmark of a maturing market. As the market gets bigger, funds can go after subsets of opportunity with increasing levels of specialization. So that's exciting. And we have started to invest in some sector-focused funds, which we didn't do early on. Everyone was a generalist early on. And now you see more and more funds specializing at things they can do better than anyone else. So with that, let me leave my general comments about Europe there and turn it back to you, Hugo. Thanks very much.
Thank you very much, Joe. I think that was amazing, and the insights that you gave were really good. I think there's one thing I'd like to pick up on, with your Charles Darwin quote. I think it comes. There's 2 quotes actually from Biz Stone, one of the founders of Twitter, saying that timing, perseverance, and 10 years of trying will eventually make you look like an overnight success, right? And I think that resonates a lot with what you said. And then the second one, which I think is also really good, and I think it's a testament to the growing number of VCs in Europe and the growing number of startups we're seeing, is when you hand good people possibility, they do great things. Creativity is a renewable resource. I do truly believe in that. I think there's a lot of big talent in Europe and with big ideas. So yeah, definitely. But yeah, I think my first question for you, and coming maybe a bit more personal rather than just ISOMR Capital, is how has your experience in various roles, maybe including LP, GP, and tech operations executive, shaped your approach to VC?
Yeah, interesting question. I didn't know we were going to go personal straight away. Over the years, what you see in the big investor world, and part of my training was very much a structural approach to investing in this area. What I mean by that is, I'm an LP, I just do LP commitments, or I'm a direct investor, I just go into companies, or even I'm a secondary investor, or I'm equity, or I'm debt, and that's a kind of structured approach. My increasing belief over time is that actually what you want to do is get involved with great companies. And that comes a little bit out of my observation that, well, if you think about a really big outcome in venture capital, I think one of my old friends had some early capital in Facebook. And what I realized when I hear kind of the stories as to how he got that capital in, and there were all kinds of secondary transactions and things that happened early on. And ultimately, it didn't really matter if you'd been a primary investor or a secondary investor, or you'd bought, some friends, some shares off a friend or whatever. What mattered is that you had figured out somehow that that company was going to be really large, and you'd participated. And there are many different ways to participate. So my personal journey has been from that structured approach. Well, I have an LP hat and a range of behaviors around that and a focus, and I ignore everything else. I now think more about trying to be a great tech investor and identify what are the key trends and areas, what are customers thinking in key markets. Can I understand something about that so that when I do meet a fund or a company, I have my own point of view on those markets, and I can, to some extent, independently validate the opportunity set. And I'm less interested in the structure. Each structure has its pros and cons. So when we do a secondary investment, it's a different format than a primary investment. But ultimately, the question is still the same. Is this something we want to own because we think it will, show high growth and give a great outcome over time? And when you talk to a founder of a company, a lot of the same things you look for would be true with the founder of a fund.
Right.
And teams. We were having this debate on an internal call last night about team. One of our guys said, all I care about at the early stage is the team. It's the team.
Yeah.
And you hear that in venture, right? The old saying, I'd always back an A team with a B idea over the opposite.
Yeah.
Because the logic being an A team will iterate, will find a way. So yeah, maybe that's my biggest change over time, is not having such a rigid structure, but really thinking about how do I identify great markets, great companies, great VCs, and be part of what they're doing. And of course, the second part is then how do you add value to that? Can we be a good partner? Can we? It's one thing to ride along the side or run along the side, but then how can I actually help you? If I can study what you're doing and the problems you have, then I can start to develop a few tools to hopefully be helpful along the way.
Yeah, thank you. Really appreciate that. I think, touching upon what you said, the trends that you're speaking about, right? So we talked about the 70s, the 80s, the 90s, 2000s. Anyways, we can go to the 2020s, but given the rapid evolution of technology, how do you envision the VC landscape in Europe changing in the next 5 to 10 years, maybe looking ahead?
Yeah, that's the $1 billion question, isn't it?
Yep.
Well, following on what I said, we've had a decade of growth in new companies, which on top of which new VC firms, and lots of people raising fund one and fund two. Everyone being a generalist at the start, broadly speaking. I'm speaking in generalizations. Of course, there are exceptions to everything I say, but fund one, people invest into based on a thesis and a team. Fund two, people are really re-underwriting that thesis and the team, because at the time investors are putting money in VC fund two, there hasn't really been enough time for the companies in fund one to really grow. And it's not evidence based. When we back fund twos, we're really trying to understand, has this VC done what they said? Have they built an interesting portfolio? What can we understand about those companies? But when you raise fund three, that's really the moment where you need to show some progress and some success, hopefully some exits, and so what you see in Europe across the board is a lot of firms are growing up. So existing firms that have been around 5 to 10 years, they're going to face their kind of moment of truth, if you will. Have you delivered? Have you delivered that growth and hopefully DPI that investors are looking for? So I think there will be some number of firms either refocusing or shutting down, not raising next funds. There'll be a bit of a natural churning there, which is normal and healthy in markets. Second, that's one big trend I would predict. Second big trend is then increasing specialization. So what you probably also understand, if you really are an introspective firm and you analyze your own data, what what I like always to hear from firms is, hey, every time we do this kind of deal, we're really good at that. And every time we do this kind of deal, it doesn't work. So for whatever reason, right, and you can unpack it, but maybe we should really focus on that area. Just to take some fictitious example, our fintech focus has worked really well, and our deep tech has not. I mean, just as a kind of to create an idea, right? So I think you'll see firms more specializing and saying, you see that in two ways. One is they say, well, actually, we're not going to do those kinds of deals anymore. We learned that at that stage or that type of tech or that geography, we're just not winning. So let's double down on the areas we do win. The other thing you see is, well, actually, we're going to create a fund focused on that area. So you see firms kind of productizing where the core fund is a generalist fund, but then they raise a food fund in one case, right, or they raise a fintech fund or whatever. And I think, as fintech is like 30% of all capital in Europe. So that's a real example. You didn't see fintech funds kind of 12, 15 years ago. Now there's quite a few, and there will be more.
Absolutely. No, thanks for that. I guess, yesterday I was speaking to John Spindler of Twin Path Ventures, and he mentioned that he was speaking to an American fund, and we had this discussion on the AI panel yesterday, just talking about the fact that American funds already have AI specialists at partner level, and that Europe is kind of lagging behind in that they don't have maybe the specialist knowledge at the decision-making level. Are you also seeing that in Europe, and are you seeing that it's kind of changing?
Yeah, I don't really buy that.
Okay.
I think, venture capital is very fashionable. Every year there's a handful of buzzwords in fashion, and right now it's AI. And behind all those fashions, and 2 years ago it was something else, and 2 years before it was something else, right? This is nonstop. Usually in those fashions, there's a lot of core value, and there will be amazing amounts of value created out of AI in general. But to me, AI is not an investable thesis. AI is a tool you use to build a business. It's like I was just talking to a fund about this. It's like having a Microsoft Excel fund. Well, Excel's not an investable thing, but every company uses Excel to do something, right? So when I look at the partners across VC funds, you see many AI experts, many groups hiring data scientists to do various things. I mean, we're in a moment where everybody's putting AI on the cover of a company book. Everybody's putting AI in their thesis.
Yeah.
You have to look through that. What do you mean by AI? What are you doing with AI? And what you see is there are lots of real applications that are creating real value and very investable, super exciting, but there's a lot of froth and baloney around it as well. So buyer beware in the moment. And by the way, the one area where prices are going crazy and where we see, back to 30, 40, 100x revenue multiples, that's where you can draw a line to AI. And it happened in .com. It happened in, social was the trend at some point, which probably nobody remembers anymore. But every company had social. As Facebook took off, name your company, they were explaining why they were using social ways, so you could recommend the product to your friend, you could create playlists and blah 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 blah. We forgot that now, but there was a moment in time where anything that got the social stamp had a higher value and had a higher competitive landscape, lots of term sheets. So that's part of the challenge for investors. How do you look through that and see where the real value is?
Well, fantastic. Joe, I think that's all we have time for today, but I'd like to thank you for coming on, giving your insights. Thank you very much. And
thank you,
I'm sure we'll be in touch soon. Thank you.
It's been a real pleasure. Thanks a lot. Bye-bye.
Bye. So good morning, everyone, and welcome back. We just had Joe speak, and now I'm very excited to introduce you to our investment trends panel, capitalizing on change, adapting to emerging investment trends. We're delighted to have with us three distinguished panelists who bring rich and diverse experiences in the investment and startup sectors. First, we have Eva, investment and deal flow manager at Block Dojo. Eva's expertise lies in assisting early stage founders to strategically grow their business and successfully raise capital. Her work at Block Dojo includes assembling startup cohorts for their intensive 12-week incubator program. Next, we have Rodri Llewellyn, managing partner at Axial Capital. Rodri's extensive background in corporate finance and banking enables him to provide insightful strategies from early growth to public capital market placements. His work at Axial Capital is dedicated to driving growth through transaction-led investments. And finally, we are joined by Orr Weingold, the co-founder at Unrest. Orr is committed to supporting the next generation of founders who want to make a global impact. Unrest is an accelerator program that empowers entrepreneurs to launch mission-driven businesses and takes them from MVP to operational readiness within 4 months. Today, our discussion will delve into the major trends reshaping the investment landscape, how these trends are influencing traditional strategies and portfolios, the most promising sectors for future investment, and the role of sustainability and ESG in decision making. So welcome all. Maybe starting with Eva. Could you introduce yourself?
Yeah, of course. So I'm the investment and deal flow manager at Block Dojo, and what we are is an early stage blockchain incubator. We help founders at the earliest of stages. So we're talking idea, pre-MVP, early MVP stages. We help them grow throughout the 12 weeks long duration of our program. We help them build out the MVP, get investment ready, and then at the end of the 12 weeks, we help them pitch for an investment. So we're actually in the last weeks of our current cohort 5, and about in 2 weeks' time, we're going to have the final week where we've got investor dinner, investor showcases and events, and the 10 startups in our cohort will be pitching their businesses for their first pre-seed checks. They're generally raising 250K, and the general valuations that I've been seeing lately at the pre-seed level are around £1.5 million, up to 2 million generally, but the 2 million seems to be a higher mark.
Okay, great. Thank you very much for that. Maybe Rodri, if you'd like to introduce yourself.
Yeah, good morning. I'm Rodri, CEO at Axial Capital. We're London HQ. We're a boutique corporate finance house. We have team members from Canada and US through to Europe, and of course here in the UK. And we typically sit, I suppose, a bit further up the curve to what Eva just described. We tend to add most value when a company has some traction. I think the unique offering that we bring to most clients is that with our team based across different regions, we can access a broad base of our investor network, but we can also look at those markets to help those companies scale, and that's what we've seen progressing really quite well, particularly since COVID, when everybody went to this sort of virtual world. It's really helped to bring together some great groups of growth companies, but also commercial partners as we've helped to scale businesses.
Thank you. Great. And last but not least, Orr.
Good morning, everyone. Thank you for joining us. Very similar to Eva, we run an accelerator program. We're based in London, and we have expanded to our first office outside of London too. So we focus on both in the north and the south. And our fundamental thesis is that the world is moving towards profit with purpose. And we're going to need to unleash thousands of companies who align with those values. And I'm sure we're going to get into the trends later, but we see a huge shift in terms of investment coming at the top end and also at a very early stage into the impact world. And so we support entrepreneurs to understand how to navigate this new world of impact, how to report it, how to talk to these new investors, and importantly, how to build cultures and businesses that are really attractive to the consumers and the investors in this new landscape. So we're 3 years old. We were born in the midst of COVID, and we are about 50 companies deep. And we had our demo day yesterday. So we had kind of 200-300 people listening to Impact. So I can give you some live reporting from what the investors on the day were telling us as well.
Fantastic. Thank you very much. And again, welcome to the three of you. I guess sticking with you, Or, I think my first question was, what major trends are you currently observing in the investment landscape? I knew you touched on that, but if you could expand a bit more on what you were just saying, and also what you saw maybe yesterday with the investors.
Yeah, of course. So I think that something that's really interesting is, we look at investing, kind of VC investing as a percentage of total that's going to impact. And if we scroll back sort of 4 or 5 years and look at France, Germany, the United Kingdom, Scandinavia, every single one of those countries was investing less than 20% of total VC rounds in impact. Now, fast forward to today, and we've got some countries that are shooting ahead. So Sweden is at 58% of all VC rounds and now impact rounds. So they've gone from about 18% to 58%. The UK, Germany, France are also significantly higher. So they've almost doubled. And so we're actually seeing a lot more capital going in the VC space. And then the second thing that we're seeing is within the private equity larger markets, and really they talk ESG rather than impact and purpose. There's far more frameworks that they use. We're seeing that now at 31%. And the estimations are that it's going to go to about 69% by the end of the decade. So there is a incredible trajectory of capital going in. And then we see on the other side is how many people want to start a business that refers to purpose, refers to impact. And so that's the kind of supply side effectively. And obviously we work with founders, we see the number of applications we get. But just for context, about 6,000 businesses that get created in the UK. About 600 of them are really high growth. The rest are sort of sole partnerships. And out of those 600, we're just seeing an increasing number of entrepreneurs, particularly Gen Z and millennial entrepreneurs that want to build impactful businesses. So this is a trend that's coming from both sides now. What we were seeing last night, most investors are talking about the tricky climate at the moment and how challenging it is to raise. And the other thing that they're kind of referring to is, of course, some of the emerging trends around AI, around impact that are coming. And so I'm sure we can get into that a little bit more.
Yeah, thank you. And I guess moving on to Eva, Eva, you've been in at Block Dojo for now just over 2 months. Yeah. Could you maybe discuss a bit more about what you're seeing as trends? And just in general.
Absolutely. Yeah. So to build on what Or was saying about the general slightly worsened conditions financially in the markets, what I say and what I've been noticing is that in 2023 in general, we are in a big year of macro headwinds and some tech tailwinds, because we've got high inflation, interest rates are rapidly changing, there's geopolitical uncertainty going on as well, and the generally tightened financial conditions that are somewhat slowing down startup growth. But then we've got some major tech tailwinds taking place as well. So obviously it wouldn't be 2023 if we didn't mention AI. So AI is one of those trends. But then also what I find, and especially what I've learned at Block Dojo, is that AI often finds itself at a confluence with blockchain. And it really, really works well together, because also when you add data to it, how blockchain infrastructure works with data is that it can enable greater transparency, traceability, and security. And then in turn, you've got better data analytics that mean real-time insights for startups, and better informed decisions, increased competitiveness. And the sectors that this is best applied to are some of the legacy sectors, like let's say real estate, that are overdue for a blockchain upgrade. And I think once this is executed properly, and once this innovation starts really accelerating, that's when we're going to see a lot of growth. And especially for VC investors running funds, their sweet spot is to invest at the beginning of the exponential growth curve of industry development so that they can maximize their returns over the whole lifetime of their funds. So we're talking 5 years, 10 years time. So a lot of the prop tech VCs that I've been speaking to, that's what they're hoping for. They are hoping for all of these technologies to come in together and revolutionize that industry, real estate prop tech that they're investing in, because that would allow for that growth to take place. And so for us, we've had over 200 applications for our upcoming cohort of the incubator program that we will be starting in September. We're still accepting applications as of now, by the way. But yeah, what I've been seeing a lot is there's a lot of prop techs, a lot of real estate, and then also HR tech, recruitment, creator economy as well. That's pretty big when it comes to Web3 and blockchain. So what we like is blockchain as a technology and underlying infrastructure applied to other sectors that are, like people using this technology to address some genuine use cases and market gaps that are in different sectors.
Great. Yeah, no, that's definitely true in terms of all the trends you've mentioned. I think in terms of the AI confluence that you mentioned with blockchain, I think with a lot of sectors are seeing a lot of positives that come from AI. I think blockchain is definitely a big one, but I think definitely when it comes to, for example, what Ors might be more familiar with, the impact and climate space, I think AI has a lot to do there as well in terms of accelerating us going towards net zero.
Yes.
But before we get into that a bit more, maybe I'll ask Rodri his opinions on what major trends he is seeing in terms of the investment landscape at the minute.
Those 2 points, or those 2 sectors that have been focused on now, I think draws quite a contrast to 12 months ago when we were looking at what was a trend, what was a key trend. Everything med tech, health tech off the back of the pandemic. It was still at that point very strong. And I think where there's a bit of divergence now is the market, as in the startup market, is still quite strong, pushing a lot of good initiatives in that space. But the money is moving slightly different directions. It's waning somewhat in terms of supporting health tech, med tech, because there's always the question of what's going to have the longevity there to come in behind it. And then you've got these new things, shouldn't call them a buzz, AI is here to stay in some manner, but it is what's taking the spotlight right now. So I think that trend of moving away from what was such a big sector over the past 18 months is something that we notice, because we still see a lot of really good health tech, med tech startups coming through. But equally, the point that was raised about where we are in terms of inflation, risk-free rate is still pushing up, and we work across quite broad regions with a lot of different funds, and of course a number of them are still focused on being pre-seed or similar, and that's changed in terms of what a pre-seed criteria really looks like. If there isn't revenue there now, if there isn't market penetration and something proven, it's increasingly challenging for a startup to really get a look in. And there's various factors there. There are a lot of startups came out of people being stuck indoors for so long. We all know that there was quite an emergence of new companies, and so they're all fighting for the money, but the money is also looking for something lower down the risk curve. So I think it's great that there are two incubator accelerators here that are filling in that space where some really great companies that might struggle to get support elsewhere can start to find the right support mechanism through accelerators and so on.
I think touching upon that point, the incubators and accelerators, I think I'll turn this question over to Or first. In the context of the current investment landscape, how are you preparing startups for successfully accessing the right funding at Unrest?
Yeah, I mean, I just want to agree with that previous point, I think, and just add a little color to that. So we speak to a lot of seed stage investors, and I think the landscape that they say to me is, look, we've got two choices. We've got an existing portfolio that is struggling, that we know the founders of, that we think are great, and they're in a tough situation, but we know what the value proposition there is, and they are historically haven't been competing with new deals for investment, and so they've got these opportunities to effectively double down and save some of their portfolio companies from going under effectively. And so a lot of the startups that we work with are now competing with companies that wouldn't have been competing with before. So the landscape is significantly tougher. The other thing that we see is that actually a lot of great founders are choosing not to raise right now, and they're choosing to wait until next year. And that's because we've seen this downward pressure on valuations. And so a lot of our top founders have done quite small rounds, so kind of survival rounds, we call them, sort of 150K, 200K rounds to get them through into next year. They're operating still in quite a lean fashion because they don't want to operate at the valuations that they're being offered right now, because they know that they need to raise some significant capital down the line. And so we've got this two-tier sort of thing going on with our founders where some are raising nothing and some are raising really small rounds, particularly amongst the top end of our founder community. So how do we prepare them? I mean, we're conscious of what's going on in the sector, and so that's one of the pieces we advise is think about your full fundraising journey. Don't just think about this round, and think about all the capital you're going to need and where you want to end up on dilution at the end of your journey as a founder. And we saw quite a lot of founders who raised in the frothy part of the COVID market after the expansive monetary policy that we saw, now sitting with pretty terrible after preference shares, pretty terrible founder deals here. So they're really demotivated to carry on running their businesses. So we help them think long term, number one. Number two, we're actually looking at slightly less formal deals, so slightly less VC, more family office, a little bit more angel type deals. I think the benefit of SEAS expansion has meant that they can still get relatively fair valuations in the market. And so the type of people that they're talking to has changed a little bit. And then, of course, I reflect both of what you guys have said in terms of sectors. There's some very frothy sectors right now, and ones that have sort of started to come down, like healthcare, etc. So we're seeing some pivots in terms of how startups are talking about what they do, and some technologies that they're incorporating that they might not have done before. AI, and I would have said this if we were talking 2 years ago, I would have said this about blockchain too.
Maybe Eva, you can explain to us a bit how BlockDojo and you yourself provide that kind of support to the startups coming through your accelerator program.
Yeah, absolutely. And just to build on that point as well, in terms of, how this works in the markets, I think given the current macro conditions, what I'm seeing is that, there's a different number of the ecosystem actors coming together to streamline the investment process and ultimately help VCs make better decisions. Because many successful VC funds have either an accelerator arm or an incubator arm attached to them. And because in the current VC model, making a few bets out of thousands in the hope that they will generate substantial returns seems almost impossible. So what the incubators do and what we do specifically at BlockDojo is that we make that easier by essentially creating a safe test ground for those startups to grow and pivot if necessary. So basically what we do is that we help founders to validate their idea, test the market as well. We help them build out the MVP, pivot if necessary, and then ultimately we help them to get investment ready as well. So we would design their first pitch deck, the financial model, capital raising strategy on the whole as well. And also we want to ensure that the founders are getting the fair deal. So whenever they get a term sheet through, we would sit down with them, review it, advise it to make sure that they are getting, more founder friendly terms. And we're generally working on, like under SEIS, which there's no preference shares involved at this stage. However, I've seen some term sheets that were pretty sharky on the terms that they were offering, even at the SEIS level. And I think, the early stages are so pivotal. And I think the choices that the founders will make, if they accept one investment deal at those stages, it will then dictate all the future terms that they have to give to other investors. So that's why it's so super important that on the early stages, startups actually utilize all the help that they can get. I've heard this quote recently where they said it takes a village to raise a startup. And this couldn't be more true these days.
Yeah, you're so right, Eva. It's we are seeing some quite sharky things going on as well. Yeah, you're absolutely right.
Yeah, it's funny. That becomes challenging going forward is there's a lot more focus from the VC space, and I think that point you made, or that there's a broad range of capital and support that should be looked at for companies now as they're growing, not just pure venture capital equity, but when it is VC money, there's often a focus now on how much does the founder still own of that company. And if they're getting those sharky terms at, pre-seed level, by the time they get to doing an A or a B, they might only have 60 or 50 or 40% of the company. And that becomes challenging, to go and raise an A or a B when they're not necessarily at the helm of the company anymore in terms of decision making.
I've seen this article. There's this article somewhere that Sam from Founder Catalyst shared with me, where a startup had been sold for 1 billion and the founders essentially got nothing out of it because of the liquidation preferences and terms that were set initially in their term sheet.
Yeah, we're seeing a lot of that now in rounds, almost negative equity rounds. So if you're a founder facing this condition, the incentive to actually raise capital is just not there.
And
if you're a good founder and you understand that, you're in this catch-22 of, if I don't raise, the business will fail, but if I do raise, I own nothing in my business, and it's really challenging. Yeah, it's almost unsolvable. I don't know if you guys have found a way through that with your founders.
Well, one of the things that we really like is companies that can bed in sustainable revenue. So there's ways of bringing in capital that can dilute less. That's not all companies can, but those that can, that's a conversation that we always have with them. Particularly as we tend to work with them over a protracted period quite regularly, and if we are taking them into a new market, then it lends itself to potentially restructuring contracts. And if that can be done, then it can just make it favorable to bring in different types of capital that are not going to have some of those terms attached to them.
That was I think that provided probably quite a bit of insight for the founders watching this right now, because I've worked alongside some founders beforehand who has asked me personally what term sheets we have available, and we don't have those available per se. We do have some that are better than others, and we provide a bit of guidance. But I think exactly what you guys all mentioned is very important, especially at the very early stage when you just want to secure funding in any ways whatsoever, and then you might be blind spotted by someone who might put this in a deal and you just sign it to get the 300,000 in the pocket. So yeah, I think that was very valuable. I think sticking with you, Rodri, as a corporate finance advisor, how do you adapt your strategies to align with the ever-changing investment landscape?
Well, that point that we just touched on then about in the current environment, and I think this is quite relevant long term anyway, is having a robust, sustainable revenue model. If a company can do that, because it helps them on many fronts, not just raising capital, but it just helps them in terms of cash management. A lot of Earlier stage companies don't always necessarily think about their balance sheet position if they structure their contracts with clients. We've seen it with a few where they're early stage, so they need money, right? So they'll bill for 12 months and they'll take the cash, and that's great. But their negative burn is something they haven't really thought about beyond the next 3 to 6 months, and suddenly you've got this liability on the balance sheet. So yeah, that's something that in general, I think companies in this current phase of being aware of recurring revenue, I think that's a trend that's bedding in, and it's a good one. In terms of how we adapt, I think we're quite lucky that we do, as I mentioned, have team members from North America through the UK, Europe. So our client base and our commercial partner base and our investor base is across that broad spectrum, which means we get to cover a fair degree of sectors. We see companies at different stages doing different things. So we can often find a solution by looking beyond just our local market. I think that's a benefit that we have that makes it easier to adapt, but it's also that knowledge sharing that comes from having people in different regions. We might see a really good company that in their own market is struggling, and if we can connect them with the right people over here or in Europe, it could open up a new channel of business for them that will let them keep developing, let them keep going. And I think looking at it that way, it's a wave. It just ebbs and flows across those different regions for us. And the more we can leverage that, the more it helps those companies, push through their growth curve. And that's just an ongoing adaptation for us.
Okay, thank you. And coming back to you, Eva, in terms of we've spoken about maybe the rise to prominence of large language models, and from Or maybe a bit more about the climate aspect, the ESG aspect. But what are for you the current major tech tailwinds influencing the future of startups and the implications for early stage founders?
Yeah, so I think if I was to narrow it down, I would say it would be blockchain, AI, and data. And I really like this quote. So one of our previous startups, they said this quote basically that it's been said that blockchain and AI is to the evolution of internet what nuclear energy is to the fight against climate change, in a sense that it is indispensable but wildly misunderstood. And I really, really like this quote because essentially what we're looking at is that blockchain used as the underlying infrastructure, AI used to power your operations, and then data used to generate insights to grow and scale. I think those three technologies are now kind of like spilling over a lot of different industries, and we should probably stop seeing like a blockchain as a standalone sector. Yeah. I don't think it is. It's just the underlying technology that ultimately we will all move towards, and it will become just like a standard of how you're coding software and how you're building startups. And I think the implications for the early stage founders here is essentially that they just need to jump on this bandwagon, because if they don't, they're going to miss out compared to other startups that might be, like working faster, being more efficient with their operations, and harnessing more insights from data that allows them to grow further. So I think monetization on data as well is huge. I've been seeing more and more businesses do that, and now obviously combined with AI, it's indispensable. So overall, I think this is going to change how we work, in a sense that we will be operating with like more information, faster as well, probably a lot more brain fatigue as well on the part of founders. But I think, that's probably where we're going to see growth spilling over to a couple of other industries.
Yeah, I think you're completely right there. I think a lot of the past few years, blockchain has always been seen as something different and kind of related to cryptocurrency. But I think eventually it will be like the internet. Every company is now built on the internet. It's like every company will be built in some form on a blockchain and AI, right? And maybe coming to you, or in the current maybe batch in your accelerator program, are you seeing more AI embedded technology or maybe blockchain embedded technology with the startups, or is that not yet there?
Interesting. So we are quite early stage. So we see, I will say to people, we see ideas 7 to 10 years before we think they're going to be big. So we actually had our batch of AI and blockchain heavy applications a couple of years ago. And they actually filtered through probably program 2 and 3 that we had. So it's not to say that we're not getting them now, but what we tried to do is look at ideas that we think are really, really futuristic and going to be quite far ahead of the trend. So yes, of course, we're seeing that, and that trend isn't done. But interestingly, when we look at applications, we always get this interesting thing where, we get applications in and they all sort of mirror each other. And we're something very curious to see 35% of the applications in one specific space suddenly, and then in another space, and that changes every time we do this. So I don't know if they're coordinating on their applications, but we certainly see them coming in blocks. And we got our AI and blockchain block probably like 4 programs ago, which is interesting. But what we are seeing is, and kind of what I mentioned earlier, is that people are now retrofitting a little bit more of AI and blockchain into what they're doing and their thinking. But the thing that we are seeing a lot of, and we have consistently seen a lot of, is the decarbonization movement. And that is, of course, using blockchain, and always has done in the impact sector. So how you measure that has always been on the blockchain, and that's been a really consistent trend. And just a note on that, because the interesting thing with the impact space is that it's a new sector. People struggle to understand the real impacts because they struggle to measure the impacts. But one area that you can really measure is in carbon. And so we're seeing an explosion of carbon startups, an explosion of carbon investors, carbon accelerators, because you can measure it. And so we're actually seeing quite a lopsided impact ecosystem at the moment, because you can measure something, whilst measuring some of the S is actually very costly. It's very difficult to get standards around that. And so we're actually seeing underinvestment in a sector that I think is really exciting. So if I was, an investor on this call, I wouldn't be shying away from thinking about how to build your own framework for understanding how to invest in the S aspect. And just as a kind of starter for 10, I would look at impact management projects, 5 dimensions framework, which sounds complicated, but it is really very simple. And it's a little bit more qualitative, but actually there's a ton of underseen value in that S space at the moment, because the E is very, very heavy right now within the ESG.
Okay. I think, if I was in your shoes, in your position, I'd pick the companies that I have no understanding of, and I'm like, that's probably what's coming next in 7 to 8 years' time. No, I'm just conscious of time. Sorry?
That is often the case. We look at applications and sort of look at each other, and we have no idea what this is actually.
Yeah. Look, I'm just conscious of time. We have about 6 minutes left, so maybe we can start closing this off, and maybe starting with you, Rodri. What, if you were to give maybe a few pieces of advice to current founders, and just maybe take into context that they have an idea and they're about to start execution, what tips would you give them?
I think that point of executing is the key piece. It's find a way, and it can be difficult because some businesses, it does require money to go and really test out, get some provenance. But if you can find a way to get into the market and just demonstrate that the market will use what you've created, what you're offering, and that they will pay for it. In the end, going back to my earlier point, that the market currently, and I think it will stay this way for some time, is looking for propositions that have already proven sustained revenue, because there are so many options out there right now, so many great companies that VCs, private equity, so on, have a lot of choice. So get out there and prove that the business actually works, that you've got a market, and then you've got something to go and raise money on, to go and predicate value on. It's not just, I've created this, I've proven that by taking this forward, we have a market that will pay for us, and we can build something that really does work.
Great, thank you. And maybe staying on that point a bit longer, have you seen effective ways that that founders have done that when speaking to them in terms of showing product market fit or showing that it works in your experience?
Doing trials, finding your target audience and doing a trial with them. Again, that can cost the founder money, because to get through the door, they've got to essentially say, please take what I'm offering. You have an embedded solution already, quite possibly, so we want to move that aside to try us out. There's a lot of hurdles that they need to overcome, so it's hard grafting. But try and do that. Try and get in with anyone that you can then demonstrate something tangible to show that it works. That's long run what people are going to be looking for.
Great, thank you. Maybe coming on to you, Eva.
Yeah, so I would say my advice to founders at the early stages would be essentially for them to build that community around themselves as early on as possible. And this would be, like other founders, but also potential investors. There's a lot of ecosystem players such as, like myself, incubator, or accelerator. And I think utilizing all the help that's available out there is crucial, especially in the current conditions that we've been discussing. But also, I think as founders, you need to have this unrelenting desire to want to learn about what's around you. And by that, I mean what your competitors are building, but also what your customers, consumers want. Otherwise, you risk locking yourself up in that tunnel vision, and you could be building the most innovative and extensive and next generation product, and so what if no one wants to use it? Yep. So that's why, like a lot of it comes down to actually like listening to what your users are saying. And to that effect, I would also say for founders to make feedback loops as easy as possible for your users to find them, to fill them in, make it easy for them to give you feedback, make it easy for you to communicate what they want, and encourage that. If you can incentivize it, even better. One of the really, really good tips I've seen somewhere on LinkedIn was, I think it was from 20VC, where Harry said the best thing to do at the early stages is to create, like a small WhatsApp group chat with your trusted, like friends or users, and like encourage them to talk and tell you, and like send them regular updates. One of my really good friends, Daniel, he's always sending me updates on like not only what they've achieved in the last month with his business, but also the new features that they've introduced, like screenshots, pictures, and everything. And it's very personal. It's very nice. And I like to see what he's building, because it just feels very like natural, like, like, oh, hey, this is what I've done last month. Check it out.
Yeah, definitely. I think that's a very good tip. I think that's probably the first time we've heard that tip, creating a WhatsApp group chat with...
Not mine. Yeah. All the credit to 20VC. But yeah, I love it. Yeah.
Great. And last but not least, Or.
I mean, you've both covered my absolute favorite subject and biggest gripe with founders who don't listen to entrepreneurs and build in a tunnel. And so I absolutely love both your points there. I'm going to go for a personality trait that I think is the number one thing that we now look for in founders, which is coachability. And it feeds into the two things that you've said there, which is a mentality of I mean, it's listening to your consumers, it's listening to your advisors, it's listening to the people around you. And ultimately, you're going to get a lot of solicited and unsolicited feedback as an entrepreneur. And the question is, how do you filter through? What's your decision-making framework to filter through all of that information? And Ava, you talked about that earlier, the kind of increasing information that founders get. And so building a model for yourself, a mental model of how you make decisions and what you listen to is going to be really, really critical. And we see probably the biggest delta of successful and unsuccessful founders on our program is those that listen and have a model for sifting through what should be actioned and not actioned. And actually, we have a kind of 3-pillar approach to that, but I think we're running out of time. So if anyone's interested in that, I'm sure we can pick up offline or in some of the networking events.
Great, fantastic. Well, I appreciate that, guys. Thank you very much, the three of you. For anyone interested in what's coming up next, we have 5 medtech companies presenting, and then we have Phil McSweeny, who will be keynoting in about an hour's time. But thank you, the three of you. Yeah, appreciate it.
Amazing. Thanks so much, Hugo.
Next up, we have ZiO Health. ZiO Health is a medical technology and digital health company that has developed an AI-driven handheld point-of-care device for therapeutic drug monitoring, bringing lab testing to the point of use.
I'm the CEO and co-founder of ZiO Health. We've developed biosensor technology to bring lab testing outside the hospital and to the point of use. One of the niche aspects of our technology is that we can bind directly to medications, and so we can measure the concentration of medications in blood. We're basically starting with a medication called vancomycin. However, we can also test a range of other medications, which I'll go through at the end. So vancomycin, it's an antibiotic. It's used for sepsis and MRSA prophylaxis. The problem with vancomycin is that it is very difficult to dose, and the reason for that is because it has a narrow therapeutic range. So if you give too high a dose, it leads to toxicity, and if you give too low a dose, it leads to ineffective drug treatment. One of the problems with being in the toxic range for vancomycin is that it leads to acute kidney injury, which significantly increases the cost for providers, up to around 36,000 per patient, because of the increased hospital length stays, and also the hospital readmission rates are also significantly higher as well, around 42%. So only around 51% of the doses are within therapeutic range, and this is because of the lead time between testing and the results being available for providers to then calculate the next dose. Around 27% of the doses are in the toxic range, and in the UK, in the NHS, around 35% are in the toxic range. So what we've done is developed a handheld device. It uses a few drops of blood, and in 3 to 5 minutes gives that result for vancomycin concentration, and then we can use the concentration to instantly calculate the next dose. So the major benefit here is the cost savings for providers, which is due to the increased turnover of beds, the reduction in length of hospital stays, the reduction of number of days spent in ICU, and the reduction in 30-day readmission rates. So even if ZiO maintained a margin of around 95%, providers save around $13,000 per patient. In the UK, that amounts to £3,000 per patient. So we've spoken to a number of individuals over the years, clinical pharmacologists, infectious disease specialists, nurses, critical care specialists, and they all agree that we need something that can measure the concentration levels at the point of care and give results instantly, so that you know the concentration in real time to then calculate the dose. So the market size for therapeutic drug monitoring is around $45 billion, and we're entering the market through the vancomycin testing, which is around $2 billion. In the US, 9 million patients are on vancomycin, and in the UK, 300,000 patients are on vancomycin. So our route to market consists of various strategies, one of which is entering the market through our research partners, which have conducted our studies for us, and also going through hospitals which have already done dosing studies for vancomycin and published their publications. There's around 50 plus publications on vancomycin dosing, as it is very challenging to dose. There are also other strategies as well in terms of entering the market. We can grow through high-risk locations, so where demographic is basically more difficult to dose. So where we are right now, we've completed our clinical performance studies at Johns Hopkins in the US, and we have gained our patents in US and Europe. We are actually also filing more patents now. We've been awarded grant funding, and we've also gained very good shareholders that help us for market entry as well as clinical studies and as well as our growth. Some of our shareholders include the UK NHS as well as private equity execs and pharmaceutical execs. So our team consists of myself and Shaolin as the co-founders. I have a background in medicine. I'm a medical doctor and have also completed an MBA. And Shaolin has a PhD in biosensors and has extensive connections in the industry itself. Dr. Yu is our first team member. He joined a few months after we were co-founded, and he has a PhD in biosensors and has commercialized over the years the knowledge that we had in the beginning. So over the years, we've now grown our team to consist of scientists, business development, electrical engineers, mechanical engineers, and software engineers. We've also gained a number of advisors, which include individuals specific for our first product, which is vancomycin, as well as individuals who help us enter other markets or understand other medications that need testing as well. We also have a range of scientists on our advisory list, and they were helpful while developing the technology, but now they're more helpful for their network and getting into universities for other studies. So one of the advantages to our technology is that we do not use reagents, and so we do not require microfluidics. This means that we are at very low cost at manufacturing, and it also means we can develop new tests quite rapidly. It takes around 3 months to develop a new test, and that is because essentially all we're doing is creating that binding molecule and placing that onto the sensor, which is the cartridge. We do not have to redevelop the cartridge each time. So we have a number of other products in the pipeline, other medications specifically. We've already developed tests for chemotherapy, other antibiotics, also for overdose monitoring, and also antiretrovirals for tenofovir, for example. We are joining an NIH-funded study for tenofovir, and we also received a grant for overdose monitoring. So, finally, our product pipeline also includes pharmaceuticals. We have, this is another problem, but around 50% of drugs fail during phase 2 of clinical trials for drugs due to the one-size-fits-all approach. So what we're doing is giving this device so that pharmaceutical companies can gain stronger evidence packages around that medication, and also be able to personalize a dose to various patient groups and get more drugs approved during clinical trials. Thank you.
Next up, we have Insight Surgery. Insight Surgery is the UK's leading provider of personalized surgery. Recently launched in the US with multiple FDA clearances, Insight Surgery has opened up access to the largest medical market in the world.
My name is Henry Pinchbeck. I'm the CEO of Insight Surgery. Insight Surgery is a personalized surgery company. We digitize the surgical planning process and automate the design and manufacture of patient-specific medical devices. And before I take you into the problem, I'm going to describe the current state of the art with personalized surgery. Personalized surgery requires patients' CT or MRI scans. The scans are used to design a medical device that's unique to the patient, specific to their anatomy. The patient-specific devices are then 3D printed for use in surgery, and they fall into three categories: anatomical models, surgical guides, and custom implants. In orthopedic and craniomaxillofacial surgery, personalized surgery is proven to improve outcomes. This example is for surgical guides, where an oncology surgeon is planning to remove a large tumor from a patient's pelvis. You can see the tumor here in red. For the best results, the surgeon wants to cut within a 10mm margin of the edge of the tumor. There are critical consequences for under or overestimating. Using personalized surgery, the surgeon digitally plans the cuts and then uses 3D printed patient-specific cutting guides to affix to the patient during surgery and guide his cuts. The pictures show the digitally planned cuts in green and the patient-specific guides in blue. Note that the guides are designed so they only fit in a specific spot on the patient and they're removed after surgery. You can see the guide here in blue. So what are the key advantages of personalized surgery? Well, with over 1,000 clinical papers published on the topic, the findings show better outcomes and lower theatre expenses. So what is the problem? Well, access to digital planning is currently complex, meaning that surgeons will not engage with it. Delivery of devices is slow. The leading provider of osteosarcoma guides, such as I showed you in the example, currently takes 6 to 8 weeks to deliver, by which time the patient may have deteriorated or the anatomy changed. Prices are high because each device has to be individually designed, and quality of devices has been an issue. Overall, the technology is worthless if it's not easily accessible, delivered quickly, priced appropriately, and it's accurate to the anatomy. The first aspect of our solution is our proprietary end-to-end digital platform, EmbedMed, that automates and streamlines the processes. It covers everything from ordering the device through digital planning, approvals, manufacture, and delivery. EmbedMed automates several stages of the design process. Most crucially, we now script the design of the devices. This has reduced the time each engineer has to spend on each device by up to 75%. It's easy for surgeons to access, for example, on their phone or their tablet. It's FDA approved and ISO 13485 quality certified. This means that the quality of the devices is guaranteed to be high and consistent. Our PCT patent from EmbedMed has been published and is pending registration in both the UK and the USA. And we've now provided over 1,000 patient-specific devices by EmbedMed, with delivery times reduced from weeks down to days. The second aspect of our solution is our point-of-care digital business model, which is intended to optimally use the technologies while giving the hospital a valuable in-house lab and providing Insight Surgery with a secure, recurring revenue stream. We seek a contract from a hospital to set up an on-site or nearby facility with staffing, hardware, and software. From our base, we supply devices to the host hospital as well as to regional hospitals, while also working with medical device companies. The contracts provide our recurring revenue, and the revenue per facility increases every year as the market matures and our automation gets better. CPT codes, which are USA reimbursement codes, are already available for models and guides. 60%. Once we automate the design stage further, our margins can reach 90%. In terms of competition, the market leaders materialize. However, they suffer from the same accessibility, high prices, and slow delivery issues as all the other companies. Our USP is that we automate the design of the devices and have a regional approach where we embed our services near or within hospitals at the point of care. The orthopedic device market is worth over 60 billion, with the entire medical device market over 600 billion, and it's growing at 5% per year and ripe for disruption. The global companies in it are highly competitive and highly acquisitive. The serviceable market for personalized surgery is around $5 billion and growing around 22% per annum. We are already established in the UK with 5 facilities and have recently secured a contract with J&J. Our growth strategy in the US has already started, and we've opened our first facility in Texas at the Texas Medical Center in Houston, where we have a contract with Houston Methodist. The TMC is the largest medical center in the world, containing the largest cancer center and the largest children's hospital. After we're established in Texas, we'll target opening in New York at the Hospitals for Special Surgery. We've also recently signed a contract with Acumed to co-sell our products alongside their implants. We've completed our R&D phase and including developing our platform and our quality management system. In 2022, we got our first FDA clearance, and in 2023, opened the facility in Houston. We've raised 1.8 million to date, and now we're raising a further 2 million. There will be an exit opportunity at break even in April 2025, when I would expect an offer to come from a medtech company to buy our digital platform and our market share. By 2027, we're generating sufficient EBITDA to be attractive to any investor, particularly large tech companies wanting to enter this market. Looking at comparables, well, digital surgery was sold to Medtronic a couple of years ago for $500 million, that is. We had revenues of over 560,000 last year and are on target to hit close to 1 million this year, an increase that's been achieved with hardly any capital outlay. As I mentioned, break-even will occur after year 2 in 2025. The team is full of specialists. All of the CEO, CTO, and FD have worked in startups and SMEs before. As a lawyer, I have a good understanding of the medical device regulations on both sides of the Atlantic and regularly give talks on personalized surgery. We're still missing some pieces from the US team, including a head of sales and a head of operations. We've got a strong clinical board with specialists from our target surgical fields. Our non-exec directors include industry leaders and our largest investor to date. The current round is to raise 2 million at 9 million pre-money valuation. We have 800,000 already closed. Funds will be spent on staffing in the US, sales and marketing, and opening new facilities. Overall, the de-risked opportunity here is to invest in an FDA-approved company that can expand rapidly in the UK and USA and achieve an early exit with only a small amount of financing required. Thank you for listening.
Next up, we have the Vaccine Group. The Vaccine Group is developing a vaccine platform that will overcome many of the challenges associated with the existing vaccines of the animal market.
Well, hello, my name is Jeremy Salt. I'm the CEO at TVG, the Vaccine Group. My background is as a veterinarian and a career vaccine developer with Pfizer Animal Health and Zoetis. And I joined TVG as CEO 2 years ago to help the transition from a basic startup university spin out to become a fully fledged biotech company. So a little bit about us. The core focus for us is in recombinant viral vectored vaccine development using bovine herpes virus 4 as our main vaccine platform. We were spun out of the University of Plymouth in 2017. The founder is a member of staff at Plymouth University who is partially with the university and partially with us at TVG. The focus of the company is for development of vaccines for use in animals. Over the years, we have received grant funding, we have received investor funding, private equity, and also we have had established commercial partnerships. All of those sources of funding have allowed us to develop a portfolio of pre-proof of concept vaccine candidates. We're currently in the process of fundraising through private equity to the tune of £750,000, which will complete by the end of the third quarter this year. I think everybody's broadly appreciative of the value that vaccines bring to infectious disease control particularly. However, there are not always vaccines for every disease, and this is really where we come in because of new strains that emerge, indeed new viruses, new vaccines are required on occasions due to new pathogens emerging. There are also certain pathogens that have been worked on over the years where they're extremely difficult to either culture or to understand the immunology of them and identify targets, and therefore there aren't existing vaccines. On occasion, some of the vaccines that have made it to the market are prohibitively expensive. And also from a developer's point of view, the timelines for registration can also be prohibitive on occasions, requiring 12 to 24 months, depending on the complexity of the vaccine. Another problem with developing vaccines on occasions is issues around manufacturing, particularly when pathogens that could be zoonotic are involved and high containment is required for manufacturing facilities. So the market opportunity that we're looking at in our area, the current animal health market for vaccines is around $9 billion per year, with a healthy growth rate forecast at around 6.5% CAGR for the next 8 or 9 years. Of our own vaccine portfolio, we operate a system of generating royalties and milestone payments on our candidate vaccines. If all of our current portfolio were to reach it to market, then we're looking at a return on royalties of around $70 million per year. One of the other major advantages we have at the company is 25 years plus experience of our founder and chief scientific officer, Michael Jarvis, in the development of herpes virus-based vaccines. The business model that we operate, it's a business to business, so we're out-licensing our candidates at around proof of principle. We hope to be able to move to proof of concept with further investment, but currently we only take our projects through to proof of principle. As I mentioned earlier, we've received around £2 million in grant funding from UK, US sources over the years, which has allowed us to develop our portfolio. We've also received around £680,000 from private equity that's acted as a complementary to our grant funding, but also allowed us to develop some projects internally. And we've also had commercial partnerships, which have paid for 2 or 3 of our projects to get through to proof of principle stage. The solution that we offer in terms of addressing the issues, using recombinant viral vaccines, we don't need a live pathogen each time because we're using our platform technology, which gets around some of the changes in production processes that are required. We have a very stable platform. We're well versed in how to put these things together. The figure there shows some of the actual stability data when our antigens are stored at -80 with virtually no biologically significant loss of antigen over that period, which lends itself very much to a commercial manufacturing process. And also with the vaccine master file registration that's being recognised now by more and more regulatory authorities, this is becoming it's an extremely strong case that we will have a registered vaccine platform and not just individual vaccine products as they come through. And we have, in terms of other aspects of key advantages for us, we have a very well-honed team and process that can deliver consistently new vaccine constructs once genes have been identified. We've tuned our platform to allow it to express, to stimulate either T-cell responses, which are required in some cases, or humoral responses through B-cell stimulation on others, or indeed sometimes combinations. We've demonstrated prolonged protein expression, which is in vitro, which is very useful if you think of prolonged immune stimulation, or indeed biologically functional protein delivery in vivo. And we're also able to work across species with good data now in pigs and cattle. We're working on other cell lines as a precursor for moving into companion animals in the future. The vaccine is self-adjuvanting. There is no induced vector immunity, so it can be used multiple times in the same animal, and we can carry a large payload. It's also DIVA compatible. We have a very experienced team now in Plymouth, 6 full-time members of staff plus the CSO. We have a nice diverse portfolio of products at pre-proof of principle stage. We're supported through Frontier IP, an incubator company shareholder, also the University of Plymouth, and we rent facilities at their Derriford Research Park. We work internationally through networks across the world, and we also have a product and process IP estate. So what we would do in future is we're looking for partnerships for front-end discovery work around antigens and potentially companies with platforms. We can do fee-for-service work with companies if you bring your own ideas to us. And particularly, we're now looking for private equity to help us deliver on what we've done so far with 8 existing candidates we have. And you can see on the bottom there with the milestones, we're enhancing constructs around our pig vaccines. And also we have 7 brand new disease projects within TVG that we aim to use the private equity funding for to take those through again to proof of principle, to put those constructs together this year and test them in animals next year. So in principle, we're ready to go. We have a tunable platform. We're open to discussion about interactions with us. And we believe that we're in a strong position to take these products forward and generate new products as well. Thank you.
Next up, we have Tarabios. Tarabios are a biomedical company focused on developing blood coagulation monitoring diagnostic systems in the aim of improving the efficiency of healthcare professionals and patients' quality of life.
Hello, everyone. I am Esat Oğuz, working as CEO at Tarabios. We are a biomedical company focused on developing blood coagulation monitoring devices in order to improve the efficiency of the healthcare professionals and patients' quality of life. And with the help of our device QuaRite, you can measure your blood coagulation status anytime, anywhere, with lab equivalent results. So the question is, why do we need blood coagulation monitoring? Most probably, around you, just your neighbors, your friends, or family members will be having a cardiovascular problem. And the people having cardiovascular issues are at high risk of blood clotting as well. So they need to use oral anticoagulant drugs. And the mostly used oral anticoagulant drug is warfarin. But it has a highly variable individual response due to several reasons, like medication interaction, disease state, age, or dietary. And the improper dose-response assessment of warfarin molecule will cause excessive bleeding, or unfortunately, it will increase the risk of the thrombotic events like stroke, deep vein thrombosis, heart attack, or pulmonary embolism. So those patients need to be regularly monitored. And the regular PT-INR monitoring, which is warfarin monitoring, the PT represents prothrombin time, is needed. And the dose adjustments of the patients are being done according to the regular PT-INR monitoring results. The patients are mostly still using the old school method, which is visiting the hospitals and laboratories. They are going to the hospitals, waiting for the queue, giving one tube of blood and waiting for the results. It is really inefficient. That's why we have built a product, QuaRite, which is portable, and it's a remote point of care and self-testing platform. In the very left-hand side, you see our product. It's composed of a reader and a disposable cartridge. I would like to mention about the critical features of QuaRite. One of them is being viscosity-based. It gives us two main advantages. The first one, it's a direct measurement method. It is the World Health Organization's reference method. And with the help of this, the results are not affected from the drug-drug interactions or other clinical symptoms. The second advantage is, by being viscosity-based, we are not going to only measure blood coagulation monitoring, but we're going to move to the other research fields, like detection of viral infections or inflammatory diseases, or viscosity measurement of industrial, agricultural, or environmental fluids as well. Coming back to our product, QuaRite, it's ease of use, we say, because there is a graphical user interface and there is a touch screen as well. One drop of blood is enough. I'm going to show you the technology in the next slide. And it gives us the fast turnaround, which is within a minute, it gives the blood coagulation monitoring results. In the right-hand side, you see in the second version, we're going to put a mobile application so that the patient will be automatically sent the results to the healthcare professional, and the healthcare professional will be making the dose adjustments accordingly. It's a golden standard. We have two different patents. We have the IPs for almost relevant in all over the world, I can say, most of the countries, related with the fiber optic-based sensor technology. I would like to mention about our technology. So from one drop of blood, our cartridge uses passive capillary flow in order to fill the microfluidic system. And in the right-hand side, you see our optomechanical measurement principle, which uses the vibrating optical fiber in order to measure the viscoelastic state of the coagulating blood. And during the coagulation, the amplitude of the vibrating fiber decreases over time, and that's how we understand the blood coagulation happens. So this is our fiber optic-based sensor technology, which is patented almost all over the world. I would like to mention about the competition. In the very left-hand side, you see the main features of Tarabios. One of the most critical one is we are a platform technology, which means that we are not going to only measure blood coagulation monitoring, but we're going to move to the other research fields, like monitoring of viral infections and inflammatory diseases, and viscosity measurement of industrial and agricultural fluids as well. And we have a direct measurement method, which is the World Health Organization reference method. And with the help of this, we give lab equivalent results. And we have the multiple sensors in order to cross-check the different factors coming outside, like the humidity, temperature, or vibration. And we have ease of use with the help of the touchscreen and the graphical user interface. The biggest market is glucose testing market. The second biggest market is blood coagulation testing market. So last year, in 2022, the market actualization was almost $2.5 billion. So it's a sizable market. And in the right-hand side, you see the CAGR growth expectation, which is double digits because of 4 different reasons. And the main reason will be the growing demand for preventive medical care. The biggest region is Europe with 31% market share. Then North America comes, and then the other countries. So we're going to focus Europe first, then we're going to move to US, and then to the other countries. So the milestones, I would like you to focus to upper side first of all. We have started with a seed investment of $3.5 million. And the blue color represents our R&D and product development. We have started with PT-INR first, but we are also working for heparin monitoring, which is APTT-ACT. And we also started to NOAC R&D as well, which is the new oral anticoagulant drugs. And we're going to move to the other diagnostic applications next year, in the second half of next year. And we are in round A now, and we are looking for a minimum $5 to $6 million, mostly to critically to expand to global and to make our marketing investment and also to continue our product development. In the bottom corner, you see the awards that we have received and we are really proud of, especially Medica, which is the world's biggest medical fair. We have been selected as top 12 within 2,050 companies. And in the right-hand side bottom corner, you see where we are. We are almost at the end of prototyping phase for our Powerite PT-INR monitoring device. We're going to do the clinical trials in Q4 this year. Then we will be applying to the CE notified body by sending all the finalized technical documentation. And at the same time, we are preparing for FDA, hopefully to receive CE marking in the second half, in the very first days of second half next year, and in the very first days of 2025 to receive FDA. And finally, this is our team. In the very left-hand side, you see myself. I'm the CEO of this company, coming with 15 plus years of healthcare experience. Our CSO, Hakan Ürey, has more than 50 patents, 5-6 spin-offs, and 1 exit experience. Dr. Sinan Müldür is our technology and product development manager. He had his postdoc at Harvard Medical School, and our hardware and embedded software manager, biosensor development specialists, and bioengineers. Thanks for listening to me. I'll be so happy if you can contact with me whenever needed, if you're interested in Tarabios. Thank you.
Next up, we have Bildia. Bildia is a SaaS-enabled construction trading network that streamlines procurement for builders and suppliers.
Hi, everyone. I'm Geronimo Van Schendel, CEO of Bildia. I'm also an architect, and I have more than 15 years of experience in construction. Bildia is a SaaS platform for construction procurement and sales. We are in a highly fragmented and project-based industry, arguably the most fragmented industry in the world. The problem we have is that procurement and sales have to start over in every project in an industry where 95% of the companies are SMEs. The current tools, such as ERP, CRMs, and other things that companies are using, are not made for the construction processes, the construction data structure, and quite importantly, for how the B2B relationships are managed. As a result, 70% of the procurement and sales work is repetitive and manual, and it is currently impossible to optimize and take data-based commerce decisions for our clients. So this is a huge problem because procurement and sales are the #1 profit driver in construction, both for general contractors and manufacturers. So at Bildia, we integrate construction commerce. We bring together processes, data, relationships, and transactions bringing the best of an ERP for procurement and estimations management, the best of a CRM for suppliers and client relationships, and B2B e-commerce construction capabilities. So we are designed to deal with specific construction data, guaranteeing privacy and long-standing B2B relationships through our software with seamless onboarding, 100% traceability, and the only autonomous, customizable, and real-time e-commerce for construction. In the end, what we are focusing is in providing specific value and relationships for our key construction stakeholders. We work for general contractors with full-time teams of estimations and procurement, for manufacturers that have medium or large portfolios of products and complex ones, and as well ecosystem of salespeople and reseller agents, and for subcontractors who are typically SMEs that work for general contractors and provide packages of services and products and are typically trying to procure quite specific types of products and systems in the industry. Our technology is quite specific and at the same time quite simple. We are able to work on 2 layers of SaaS interactions, data, and privacy. Basically, on a first level, we basically connect to our clients' core processes. On the side of general contractors, we connect to the pre-construction estimations, pre-construction procurement, and construction procurement and asset lifecycle maintenance. We connect a layer that automates their processes, standardizes their database, and makes it accessible in real time, and provides privacy and reliability for managing very numerous interactions with their own suppliers on a private mode. On the side of manufacturers and resellers, we help them to do data integration of products, clients, and pricing, which can be extremely complex and a challenge for non-construction suppliers of technology. We also help them to centralize all their sales teams and channels and provide the best e-commerce construction experience for their B2B clients. Through these softwares, they can operate on both with any company in the market, so any company with connection to the internet, but they can also operate on a second level on what we call the Bildia network, the B2B platform for public interaction, with enhanced database standardization, AI applications based on the data models that we have, such as doing pre-construction estimations modeling based on the own data of each company, or stock modeling for manufacturers, for instance. We also provide B2B transactionality in the platform, safety layers, and a unified environment for relationship building. On the side of subcontractors, we also automate, structure the database, but mainly give them exposure on a very specialized market and help them to build a network and manage that network over time. We monetize the model via general contractors via a SaaS fixed annual fee, where they can have unlimited supplier database onboarding and unlimited supplier interactions. With manufacturers and resellers, we work on a fixed annual SaaS fee plus an additional fee for transaction volume, which is not a commercial intermediary type of fee, but one that is very complementary with the dynamics of the industry, which is sort of infrastructure intermediary, which is between 0.25 and 2% of the total turnover, and they have unlimited clients database. And we will progressively start monetizing subcontractors with fees for visibility, homepage hosting, lead packages, and so on, which all of those are pretty big problems for these SMEs. We do have an open and very large vision and capabilities to add value on the supply chain in multiple ways with our technology. We are the very first steps, but we can also go into advanced data and business intelligence services, or for instance, construction fulfillment by connecting the capabilities of e-commerce to some of our partners for manufacturers and resellers, and much more. So we believe that there's a very, very big room to grow in this space. In terms of competitive advantage, we are the only ecosystem or digital ecosystem in the industry that blends together process management, relationship management, and transactionality. We unify the procurement and the sales of our clients with any company that they want to be related with inside and outside Bildia. We have a seamless transitioning and kickstarting in an industry where clients often are above 1 or 2 years of implementation of solutions. And we have the separate layers of privacy and data in terms of tech advantages, compatibility with all legacy software in the industry, and the network value. We have a large market. construction is in itself a very large market, procurement one of the largest, since more than 65% of the investment of a project goes directly into contracting of products and services. Our TAM includes any B2B company in the industry with a full-time procurement and sales team. Our technology can manage all construction types in different regional markets. That's something we've already proven. So as a beachhead market with the first revenue streams, we have a TAM in Spain of 4 billion and global estimations of 292 billion. In terms of traction, we've already processed more than 51 million of tenders. We have an average response ratio that is more than 5 times what's the average for our clients in using any other alternative to Bildia. And we are reaching now our 25th client, more and more largest clients with a lot of volume operating on the platform. We have a unique team with construction tech and sales DNA. We've led construction and digital projects worth 500 million over the last 50 years. Myself, I have been both on construction management for private and public clients in more than 5 countries, mainly Spain, Latin America, some part of Europe and China, working on projects that have been extremely large, for instance, train stations or parks infrastructure for Shanghai municipality. Our CTO has been part of the team that developed the Leroy Merlin marketplace, and our COO, for instance, was the youngest construction lead on a project for the Airbus factory in Toulouse, among other experiences of our senior team that have been in companies like Cemex or Cemex Go or Saint-Gobain. To wrap up our round, we are raising a round of around 1.5 million euros plus 300,000 in public non-dilutive funding. We want to reach with that 100 relevant builders and manufacturers, 1 to 2 billion euro in procurement volume or power on Bildia, and the first 500,000 euros in transactions from manufacturers. And yeah, we would love to hear more about you. Connect and have you joining our journey to build the best B2B commerce platform for construction. Thank you so much.
do some breathing exercises.
All right. Good afternoon, everyone, and welcome back to V&C Global. I have the utmost pleasure of welcoming Phil McSweeny, who will be our keynote speaker today. Phil is a mentor, startup advisor, and an author with a deep commitment to supporting founders as they launch and scale their businesses. Phil brings an extensive background as a company chair, non-executive director, and executive coach, roles in which he has guided startups to achieve their potential. His passion for startup growth is founded on a strong belief in clear goals, the right team with the right mindset, value orientation, competitive positioning, and disciplined execution. One of Phil's key initiatives is Angel Think, a resource that helps founders get into the minds of angel investors, an essential skill when looking to raise capital. This approach comes to life in his book, Angel Think, The Founder's Guide to How Business Angels Think and How to Raise Money from Them. Moreover, Phil has been the executive chair of Patient Source Limited since 2020, guiding the company through scaling, team building, partnerships, and fundraising. He's also an NED or board advisor for several other companies. Known for his insightful founder support material on LinkedIn, Phil is a valuable resource for anyone seeking to navigate the startup landscape successfully. It's a great privilege to have him here with us today. Please join me in welcoming Phil McSweeny.
Hi.
Yeah, the floor is yours, Phil.
Okay. I'm going to just share a few slides first of all. So not that. Share screen. Tell me if you can see that.
I can see that.
I'm on the wrong slide, but so hello. I'm Phil McSweeny.
Yeah, Phil, do you want to put it in presentation mode?
Yeah, I can do that.
All right, fantastic.
I'm Phil McSweeny, and I'm, as trailed by Hugo, a chair of a company, a NED, mentor, advisor, angel, and author of the book you can see there, Angel Think. And my topic today is the human side of investing. And I am not going to be talking about data, analytics, tech stacks, the metaverse, blockchain, Web3, crypto. I'm going to be talking about psychology, really, and relationships. And the way I'm going to do this is I'm going to stop sharing and every now and again just show you a couple of slides. So I'm a relationship person. Hugo, can you still see me?
I can still see you. We can't see your presentation though.
No, I turned it off.
Okay, great.
Temporarily. So I'm a relationship person. And I think founders and investors fall into two camps or two extremes. There are people who argue, on the one hand, that investments are made because of the numbers, the business case, the logic of the proposal. And on the other, there are people who are attracted to an investment because they can see something in the founder. They love the story, the vision, the association with the business, the idea, the whole emotional appeal of it. So, okay, it's a spectrum, and you can't divide the world into those who love only documentaries and those who love dramas. Let me tell you briefly about my youngest daughter. When she went off to university 12 years or so ago, I said I'd buy her a car. I said, here's a budget, go away and have a look at what you want. And she came back a few days later and she insisted it be yellow. So no facts about reliability or running costs or miles per gallon or resale value or any of that made any impact on her at all. And I'm sure if the dealer had said to her, oh, that'll be another £1,000 because it's yellow, she would have said yes. I mean, it was my money, but there you go. And as you might imagine, it turned out to be a rust bucket. And 3 years later, it irretrievably failed the MOT because there wasn't enough metal to hold the rust together. But it made her very happy. As we unpack AI, I'm seeing all sorts of tech-driven businesses or ideas being offered to founders by other founders. New databases that enable deep searching for investors, what might match your criteria, or more impressive text in pitch decks and so on. And going by the amount of impressions and likes these posts get, founders are liking these developments. So what are the problems I see here? The problem is about emotions and relationships. So I'm talking about relationships for a moment. And the problem that I see is that technology enables more spray and pray, the shotgun scattering of pitch decks to more and more people that you don't know, whilst doing nothing to argue for and help you build relationships with potential investors. And whatever you might have come to think of angel investors from your own experience, most of them do want, or us, do want a workable relationship with you because investment is for the long term. Now, we're not looking for new best friends, but it helps if you're likable. Opinionated, sure. Assertive, sure. An authority on your subject, sure. Arrogant, no. But able to do some basic human skills like build rapport with someone, understand what chemistry is, have a trace of empathy and humility. And it's not all for the investor's benefit either. I have to believe that you can attract a team of people to scale your business. So, in summary, the mantra of relationship, of selling even, is know, like, and trust. Nobody gives money to people they don't know, and particularly if they don't like them. A political party donations must be the exception that proves the rule here. And I'm prepared to believe it's not entirely true, but I'm talking first-time founders, early founders, little or no track record, no exits, etc. A completely unknown entity in many cases, if you like. But loads of shareholders will invest in Tesla who will never meet Elon Musk. But you're not him. So let me just put another slide up for a minute. So a little, whoops, go down a little bit about storytelling. I've already hinted at the importance of making your pitch attractive. And I don't mean in a kind of warm, fuzzy way. I mean magnetically attractive. I've mentioned love and emotional appeal, and some years ago, I dug into understanding how marketing works. excuse me, how marketing works and the importance that emotions play in our decisions. Whilst a lot of people, marketers, talk about digital marketing and SEO, etc., some talk about emotional marketing. It's the emotional triggers and connections that make some brands top of mind over all others, what's going on unconsciously as well as consciously. We like to think we're rational human beings, but no, we're not. Almost all of our purchasing decisions, substitute investment decisions, are made with emotions in play, with an overlay of post hoc rationalization. If we were always happy with our purchases, investments, then buyer's remorse wouldn't exist. Why do you think with many purchases a cool down period exists? So as founders, we seriously need to consider how to capitalize on the power of certain emotions in persuading investors to invest. You're trying to share something compelling. And the first approach is pretty obviously storytelling. Storytelling, or stories, have an irrefutable power over us. We're genetically hardwired to listen to stories. And if you don't believe in the value of storytelling, then think how whole Saturdays or whole Sundays can go by while you're laying on the sofa watching 8 episodes of a box set continuously. But what stories? We can tell stories about origins, about visions, about values, about transformations, and so on. And you can make your founder story very powerful. People love to hear about what's driving you forward, where you got your passion from. What made you or led you to see something that needed doing in the world? What sacrifices have you been making? What values do you hold? And so on. So a powerful founder or origin story can warm people to you, or warm you to people, get them aligned to your purpose and help them see your authority in a space. It can help them see why people would work with you and why you'd have no problem in finding co-founders and recruiting a strong team. So I think storytelling is a key human skill. Some call it a superpower, including Mark Cuban of Shark Tank fame. Now, vision is something else. Here, people get the idea of storytelling wrong, in my opinion. They talk about the traditional arc a novel or a film takes. An often quirky character gets drawn into a problem, which gets more and more complex until there's a crisis and then a resolution. But when we talk about our business, our fundraising, our vision story, the resolution is in the future. The power of the vision story is in the invitation, the shared challenge of building your vision together, a place where you can see the solution you propose is working and the impact it's having on people's lives, and you're offering that challenge, that journey to investors to come with you, the invitation. And I sometimes tell people to imagine what it must have been like centuries ago for Christopher Columbus. Now, Christopher Columbus, as you know, allegedly discoverer of America, decided to set sail to the west to find a new route to India because it was really expensive and time-consuming to go to the east or south, all the way down the Atlantic, round the Cape and across the Indian Ocean. So I just imagine how he must have gone about trying to raise the money to build the ships that he sailed by promising people the adventure, the invitation, the shared challenge of, you know, what he would find, the riches he would bring back, the gold, the fortune that they would make, etc. So I kind of see him as a, you know, a very early founder example that must have told a compelling story. I've got another couple of slides to share. Just hang on a second. I should have stopped sharing that one. So I'll just go to this one. Competitive advantage. I'm going to talk about this for a moment, and I'm going to stop sharing for a minute. Whenever I ask founders what their competitive advantage is, they almost always talk about, you've guessed it, intellectual property. And there's nothing wrong with that, except most founders don't have it or don't have much of it. And I'm referring to patents here, and you need to know what you can patent and what you can't. And then there are trademarks and designs and brand names and domain names and the like. But let's get beyond that kind of legalistic view of what competitive advantage is. To me, the first and most obvious thing that gives you a competitive advantage is you. You and how you use and develop you. And I'm talking about building authority and understanding where that comes from. If I take myself as an example in the startup space, I've once been called a thought leader, and that was very nice. But I can think of three people that I follow a lot. One has the authority of having been a merchant banker and worked at a VC. One says he's a many times founder with multiple exits. And one concentrates on storytelling and claims to have raised over $550 million for clients through the power of storytelling. I don't have those authority anchors. Remember that phrase, authority anchor. But whenever they post on LinkedIn, their posts get more views and likes than mine. Tough. And my authority is built on giving value to founders with regular insight posts and a book of insights that Hugo mentioned and helps them fundraise. So you need to find and develop what it is about you that gives you that authority. And often, but not always, it's your profession, your professional background, but you need to look like a winner. If I had a lot more time, I could unpack all the stuff about building a personal brand here, or becoming a thought leader, or developing as an influencer or a trusted advisor, etc. But I'm sure you get the picture. And there are other things you should consider in this world of competitive advantage. You look for and develop what you do over and above the competition, your unique thing. You can develop your competitive positioning, like your customer type or the channels you use or the locations that you offer the business in. You can try to build a moat. You can find and share insider information. You can recruit the best team you can and let them be your competitive advantage. You can develop an in-depth understanding of your market, trends, where it's going, how needs are changing. And timing is everything. Think about AI, for example. I'm just going to share another slide. Hang on. I want to talk about attributes for a while. So you can see these little people down the bottom here that are obviously have the right mindset. I'll stop sharing that for a minute. Most of my early experience as an angel was with angel groups. I've been a member of 3 angel groups. And early days, someone more experienced than me usually conducted due diligence or investigation into a founder or co-founders, and I never really got to know the founders very well at all. And if I think back now, I laugh because through not knowing them, I didn't know basic things about them. I didn't know if they could sell, for example. In my defense, I don't think most of the rest of the group did either. So let me tell you about my split screen idea. When a founder is pitching live, I look at the pitch deck and the narrative it tells, and at the same time, I'm trying to watch the founder to make an assessment of them. Is he or she the person that can actually deliver that hockey stick graph that they've stuck in towards the end of their deck? But what does that mean? Can they lead? Have they attracted a team of co-founders or advisors by the strength of their own self-belief and the vision that they've got for the business? Is the team committed in the same way the founder is? Is the founder a real authority in the sector that they're proposing to launch the business into? As I said, can I see them being the person that's going to scale it? Where's the business? Where are they going to take the business in 5 years' time? And most of these things I just don't know in 5 or 10 minutes, partly because I've been glued to looking at slides rather than looking at the founder performing. So that's just peeling back the top skin of an onion. I get first impressions, and of course they're important. I get a gut reaction. I can only start with some likability or possible chemistry. But everyone these days talks about founder attributes. Founders need to have, ready for it, here's a list, an impossible list. Growth mindset, grit, tenacity, belief, resourcefulness, integrity, judgment, authenticity, curiosity, decisiveness, shrewdness, empathy, patience, of course, emotional intelligence, and so on. People talk about founders needing to be superhuman, to have superhuman qualities. Can they run through a wall? How many plates can they spin at the same time? And one of my favorites, can they build an aeroplane after they've jumped off a cliff? So we describe and expect perfect human beings, even though they don't exist. We're not perfect ourselves, and we know both of those things. But we don't try to make any objective measurement of any founder attributes before we give them hundreds of thousands or even millions of pounds. And initially, that might work to your advantage until you fail and no one wins. Bit of a disservice, don't you think? We've got another slide I'm going to share for a moment. Show. Okay, founder market fit. So let's go back to something there's a load of names there. I don't know where they've come from, but seem to be overriding the slideshow. So let's stop that for a moment. Let's go back to product market fit, something that's been talked about for years and what you ideally should be aiming for, the fit between your idea, your product, your service, and what the market wants. But notice in that short phrase, there is no mention of the word founder. But crucially, it's the founder and their team that will deliver product market fit. Much more recently, people have been talking about founder market fit. So how does that show up in a founder? So my first thought is obsession. Your belief in yourself and your idea is so strong, your brain is exploding with it. You're immersed in your market. Your authority is your knowledge. You might work all hours. You can't sleep. And there's a downside, obviously. Mental health, high levels of mental health problems, burnout amongst the founder community. But generally, I take it as a great signal for the long term. Second, backstory. A great founder story, you can explain your passion, your motivation, and it creates a much more compelling reason to get involved than just, I spotted a gap in the market, or, oh, I've always liked cheese. Thirdly, personality. Are you likable? And I don't mean necessarily cuddly in a likable way. I like rebels. I like people that are ballsy. But is the market going to warm to you? Will you be accepted by peers and investors? How well are you connected? Personal brand, thought leader, trusted advisor, all of those things. But importantly, who's giving you those likable references? And fourthly, experience, your experience in the sector that you're trying to launch the business into. I think it matters much more in some sectors than other. My interest, particularly bio, life sciences, pharma, med tech, health tech, it really matters where you come from, what you've done. If you're developing a new ice cream brand, it possibly matters less. But those founder market fit criteria should enable you to kind of put aside unconscious biases. If you fit, it shouldn't matter if you're old, young, male, female, black, white, and so on. So if I have a takeaway, like a most important message here, it's this. I've come to view that angel investing is really the search for the exceptional entrepreneur. It's a bit, ideas are cheap, but it's whether you can execute that matters. Often we don't know that at the beginning. So yes, of course, know your numbers, but I look for a founder wanting to make an effort to develop a relationship with me. I look for their potential. Can I see them doing what I expect them to be doing in 5 years' time? Can they learn? Are they wanting to grow themselves as well as scale? And I like to hear a great story with a founder who shares some values and, more importantly, who can share a vision of what they will improve in the world or for their niche of customers. And I want to meet the team, not just the founder, to see if that passion is shared across the team. And of course, an ability to pitch also helps persuade. And I've learned some psychological tricks, I guess, that founders play. For example, FOMO, fear of missing out, and scarcity advances. And you'll know the kind of thing I'm talking about. We've raised 85% of our round, and we want to close the round by Friday. We're looking for people like you, but there's only 15% of the round left. Hurry up, etc., before the door closes. And here's a recent one that was pitched to me. Hi Phil, we've got an investment of £20 million from an institutional investor, but we've held back £2 million just to give angels like you, an opportunity to come on board. And I thought, yeah, it's quite clever, really. They put some thought into this bullshit. So I generally don't buy these advances unless they come from people I have a trusted relationship with. Show me the founder who refuses to overfund or take the right person's money. So I don't think I'm actually saying anything contentious, and I'm just going to share the last one or two slides, and then I'll be there. I'm just going to show you that I've only got 3 left. One I mentioned the disservice, and I'll say a little bit more about that and the long view, and then I'll say thank you. And I'll leave that there for the moment because I'm nearly done. So going back to what I said at the beginning, I think founders get misled somehow as to what's expected of them, not just by angels, but by the whole startup circus we're in. And much of the advisor industry is not helpful in this regard either. And one example I'd say, there's so much rubbish written about pitch deck fundamentals. This obsession, this detail with the number of slides you must have, what slides need to be in or out, what order they're in, etc. A founder's competitive advantage is often themselves. They identify early the kind of investors they want. They work out where to look for them. They build relationships early. They're interested in supporting investors to get what they want. It's a two-way street. Founders are on a journey, investors are on a journey. They need to find where those things collide. They see the relationship as a partnership over the long term. It's not just a transaction. I'm not just a wallet. They make their idea sound exciting. They can tell a compelling story. And their team wants to deliver the mission as much as they do. And they know what they're letting themselves in for, and they know they have to develop themselves, and they're hungry. The ones that just do and are what all the other founders do, let's call them politely the pedestrians, end up in the same place, unfunded and left on the sidewalk. And I don't think we, the startup ecosystem and angels, help them necessarily just by giving them money. We need to expect more of you, and you need to give more to us. So perhaps I've given you some idea of what I look for in an investment these days, and I hope that helps. So let me just say thank you, and you can connect with me. I'm on LinkedIn, Phil McSweeny, and my book is available on Amazon. So thank you very much, and I'll stop sharing that now.
Thank you very much, Phil. I think that was very, very insightful. The human aspect is definitely very important and sometimes tends to be overlooked. As you mentioned at the start, I think, we have a couple more minutes and I've prepared a couple of questions. So I think, more on a personal side for yourself. Can you maybe share your journey into becoming an angel investor yourself and what drove your passion originally for startups?
I think the journey started a bit by accident. 15 years ago, I'd had a career in our National Health Service. I got to being a director, and one reorganization too many, I got made redundant. And I thought, I'll take this. I don't really want to go back and work for large bureaucratic organizations that take forever to make decisions and so on. And I thought, I've got a chunk of money, and I want to work at the other end of the spectrum. I want to see what startups do. And I went along to my second angel group meeting. I completely had no idea what it was all about. And I thought, this is interesting. This is quite exciting. There are these people promising, that they're going to make people millions. And I made a couple of investments, and one came along that was a great fit, I think, to my past experience. So I said, I'd like to invest in you, but can we talk about a role? Could I become an advisor? I'll tell you about, what I could bring to the party. And it all kind of took off from there. And as part of my redundancy package, I was offered retraining as an executive coach. So I was beginning to bring together these kinds of skills, as a coach, as an advisor, with a bank account full of money, going to angel groups, and I just got the buzz, really. And here I am, 15, 16 years later, have made 30 plus investments, some of which have gone down the pan, some very quickly, some one or two exits, and sadly, I guess, that middle ground where there are too many companies that have become lifestyle kind of businesses, which aren't growing, which aren't scaling. They're a bit zombie-like, in terms of what they're doing. So yeah, that I was going to say in a nutshell, but I've been rambling on. That's how I got into it. So.
Fantastic. No, that's definitely very interesting. In regards to maybe one of those 30, can you speak about them, or is that confidential?
Depends what the question is, and depends, whether I want to name them or not. But yeah.
Yeah, or you don't have to name them, but perhaps give us an example of a success story about how maybe your mentorship or your advising has helped a startup become what they are.
There are few that have actually, scaled to great heights, as it were. The one that I've been with the longest, I started off as an investor, advisor, NED, and then I became a chair a couple of years ago. And so I brought experience, and not just sector experience, but the experience of kind of, managing people. But I suppose it's a kind of learning exercise for yourself, because when you work with founders in a startup, your, I suppose, more traditional corporate style of management of directing people is not what they want. It doesn't work. They resent it. So the kind of, constructive challenge, the critical friend approach, I think is what works. But others are much earlier on, and they, find a value in a whole range of things, particularly fundraising, because with companies that I've been with longer, I've been through, 3-4 fundraising cycles. So a first pre-revenue or early revenue company is really interested in how they can raise funds, and that's where my book, I guess, comes from.
Fantastic. Well, look, I think it's we've come to the end of our time today. I'd like to say a big thank you to you, Phil, for joining us today. And for everyone watching, all the attendees, we'll send you a link with Phil's book if that's something of interest. Otherwise, you can go straight to Amazon, as he's just mentioned. It's called Angel Think. So yeah, thank you very much, Phil, and looking forward for a future time.
And thank you for the opportunity to meet all these people all over the world that no doubt I'll hear more from. So great.
Fantastic. Thanks, Phil. Have a great day.
All right. Cheers.
Next up, we have the Wheelhouse Group. The Wheelhouse unleashes the sharing economy by partnering with owner-operators of underutilized spaces. Together, they create the Wheelhouse, a co-working space that allows freelancers, startups, and work-from-homers to come together and flourish.
Hey, hello everyone. My name is Harry Turner. I'm one of the co-founders of The Wheelhouse, and I'm really pleased to present to you this investment opportunity. The Wheelhouse is a place where you, your business, and your community flourish. We unleash the sharing economy by partnering with owners and operators of spaces that are underutilized, such as charities, city councils, community organizations, and together we create a wheelhouse, a co-working space that allows freelancers and startups and work-from-homers to come together and flourish. The Wheelhouse is a technology-enabled co-working brand and marketing firm that enables these owners and operators to create these co-working space. And our unique business model allows us to rapidly expand whilst retaining a very, very low cost base. Just want to introduce you first to our founders. Obviously, you've met me, Harry Turner. I come from a 30-plus year background of technology and operations, having been in roles such as being the global head of IT infrastructure for Macquarie Bank, Australia's largest investment bank, having been the global head of operations for a large microfinance charity, and having even set up a social impact fund with a number of other colleagues. I'm joined as co-founder by Alex Lloyd-Davis. She has 25 years or more of experience in sales and marketing. She was the UK commercial director at Kellogg's, marketing director at Procter & Gamble, brand and sales consultant to numerous companies, startups, and third sector organizations. And we're ably joined by Sanjay Matani as a director of the company who has a raft of experience in startup and consultancy experience across Europe, the US, and Asia. Now, the problem we see for venue owners is that with the rise of hybrid working and working close to or from home, there is an enormous rise in partially used office space. And we believe this is just getting worse. A Gartner report recently showed that 70% of CFOs are planning to move part or all of their on-site workforce into remote workforces post-COVID. CBRE advisor Simon Johnson predicted that regular remote working could become the norm for as much as 50% of the UK workforce in the long term. There's not just a problem though for venue owners, there's a problem for workers. Commuting can be really harmful to our well-being. Over half of commuters say the commute increases their stress levels. Over a third say it decreases the amount of time spent sleeping. But the solution of working from home can harm our well-being too. Many complain about a sense of isolation. Zoom fatigue is a common complaint. In a survey of over 12,000 professionals, BCG found that connectivity was being missed. Spontaneous connection with co-workers just walking to their desk or social gatherings at work. On top of all that, work-life balance when working from home can be a real challenge. So we at the Wheelhouse have a purpose. Our purpose is that we exist to help you, your business, and your community flourish. We embrace the sharing economy, connecting venues that have underutilized space with communities of co-workers. We believe we have a powerful impact, that through building community, we can help combat the loneliness epidemic. Recognizing this loneliness problem as such a serious problem, the UK government, in fact, created a cross-government loneliness strategy in 2018 prior to the advent of the COVID pandemic. Research shows that joining a co-working space positively impacts loneliness. 89% of co-workers say they feel happier. 83% say they feel less lonely. 48% of members of the Wheelhouse have indicated that they joined because they wanted a sense of community. And we run community events and networking events and even provide things like chaplaincy services to try and really address that sense of building community. Our business model is simple and it leverages the sharing economy. We partner with owners of underutilized space, council buildings, office owners, churches, community centres, and we leverage that partner's existing office fit out. That allows us to launch with really minimal increase to our operating cost base, and for the large part allows our partners to launch with us, likewise with very minimal increase in operating expense. Our low capex model means we can work in underserved towns and cities, and really we can operate in venues of any size. We're not confined to large spaces in wealthy metropolitan districts. In addition to that, our business model really leverages technology. We have selected a suite of high quality technology solutions and uniquely integrated them together to create an end-to-end co-working platform. By integrating with a high quality network solution, we can connect each member into their own virtual LAN. That's great for their security, but also allows us to automatically register them as present, meaning we can operate in a low or even no supervision environment. We've created automatic reported tools for oversight for our venue partners. We've created automated onboarding tools for our co-working members and for our meeting room members, which really means we can operate with a very, very lean team, and we can scale off the back of that without significant additional resources. From a financial perspective, we've really bounced back from the COVID lockdown. Obviously, 2020 was a difficult year, but we survived that thanks to the business model of working on a revenue share basis rather than taking on board fixed leases. That really gives us some protection in downside scenarios. As you can see, revenue's growing well. We took on investment in September 2022. And hence our cost base increased, but we're on our way back to profitability, which we'd actually hit in March 2022. The proposed investment here is for a further £440,000 on the same terms as the first close that came in September 2022. We're looking to use that to continue building out the technology platform, some further work on marketing, and a further increase in personnel. So really, this is your last chance to join at the same valuation. And remember, since we first signed the first closed, we've signed 5 new venues with 4 more likely, and revenue's grown by over 30%. So really, this is a last opportunity to join at the current valuation. Thank you.
Right, now next up we have Viritech. Viritech provides automotive manufacturers with the best performing, lightest and most space efficient hydrogen powertrain technologies.
Hello, welcome back. I'm Timothy Lyons, founder of Viritech. We founded Viritech in 2021 with the intention of becoming the world's leading developer of hydrogen powertrain solutions. While our technologies have wide application, we've now sharpened our focus around the automotive sector, based on a development pipeline for 4 key technologies. As you can see, we've come a long way in that journey, creating innovative technologies and growing recognition from major automotive manufacturers and Tier 1 suppliers.
Hi, I'm Matt Fawkes, CTO and co-founder of Viritech. responsible for technology strategy and our world-leading IP. Viritech focuses on the smart, enabling technologies that sit between the fuel cell and the electric machine. This has resulted in the development of our Tri-Volt ecosystem, comprising proprietary hardware and software, which includes high-performance DC-DC converters, vehicle and energy management systems, high C-rate battery packs, and a proprietary battery management system. In addition, our Graph Pro structural pressure vessels provide efficient on-vehicle hydrogen storage. All of these technologies are now running on our mule vehicles at TRL 5 or 6. This includes a detailed 18-month design for manufacturing roadmap that will bring to market all of the 24 products which will flow from these technologies by the end of Q3 2024. This is our DC-DC converter, part of our range of revolutionary power electronics technology that will be available to OEMs and Tier 1 manufacturers later this year. The benefits of having in-house PCB manufacturing, along with our focus on control systems and power electronics, has enabled our rapid pace of development over the last 12 months. That means we can go from design to testing in under 48 hours, and prove the manufacture of designs in-house prior to licensing our technology. A fundamental difference in the architecture of our hydrogen powertrain solutions is that we use the fuel cell as the primary source of energy on vehicle. As a result, we have optimized battery technology for very high C rates, meaning they can charge and discharge extremely rapidly, which is particularly important if you are trying to capture the kinetic energy of a HGV under braking. We can use extremely small batteries, saving significant weight whilst requiring just 10% of the lithium to produce compared to a conventional BEV battery system.
Over the last 12 months, our team has grown considerably, not just in terms of headcount, but also in terms of operational capability, moving from pure R&D to a customer-focused product development pipeline, with many new projects already underway. Notably, we have just signed an MOU with Anand, the leading Indian Tier 1 manufacturer, to create a manufacturing joint venture for powertrain solutions for the Indian, ASEAN and SAARC markets.
We've also signed an agreement with Myra to jointly develop a 44-ton HGV research vehicle. We're also working with a leading manufacturer as their powertrain development partner on an exciting motorsport initiative.
And finally, we expect to announce agreement with a major OEM to develop a light commercial vehicle to which Viritech will contribute important technologies.
I'm Joe Ritblatt, Viritech's Director of Finance, responsible for finance, capital strategy and corporate development. Despite a challenging year for the industry, geopolitics placed hydrogen at the centre of energy security and the road to sustainable transportation.
This is shown by Viritech securing investment from 2 venture capital funds and over £2 million in UK grant funding.
We're witnessing a vital shift towards sustainable transportation, and we hope you'll be inspired to join us on our journey to become the leading developer of hydrogen powertrain solutions.
Next up, we have Kelda Showers. Kelda has pioneered innovative, high-efficiency water and energy-saving shower technology through the application of jet engine propulsion technology to deliver shower products that use half the water and energy and deliver superior shower performance.
Hi, my name is Richard White. I'm the CEO of Kelda Showers, and we have a fantastic opportunity for new investors. So we are pioneers of air-powered water-saving showers, which are very different from air-rated showers. We use positive air from a pump, and therefore you get far more impact than you do from an air-rated shower. So our aim is to help reduce water, the associated energy, and massively reduce carbon emissions from showering while enhancing the user's experience. We work very closely with Southampton University to develop the technology, which is all patented, and therefore the IP is protected. We work closely with the government, setting new standards in the UK, and all of our data is verified by the Energy Saving Trust, and you can see some of the other major companies that we work with. This is UK data, but I think it's probably pretty relevant for most of the developed world. And it shows that hot water accounts for about 36% of all household energy, and showering is responsible for about 50% of that. So in terms of total energy use of a household, showering accounts for about 18%, and we can reduce that by 50% with our technology.
How our technology works, as I mentioned, we have a powerful fan, and the water is injected into the airflow via the shower head, and that gives much larger droplets of water than you get from a standard shower, so much better cleaning ability. So we've been identified by UK GBC as a sustainable shower provider. We've got all of the approvals like RAS and water label. Our showers can run from as low as 5 litres a minute. So we're endorsed by the Energy Savings Trust. We now qualify for certain government grants under SALEX, and we work closely with BREEAM, the government authority. And as mentioned before, the technology we developed with Southampton University, but all the IP is owned by ourselves. So we believe we've got the world's most efficient shower, and it comes in 2 formats. On the right-hand side, stainless steel anti-vandal with a fixed head and a time flow button, so you can reduce or set how long the shower will run. And then we've developed that further into a domestic proposition and high-end gym proposition. So it's just gone into David Lloyd, for instance, which is probably one of the top leisure centres in the UK. It's an easy white glass panel, and you control temperature. You can also divert it to a hand shower. People will require a hand shower. We work, as I mentioned, very closely with the government, and we're currently undergoing SAT trials to set new standards in the UK industry. And what you can see from the data here is people don't need to spend as long in the shower versus national average when they use ours. They use less than 50% of the water, and the flow rate comes in just under 5 litres a minute versus a national average of 10. And then the surveys that we've done with the government, nearly all of the trialists gave us a 10 out of 10 rating, that they didn't need to spend any longer in the shower. It was easy to use. It rinsed out shampoo and conditioner very quickly. So we know we've got a great product. If you go onto our website, you'll see a number of case studies. So this is at the Queen Elizabeth Park Olympic Pool, where we've set it to save them 40% less water. And of the people that tried the shower, we had 100% acceptance and recommendation to roll it out across the entire Olympic Park. We've done work with student accommodation, and what this proved is we cut the water by 50%, but the students actually didn't spend any longer in the showers than they previously did. So we did 4 weeks before our technology, put our technology in, tested it again another 4 weeks. I say that's all on our website. And we work very closely, I say, both with the government, but with some of the big house builders. So Barratt's is the biggest single house builder in the UK. In their energy efficient zero carbon home, they've installed our showers. And what we've proven there is we take the entire house emission rate, so the lower dwelling emission rate, DER as they call it, by 10%. We'll set a new SAP standard. And for the average family of 4, we'll save £430 a year in water and energy charges. So for this initial technology, we've got major interest, obviously, from house builders, hotels, leisure centres, and in fact, yesterday the MOD came in. So all of the military side of the UK, so there's 50,000 homes and all their barracks, and they're about to start testing with us. And we also are now included in government grant schemes for decarbonisation and recycling. So great position for us. And then major water utility companies actually offer for every single house that our showers are included in discounts for connection fees of up to £350 per property. So another great endorsement. Then we've just launched a new technology, which we call Bubble Spa, which is intended to be a very relaxing, completely unique experience. So this is pure bubbles of air and water, nothing else. The bubbles burst onto the user, so you get a light massage effect. And with the lighting that we've put in, you get this visual appearance of bubbles that appear, some appear to be going up, some appear to be going down. So there's a kind of magical experience. If we had more time, we could click on the launch video and you could see it actually live working, so you physically see it. It comes in another options. So all of the technology to create the bubbles is actually in the shower head. So we can supply just a wall arm or a ceiling arm and connect that to an existing concealed system. So you don't need to change the whole system. You just literally change the shower head. All you need is an electrical connection. if you're doing a completely new install, then we can provide obviously the mixers as well. So they're all TMV2 approved, and you can have the option of a diverter to a handset. And then finally, if you prefer to have all of your technology and water surface mounted, we supply this where you can obviously then you get a tray where you can put your shampoo, conditioner, and anything else that maybe the ladies use in the shower. But it's a totally relaxing experience, and amazingly only uses 10 litres of water a minute. If you compare that to anything else that would claim to be a spa experience, they're running it 20 to 30 litres a minute. So again, we're saving more than 50% of water and energy. So this is our range. So on the left-hand side, predominantly used for gyms and leisure centres. The one in the middle, taking that technology but into a much smarter presentation, suitable for homes, hotels, and then the bubble spa range on the right-hand side. What is very interesting is we've presented this to many of the global branders, and we're in discussions to license this technology on a global basis. So not only will we have UK sales, we'll have royalties coming in from all over the world. And in terms of the investment, we're looking to raise £2 million for 25% share of the company. We've got a pipeline currently of 130 million with clients that we're fully engaged with. That actually went up yesterday when the MOD came in. You can add another 4 million a year to the pipeline with those. And then our base plan is actually to convert next year only 2.56% of that pipeline. And assuming that that pipeline will obviously grow, but these numbers on this chart show that that just is a constant pipeline. So in 3 years' time, we're saying, you know, even if we only convert that to just over 11%, we'll be into major profit. And my belief is for this technology, we should, on an exit value, get at least a multiple of 10, which would put the value of the company at around 49 million, or nearly 50 million. So with the 25 stake that we're offering, that would give you more than 6 times return on the 2 million investment. So hopefully you've enjoyed that. I would invite you all to go and look at our website. So all of the technical information, installation guides, case studies are there. And we believe this is a fantastic opportunity for investors. Thank you very much.
Right, next up we have ANGARA Global. ANGARA help industrial plants reduce their CO2 emissions and energy consumption with their suite of AI-powered technologies.
Hi, I'm Val Krivenko, Executive Chairman, Investor, and Co-founder of ANGARA Global. And here I would be pleased to present you probably the most pragmatic decarbonization solution, profitable solution of a gigaton scale. And in a nutshell, what we aim to achieve while generating enormous returns for our shareholders and investors, we want to trigger decarbonization revolution in the area of heat transfer efficiency and trigger industrial cleanliness revolution in a number of heavy industries that can result in 1 billion tons of CO2 abatement per year by 2030 and creation of a $50 billion market opportunity. And we already achieved quite good results. Here are a few of our highlights of our investment opportunity. So we have already product market fit confirmed. We have a de-risk technology validated as TRL 8.5 technology. We are a UK company, a UK technology company that owns all IP and assets, and we have offices in Amsterdam and in Bahrain, and we are already expanding globally. Currently, we're doing a $5 million round with a minimum $100,000 check to speed up deployment of our technology within already engaged clients. And for that, we need to hire more people. And that's the main use of the funds. So in a nutshell, what we do, we help industrial plants worldwide, like refineries, reduce their CO2 emissions and energy consumption through our AI-powered patented decarbonization technology. We already commercialized our solution in refining and petchem plants, and some of our clients you see here in front of you. And as we expand, we will be applying our technology to the biofuel segment, geothermal plants, desalination plants. In a nutshell, what we do, we improve the level of cleanliness of heat exchanger and equipment of our clients. That leads to improved efficiency, and that leads to reduced fuel consumption and improved product yields. For example, an average European refinery can reduce about 35% of their CO2 emissions, and they can enjoy about $100 million of fuel consumption reduction in terms of costs. 2/3 of that will be on a net basis. We already coined quite solid partnerships, like for example with JP Morgan, where we're part of their green economy banking platform. We're generating revenues, and our revenues started to grow steeply. And we are honored to be backed by very smart money people and as investors who have experience or currently working in Bank of America, Goldman Sachs, McKinsey, 3i, etc. And we also put money where our mouth is. The team invested $3.2 million out of $12 million that got invested in the company. Now, what we actually do. So we find that ugly fouling. That ugly fouling acts as an insulation layer in heat exchangers that prohibits efficient heat transfer, and that causes inefficiencies in a number of industries that account for $100 billion of annual losses. And collateral damage for the environment exceeds 1 billion tons of CO2 emissions per year. So those industries clean heat exchangers or remove fouling in a very old-fashioned way, like you see here on this slide. And such cleaning requires a lot of steps, and it takes a lot of time, and it's done during shutdowns of refineries. Our technology, which is already patented in the US and in Europe and in some other countries, the patents are pending, allows to remove fouling from heat exchangers super quickly, 5 to 7 times faster without disassembly. That allows cleaning anytime, whenever it makes economic sense. And the superiority of this technology has been confirmed by DNV, an international risk assurance and technical assessment organization, as well as its big impact and safety for equipment and environment. If we zoom in on a particular typical client in Europe, so as you see, our technology is the best solution for such a refinery decarbonization efforts. So we would bring savings instead of extra costs, like most other technologies, and we don't bring any risks, unlike other technologies. An average refinery would save about $100 million gross per year at full scale. 2/3 will be on a net basis for them, and 1/3 will be our revenues. And in a nutshell, what we do, we change the way how refineries keep heat exchangers clean. They clean them once per several years. Well, we can do it anytime in high frequency mode, so we can maintain cleanliness and efficiency with that. And in blue, the savings are highlighted. In terms of the business model, we digitalize our business model, and we act as a Uber for heat exchangers. So our client would be a refinery, for example, and we have software digital platform, AI powered, that enables to keep the heat exchangers clean, while we contract all the physical aspects of the job to be done out. So we have a very sophisticated and comprehensive toolbox of various solutions we can offer to a client. And we do engage a lot AI that helps us to generate smart schedules and smart recipes. And that would be a good example when what we do for clients. This is an example of just one heat exchanger where we saved $500,000 for a particular client on just one heat exchanger. In terms of competitors, we don't have direct competitors, at least at the moment. We have functional competitors, i.e. other companies who clean heat exchangers. But we are not about cleaning, we're about cleanliness maintenance. And we actually engage those participants, those players, to work with us together to create and expand this new market opportunity, which we expect to be to reach $50 billion by 2030 at scale, and another $100 billion will be the amount of money on an annual basis saved for our clients. We already patented our technology. We have 32 patents granted, and we have a lot of know-how to protect our margins. We have already achieved quite good recognition in the industry and with clients, and some of our clients you see on the right-hand side. The team is quite solid. For example, our CEO, before joining us, he was global head for oil and gas for a British company, Aggreko, where he had $400 million of P&L responsibility. We have two very reputable independent board directors who both invested in the company, like Panos Kavlakis and Jaap Kalpman. And in terms of advisors, for example, we have Oke Rolfsen, who used to be global head of McKinsey Oil and Gas for 7 years, and he's also our investor. Or Alex Saltika, for example, he, on the left-hand side, he was, before joining ANGARA, he was global head of sustainability and energy for JP Morgan. We're currently raising $5 million rounds, as I said before, to scale faster and become profitable within the next 18 months. And we're inviting you to join our opportunity, to join our company through a convertible note, and these are the terms, and I'll be happy to address your questions and see you on the Chris platform. Thank you very much.
Good afternoon, everyone. Hope you enjoyed that small lunch break. I know we've been back to back all morning, but I have the pleasure of inviting and welcoming our climate tech panel, A Greener Tomorrow, Climate Tech's Role in Sustainability. And I'll introduce Hau Kovseth, my very good friend working at Alma Capital, who will be moderating the session.
Thanks a lot, Hugo. There's been some interesting sessions today. I look forward to getting into this with everyone. I can't claim to be an expert at all, but I did spend about 1.5 years as a consultant in sustainable energy. And of course, tech was all the rage in 21, 22, and saw a lot of deals. So being on the M&A side, advising on those deals gave me a bit of an insight. And I'm very excited to get some more insights from the rest of the panelists. Also worth mentioning that we'll be kind of looking at this from a VC angle. I'm currently also working for a VC fund looking to invest in fashion technology, in particular enabling circularity. But more power to the panelists. Let's hear from you guys. Do you want to do quick intros? Perhaps Remy, you want to start?
Very well. Hello, everyone. My name is Remy Said. I'm a co-founder and managing partner of Partech Impact. Partech Impact, it's an impact fund positioned at growth stage, investing in impact-native technological companies which reach commercial maturity in their journey to scale up. Very happy to be here.
Cool. Craig, maybe you can jump in.
Sure. Afternoon, everyone. I'm Craig Douglas, one of the founding partners of World Fund, which is a 350 million climate tech venture fund investing in European technology companies with global applicability.
Cool. And I'm happy to follow. My name is Jörn. I'm a partner at Catapult. We're a climate tech VC and accelerator. So we invest and then we run an accelerator. It's meant for seed companies. So that's what we do. Done that since 2017 and have 146 companies in our portfolio so far. So we're reasonably active.
Very nice. Very nice. That's important. And we got a bit of info there on the kind of stages you guys invest in. If you could also please elaborate a bit on the verticals that you prefer. I mean, we all have, our preferences, and perhaps a bit on the technologies as well that you invest in. That'd be great. So maybe we could just do a quick round so, we
Yep.
the land.
So we are a 300 million euro fund size. We invest in technological companies, but this technology can be either digital or industrial. What is important for us is that the company are one, impact native, two, that this technology is very strong and synonym of barrier to entry, IP protected and hence high margins, and three, that they reach commercial maturity. We want to see revenues from customers, and we want to see this R&D or technological risk behind the company when we invest. So we invest at Series B onwards, equity tickets between 15 and 40 million euros. And we invest mainly on the sustainability side on topics related to decarbonation, energy, circular economy, food and agri-tech, mobility, and construction.
Cool. Very clear. Let's just keep the same structure from before, and Craig, you can jump in.
Sure. In terms of what we look at, we look at everything through the lens of CO2. So we look across all the major CO2 emitting sectors. And the way that we view the world is always with regards to CO2 reduction potential, climate performance potential. So what we define as. So we look at what the potential of each company is that we invest in out to 2040. And that needs to be a very high number, typically over 100 megatons per year for us to be interested in investing. And what that means in practice is we invest across all the major CO2 emitting sectors. That normally falls into two buckets. One is food, agriculture, and land use on one side, and energy on the other. And within energy, it's transportation, built environment, industry, and the transition itself. In terms of kind of the technology side of things, we actually don't care whether it's a business model innovation or a deep tech company or a software business. What we care about is CO2 reduction potential and what the real additionality of those companies are. So when we look at companies, we look at it in terms of what that company is going to need in order to be hugely successful. Obviously, in terms of capital and how you grow a software business is different to how you deploy a hardware business. but we look at everything initially from the lens of CO2. In terms of the stages of companies, we typically invest seed to Series B. Initial ticket size is kind of 1 to 15 million. But where we step in, and why we were one of the larger funds, is we have the opportunity to invest a lot more capital going forward. So into kind of Remy's world. So we'll start getting early, 1 to 15, but we can invest 20, 30, 40 million in the winners in the portfolio company. So we're happy to get in a bit earlier than Remy, and then happy to work with him when our companies get a bit bigger. And I know we know Catapult very well as well. So we've looked at a few companies of theirs already.
Yeah, we come in at the I mean, for these folks it's basically baby time. But pre-seed and seed is our domain, right? So we look for companies where it's just at the beginning. Typically you have 5 to 10 people maybe in the company, just started generating some revenues. So we don't take too many chances on whether the founders are able to build. What we take chances on is basically their ability to execute, to see if this really goes big. But we have to see some sort of sign that they're able to build. I think that's the big before and after qualifier for that matter. And that typically qualifies us as the seed investor. So typically when a company raises €1 million or something, we're happy to go and take 200-300K off of that round. So we co-invest with others. That's our specialty. I like the way Craig puts it in mapping our investment domains to CO2. CO2 is a pretty good proxy for climate action, and also it happens to be really investable domains. Like if you invest with that as a lens, you get to invest in energy and transportation, cities, obviously the built environment, food and agri, enabling technologies, really anything that can give you measurable potential climate action, and also venture scale returns. Those two things are what we optimize for. And so since we don't run a science lab for any of the companies or anything like that, we don't claim to be experts in the specific domains. That's their job, but we're experts in figuring out how and if the business can work. That's our thing.
Cool. Well, I'm glad to see there's a significant amount of overlap here and even collaboration, both in the past and the future. I guess it's a bit of an antithesis to the Silicon Valley model, where you have your actually someone told me last week that there was a founder coming to town to meet one of the big the value firms, and the partner of the firm made sure that the founder was in an Uber to their facility with them at all times, and then in an Uber back to the airport without meeting anyone else, because there's no deal flow sharing, none of that. So
I think it's super important to share opportunities, and also we know that the companies that we help back, they will need a lot of capital, and also everyone relies on the ecosystem to work, so that the level of maturity rises in corporates that are going to buy these services, for instance. But they need to understand how to deal with startups in general, not just our startup, and so it actually helps tides race all.
Yeah, exactly.
I agree. I would say that it's a space, climate tech investments, where there is a lot of collaboration between funds. We have discussions regularly with World Fund, with Catapult, and with many others. The objective is really to support this ecosystem to grow, and that's very important. And we know that it's needed by the companies, it's needed by the people. And I think we know how complementary we can be to each other, and it's a space where collaboration is quite key, actually.
And would you say this is the case among the founders as well, or is that a bit more competitive, given that these days a lot of people are looking for funding rather? Do you think this is something that they've adopted as well?
Yes and no. I mean, most founders know one another in sectors. Right. So, when I'm chatting with one founder, it's like, oh yeah, of course, I spoke to those people, like our competitors, a couple of weeks ago. So there's definitely competition, but there's also collaboration in terms of, how you actually change an industry, or on the policy side of things, because, where people are all clubbing together to actually fundamentally change how a market or how an industry works. And that, is a clear area of collaboration. Of course, they're going to be competing for customers at some point, but it's less, I suppose, slightly less cutthroat in most of the industries at the moment. But it's clear that there's still a lot of things that people need to collaborate on together to actually make the whole business environment more attractive in the climate tech space. So there's still a lot of collaboration between companies, whilst people still keep their cards close to their chest in terms of what their strategies are, what their benefits are. But there's still a clear way that people work together at the moment. The same in the VC community, right? We're still not as well capitalized as the US, particularly in the climate tech space. So, for us to make the market winners, there needs to be a lot of capital around the table. And at the moment, Remy and I are kind of the 300 million mark. We're some of the larger funds in Europe, which is ridiculous. Like there's 40 plus funds of our size or bigger in the US. Like we know that we have to work together to really make these companies the market winners. And that takes capital, as Joran's already said.
Yeah, exactly. And I think it's worth mentioning that actors like the VCs and in fact platforms like Wholesale Investor are in quite a privileged position where we can actually connect these founders together and keep an eye out for, actually maybe they fit within the same model, but slightly as a further upstream in the ecosystem, or they have data that they might need, and then being generous with putting those kind of people together, I think is really important.
Yeah, peer learning works. It just works, right? Why does that work during an accelerator program, for instance? Well, it's because you have so many things in common when you're building a startup. Things that don't connect to the product you're building, but to everything else. But that is true for VCs as well. There is a lot of value in sharing. If not giving each other tips, then just packing each other on the way. We're incentivized to say that everything is going great all the time, because that's how it has to be. Same in the startup, right? So just to be in a room with other people who knows that it's okay, even to stop saying that for a tiny short bit, that helps.
Yeah, we can give a concrete example there, right? We've had a lot of discussions with all the regulators in Germany on becoming a climate fund, an Article 9 fund, and we've done a lot of the heavy lifting and spent a lot of money doing it. As a result, everyone else who's now trying to do similar things in Germany has a lot easier ride, and we're happy to share that experience. Because if we don't, then other people are just going to waste money and time doing things other than actually investing. And that's not in anybody's best interest.
And you'll get some angry climate consultants knocking on your door now saying, Greg.
I wish that there were people who would actually be able to do it for us. Unfortunately, we haven't found any yet.
Yeah. No, it's a difficult spot. But all credits to you for doing Article 9, though. That's really important. And I guess here in the Europe, we are actually, one of the things that we have, even though we're less well capitalized, is the governmental support and being able to bring them in to a larger extent as a stakeholder in these discussions as well, which is really important. And on that note, we might as well discuss the geography here a bit, because I mean, this is, the big question, right? I mean, will it be the huge markets of the East and maybe Africa? Will it be the best regulation in Europe, or will it be, the money and the capital that's current in America that will drive the sector forward? Do you guys have any intuitions on where we might go from here in terms of geographies?
Yeah, so I have a strong belief that Europe is going to lead the climate tech space in the next couple of decades. And Europe is definitely to be quite hot. And the reason for that is, one, you have regulations that you mentioned that are pushing for demand. And that's, I would say, the main difference versus 10 to 20 years ago. Climate tech has demand in front of them, also pushed by regulation. If I take some of the themes we mentioned a little bit earlier, in Europe, 50% of pesticides are going to be in the agri space are going to be forbidden by 2030. You have an obligation to report your carbon emissions, 1st of January 2024. You have plastic recycling that becomes mandatory 1st of January 2025, etc., etc. So these regulations are creating demand for companies. Number one. Number two, there is public funding that is supporting this trend and that is emphasizing these companies to emerge. And number three, we talked a lot about IR Act in the US, etc., etc. Well, actually, there is a certain number of companies in Europe that are developing quite unique technologies that are global actually, and that can address a global market. And hence, not only they will benefit from their strong regulation, their strong demand in their home countries, but they are also able to expand to a certain number of other countries, namely the US, and benefit also from a certain number of other schemes in place in these countries. So in a sense, if I had to bet, I would say that Europe is probably lag behind on the technological side versus the US. But if you look at climate and climate tech in general, in the next 20 years, it's a very hot space where we believe there will be a lot of very strong technologies that will emerge and become global technologies.
I think on the regulatory side, it's obviously there is a huge push in our entire region, right? And corporates are faced with much stricter demands and push and pull effects here than in other regions. But I also wonder if is there something about the over-regulatedness of our space to stifle certain parts of innovation? I don't think I'm shocking anyone by saying that the European startup world didn't think of GDPR as a aphrodisiac, right? It didn't unleash 1,000 new startups. Maybe it was good for a few people. I don't know if it's meant to. I mean, if it's a criticism or not. It's just an observation that in many other regions, you don't waste your time with GDPR because there are other issues at hand. So I don't know, maybe you can do both. But I guess if there's one thing to be afraid of, it's that the regulatory nature of our society means also that innovation is going slow. The fear is too slow to address some of these challenges. That can be unlocked in other geographies where there is, for better or worse, a lack of control on those elements.
If I can maybe give a bit of a counter opinion a little bit. We have technology. Like Europe doesn't have an issue with tech. We have just under a third of the world's patents in climate tech comes out of Europe. We have a third of the world's research institutions in climate tech in Europe. We have more startups in the climate tech space. Example, energy and batteries, last 3 years, more startups founded in Europe than the US and China combined, right? Like we're really good at the early phase, and then we're really bad at growth, right?
Yeah, no new huge companies are coming.
Yeah, it can be over-regulation. It can be, it can be a hesitancy of people to deploy both capital and new technologies at scale. And this is where, the example of the IRA actually has some big advantages because you can actually scale up quickly because it's a very transparent, it's a very transparent regulation. It's very transparent incentives. And same is true in certain parts of Asia. When people actually want to deploy tech, they go from doing nothing about it to deploying it in every factory in a matter of years. Right, so we have an issue, I think, in Europe and the rate at which we scale, not in our technological innovation. And I think that's kind of the biggest barrier that we face in Europe. So in terms of where we think technologies can come from, I think a lot of great tech will come from Europe. The question is, for me, is whether we can scale it up in time to become the global technology leaders. Like that's kind of the biggest question mark I have. And one of the things that, it's the whole reason World Fund exists is about how do you scale up technologies to be globally applicable, and that's kind of the biggest challenge. And we have a potential to not be able to do that in time, and that would be an exceptional shame and exceptional waste because of all the technological advantages and regulatory advantages that we have. We need the capital and scalability to go with that.
Yeah, this is
fully aligned, and I think it's the point from Craig a little bit earlier on the fact that Partech Impact or World Fund are one of the few sizable impact funds in Europe, and we see this funding gap at scale up phase very clearly is one of the issues, and we are trying to address that. Our objective also on the Partech Impact side is to take companies and bring them to global niche technological leaders. That's our objective. But very clearly, the scale-up phase is where there is a certain gap, and where there is a room for improvement in Europe.
Yeah, that is the challenge. The issue is how many new huge tech companies out of Europe can you think of? Well, there are a few. The green giant from Sweden, but like there aren't that many. It's disappointing. You'll find a few B2B SaaS stories here and there, but like SAP is our is our tech giant. It's kind of yeah, it leaves something to be desired. So that's where the next wave needs to come in generating huge businesses, hoping that the IPO market opens up, that we can channel more public money towards this as well.
And this is something that's actively recognized at the European level as well. The new ETCI, European Tech Champions Initiative, which is a couple of billion fund put together by a bunch of governments for looking for climate related technologies, and funds that need to be $1 billion plus. But to put that in context, no German fund currently qualifies to have access to that money because there are no funds big enough. A couple in France, but basically, we're missing part of this ecosystem, and it's that scale up. If you look at the climate tech and general tech ecosystem, if you want to raise a Series C plus, 50% of that has to come from, at least 50% of that has to come from outside of Europe. And I'm including the UK in that. If you exclude the UK as well, it's over 70% of the capital in Series C plus runs comes from outside of Europe into European companies, right? Kind of shows you where the biggest gaps are, right? In terms of how we're going to be able to scale these companies.
Yeah.
So yeah, I think what we can all agree on here is that it's actually a matter of capital, or too little capital rather than too little technology and innovation. Even though the latter might not be perfect either, it's maybe a call to LPs to write some checks for European venture capital, because I think if there's a great company in Europe looking to get a Series C done or an IPO, an American fund will come in and fund that. So the question is whether we can actually create that into a self-sustaining industry, making founders actually want to start that company in the first place. And I think that's the challenge to regulators, to LPs, for us VCs to actually do a good enough job to warrant that. But it does really come from the capital, in my opinion.
And build up more of a mythology, I guess, around risk taking and entrepreneurship and everything. So it's true that we have a lot of early stage companies, but it's not part of the culture in the same way. You could take one out of many examples. You mentioned the LP side. In the US, there is a deep tradition for university funds, for college endowments to be actively investing in venture. That's frustratingly rare in Europe. And I think it's a shame. It's obviously one of the best ways of doing actual tech transfer, right? You make sure that the best founders go and just start startups, and that's how you expand your brand, and you get to reinvest in your best students, and they get to be part of your alumni, and it's a virtuous cycle. And across many parts of our society, we need for more people to understand the importance of risk taking and entrepreneurship at every stage to be able to build the next big tax generating companies. That's if there's one thing we need in Europe, it's companies generating a lot of tax income, so we can afford to run this system. We need the new ones.
Absolutely. I think that's
interesting in terms of ambition, right? A lot of European companies tend to be more cautious. And it's also in the venture community. If you look at the failure rates in startups in Europe versus failure rates in startups in the US, I think in the US it's about 60% end up, 1x or less. In Europe, it's about 40%. Right? That's good in terms of, you're reducing your downside, but what that actually means is you've got fewer unicorns. Right?
Yeah, you're capping your upside, and our business is power law driven. So
interesting that sort of sentiment is beginning to change, particularly as a lot of the original tech entrepreneurs are moving into the venture sphere. One of the things, we have a large number of tech entrepreneurs and climate tech entrepreneurs as our investors in the fund, and it's interesting to see more and more of them are just no, my next startup is going to be in the climate tech space. And they are the aggressive founders in terms of we're all about growth. And the combination of that with some great engineers and some great tech I think has some really good promise for being more aggressive and being more for the hyper growth stage companies.
And unfortunately, what we're seeing right now, of course, is that VC fundraising has dropped significantly following SBB, following everything else, and the general economic climate. So I just want to take it a little bit back to the macro stage, because I think we can all agree that every dollar spent now is worth a lot more, right? Because a lot of valuations are down. There's more need for it than ever. We're essentially at an inflection point in climate tech, right? But how is actually the climate tech sector performing relative to other sectors? If you guys have any insights on that.
So yeah, we just had our AGM. We just had our AGM yesterday. So I've actually gone through all these numbers in a lot of detail in the last week. So interestingly, Q2 was actually up significantly on Q1 and Q4 last year. So actually in the climate tech space, investments are recovering quite nicely. More Series B, more Series A, average ticket sizes in both those rounds going up as well. Still nowhere near what we were in late 2021, 2022, but still back to above the historic averages pre that level, which is nice in terms of there's some significant changes there. What we have seen, or what we've seen certainly, is if you want to raise a Series B, you have to do it on the numbers. You can't do this on promise. You can't do this on potential. You have to do it on actual revenue. And that's still very much the case. And we've seen some companies that raised really big Series A's or decent sized Series B 18 months ago, coming back with valuations half of what they were then. But
that's a very
significantly further ahead, but just the market's kind of re-equalized. Bjorn, you maybe got some more insights on this as well.
Well, just in sheer volume, we see a lot of deals since we invest in a lot of companies at the early stage. But one thing we notice is that founders who go for ambitious valuations right now, and the ones who did it last year, are faced with that 12 to 18 months down the line. It's a very, very basic observation, but it's true, and I think most people will recognize it. If you go for that super ambitious valuation and you don't hit every mark, you're going to need to go through a painful negotiation next time. So it will be corrected. That sends me towards the viewpoint that take the valuation that makes sense for the investors that you meet, and don't go too hard on that, because you will need to raise again. And fighting a valuation that is too ambitious, that applies even if you're at seed or if you're at Series A or Series B, that will stifle your ability to recruit talent and also to keep optimism there and to do everything. It gets really, really hard. So much better to accept that valuations are a bit compressed and that the market is prioritizing well, I don't know if you want to call it more healthy growth, but at least a different growth pace than we priced in 2-3 years ago. Well, get used to that, and then you'll be fine. The problem is for the founders who aren't adjusting to the market. At some point, the market will adjust to them.
Yeah, maybe a few comments. One, there are data that shows that climate tech investments in the last 4 to 5 years had a premium in terms of returns compared to standard investment in the private equity space, from 3 to 5 points of IRR. So, and I think this trend is going to continue and to increase. Second, timing is now for investment. I truly believe that valuation are getting down, though I would say that very strong climate tech companies may have a slight price premium, but this price premium, you will find it at exit, quite certainly. And number three, to what Jörn and Craig just said, I think the companies that raised at crazy valuations a couple of years ago are struggling a little bit more now that they are coming back to ask for money. And we see more and more companies that are either waiting and trying to just wait for better days, or just accepting a lower valuation, thinking about the fact that it will make easier their next fundraising. And that's also what we see, and that's also what contributes to the fact that in the next couple of years, I think there will be a very strong number of opportunities on that space to make very interesting returns, while having a lot of impact.
Yeah, eyes on the prize. That's the thing. You have to raise another round probably, and if you don't take that whole picture in, you're optimizing only for whatever is in front of you right now. Well, I think that's a losing strategy because it will wear out the other people in your company as well. That's the problem, right? If you got a cap table that isn't investable anymore, well, then it comes to a full stop, even if you're promising.
Maybe the biggest sector that's kind of taken that hit is food, right? That's where we've seen kind of the biggest compression in valuations. I mean, fortunately for us, our portfolio companies in that space have actually performed very, very well. So, with regards to next round of fundraising, we're kind of very happy with where they are, and there'll definitely be upticks in valuation from their side. But maybe give a real example. Startup came from us 6 months ago asking for 100 million pre-money valuation, and we're just like, we think you're worth pretty much half of that. Come back if you think if you want to have a chat. And they went away for 3 months fundraising and then came back to us, and they're like, okay, now we're back at a more sensible number, and they ended up closing just above what we originally were talking about. We didn't do the deal in the end, but kind of an idea of I think the people around the table here are sensible about where the next, where's the next value inflection point for a startup? Because if you're not going to make that with this fundraising, then you're not going to be raising at a new valuation. So where is this capital going to take you? Where's the next value inflection point? And make sure you have the capital plus a bit more to be able to show that growth during that time
to understand period. The tranche financing nature of our business, right? Which means that you have to complete the tranche to be able to unlock the next financing. There is no next financing if you haven't made any improvements. Then you're just in a world of pain. Also, unlike some previous cycles, but this is where we get to learn. I've been told by older investor friends of mine. So.
Yeah, and that's a very good point. Yeah, and I mean, it is kind of baked into the VC game that there's going to be a lot of hardship and a lot of challenges. But since the last year has been exceptional on really all levels of investment, have any of you guys made any kind of strategic changes, any pivots in relation to this? Or have you kind of kept going as business as usual, of course, with slightly lower valuations, etc.?
We haven't really changed much. We're pretty aggressive. Well, not aggressive. We're pretty transparent in terms of how we value businesses. So even during the times when there was a lot of cash going into the companies, we were very strict about what we'd invest in and what we wouldn't invest in when it comes to valuations. So it hasn't really fundamentally changed how we've approached things. Interestingly, maybe the best companies, there's still competition. Right. So the best companies can still get a premium, but it's not a 3x premium. It's a 1.2, 1.3x premium on their competitors. It's not a, it's not a 3-4x. There's not people just randomly throwing money into the sector saying, oh, this sector looks interesting. Here, have some money. Those days have gone.
Yeah, the tourists are gone, and I guess that's totally fine.
We are same on our side, so we didn't change our strategy. We are disciplined investors. So we look at valuation with the exit eye in our eyes. So given we are at later stage, we want to be seen as potentially the last investor before having a company that is self-sustained from a cash flow standpoint. So we look at companies from an exit eye, and we say, okay, I'm building a company that is 100 million euro sales, EBITDA profitable, cash profitable. What is the real value of this company for 5 years from now? And we retro-engineer the valuation that we believe is the right valuation for this company at entry. And sometimes, as Craig said, there is competition, and we are a little bit below, and that's fine. We want to stay disciplined. And sometimes, we are the preferred partner of the CEO and / entrepreneur, and we continue to work with them towards a valuation that makes sense for everyone around the table, and that is very attractive for us.
I'll add one thing that we've noticed, and this I think applies much more to the early stages where we are, and that's just the sheer speed of execution in the teams. This has always been an important factor in assessing startups, but I think for a few obvious structural reasons, it's accelerating right now. That's just to the sheer level of tools available at your disposal. If your 5-person software team is not utilizing software tools to make you quicker, well, your competitors are, and so if you have a software heavy solution, you just I mean that is part of how quickly you're able to execute and get to the next level. So even more value is placed on small nimble teams that are able to move fast, at the cost of those teams that are twice as large but have sort of been fumbling around for a year or two extra. We take even more value in that.
Your strategy and our strategy, we're at different stages, but very similar in terms of we look at everything through, very similar in terms of we look through things from where's the CO2 reduction potential, right? And it's a really nice lens to look through because you're actually solving a fundamental problem in a sector, right? So one of the nice things about using that as a lens, doesn't matter if it's a downturn, it doesn't matter if there's, things are slowing down, you're fundamentally solving a problem for an industry.
Yep.
Or for a sector. So, regardless, you should be able to continue to grow. And, when the companies, actually show those numbers, you're going to be able to get a good exit. Yep. So fundamentally, if you're changing and modifying an entire industry, you're actually solving a fundamental problem that they either have or going to have. And that, it very much comes to decarbonization. Remy, your point earlier on, regulation as well. These people have these problems. And if you focus on the companies that are actually solving those, then it kind of doesn't really matter what the market sentiment is. You're always going to be able to build a good business out of it, and that's kind of a really nice situation to be in. You can afford to wait, particularly Remy, when you're in your sort of stages and you're in a profitable business. You can wait until the market turns good, and that should be the direction that everybody's going for. But scaling companies aggressively is also expensive. It does take capital to grow.
Yeah, but it's very well aligned with, of course, the grander problem, which is the extreme carbon emissions that we're seeing, which is the very baseline of that, and then it's also at a high level also connected to the regulation that we're seeing is typically also focused around the CO2, so it makes a lot of sense. But just as a quick antithesis to that as well, I think Remy, you mentioned enabling technologies as well. I mean, that's often going to be harder to measure or directly gauge what the impact of enabling technologies will be. I mean, I spoke to a large impact investment fund in the US 2-3 weeks ago, and they said that they're actually, for example, recently looking into grid security, cyber security, and they're an Article 9 fund, and typically you wouldn't think that that's the kind of thing that they would be looking at, but of course it's essential to the transformation at large. So do you have any examples of enabling technologies or ancillary stuff that you guys could look at as well?
Yes, so just as an intro, the way we think about impact quantification on our side is to pick one KPI by company that is linked to the business model of the company. And this KPI can be very different from a company to another. So our first investment is an enabler. What they do is they verify and certify carbon reduction projects. They bring credibility to climate data, either for project developers or for corporates. In that case, the KPI we picked to measure the impact is the tons of CO2 reduced that the company verified. And the more you're going to verify claims that are claimed by corporates in their net zero journey, the more credibility you will bring to climate data, the better the space will be. And even if it's an enabler, it's a very strong enabler to the climate challenge we have. And I have several other examples, of course.
I just want to point out that we have about 5 minutes left, and I'd love to hear more about your actual portfolio investment and get some examples here. So maybe we can just go around the table quickly, and if you have 1 or 2 minutes to tell us about one or more companies that you guys are excited about at the moment, then I'd be very interested to hear that. Craig, you want to go first?
Yeah, I mean, I love the portfolio that we've built. You know, I've done it across all the major sectors, everything from deep tech to software. So, you know, my favorite company at the moment, a company called Scilab, which is in battery recycling, capable of, you know, recycling 85 to 95% of a battery by mass, which basically just isn't done today. Which, from our perspective, is particularly in Europe, is strategically important. At the moment, we're importing all of these batteries, and then typically we're either shipping them off to Canada or shipping them back to China for recycling. So really like that company at the moment because, you know, today the best in class tech can recycle maybe 60% of the battery. They're capable of doing 85 to 95%. And that fundamentally changes things, and not just like technically capable of doing it, it's economical to do it. And that's kind of one of the biggest added values that you can do. And legislation has just come out that's pushing, you know, a minimum kind of 60%. But if they can prove 85%, then the legislation will follow what's technically possible and commercially possible. So really like that company. They're doing really well, building their first facility in Germany at the moment. So one example from the portfolio company, but one of my favorites.
Very cool. Super important. Jan, you want to follow up?
Yeah, I guess let me just quickly name one from the most recent portfolio. It's an English company called Materials Nexus. So they do quantum computing based materials discovery. The thing is that we need a lot of innovation in how we use materials to reduce the material usage and also change up our rare earth minerals usage. It impacts a whole swath of industries. It will have both a direct and indirect impact if and when it works. And they just raised a round, brought on some new investors that will help them on board that, and I think that's a magical journey. So let's get smarter materials and better combinations right now.
Yeah, very
Jan, must be hard to pick out of 400 companies. On my side, it will be easier. We are a young fund. We are currently fundraising, and we did our first investment in this company that I just mentioned, which is SustainCert. Very happy of this amazing investment, and we are investigating our next one, and hope to be able to do that very short term.
Cool. And what are you looking towards now? I mean, what sectors, technologies?
So look, there are 3-4 sectors we are currently deep diving on and that we like. There is the irrigation challenge that we see in the agri space is something that is very challenging, and it's a space we like. The grid and battery that Craig just mentioned is a space where we believe there is a lot of potential and very strong companies that we hope we could scale up and take to the next level. There is the biodiversity, which started to emerge 3-4 years ago. It was still nascent and much more at earlier stage. There are a certain number of companies that start to be a little bit more mature and very interesting in that space, just to name a few.
Cool. I think we just about have time to hear the other two perspectives as well on where your sights are set for the future. Great.
All right, still on mute. Yeah, so we're a thesis-driven investor, right? So we look at sectors individually and kind of build our own sector theses on the back of this, and then speak to all the companies that are active and figure out if there's one that we like. So we do this on a continual basis. We always have close to half a dozen of these sort of things going on at any given time. One of the advantages of having a reasonable sized team. So at the moment, looking at a couple of spaces, some things in the alternative proteins space, component B2B ingredient supplies for large-scale alternative proteins. Some things in direct air capture, whether that's enhanced weathering or technical solutions or added additions into agriculture. So quite a few things on that space. But there's always those are two. Again, we've got another 4 going on, and we've just completed 3 other ones. So difficult to say exactly which one, but lots of it at any given time.
Yeah, I'm sure. Jan, quickly from your side.
I think energy is the biggest sector that we're looking for. The rationale for that is quite simple. If you solve green energy, you can solve everything else. If you don't solve that, nothing else matters. So you need to be quite clear on that. Built environment is very important for us. Also, transportation. It may not look like it from the vantage point you see me right now, but I am obsessed about reducing car dependency across the world. I think that's one of the most overlooked categories to reduce CO2 emissions directly, but indirectly, actually, more so than directly. And that's why we need to do it right now. So we're looking at mobility from an urban lens.
Very cool. Thanks for that, and thanks to everyone. I mean, Hugo, I think we've just made it on time.
You're very good. That was very insightful.
Yeah, what a panel. Thanks to everyone. This was super interesting, even just to look from a moderator's perspective. A lot of cool stuff was mentioned. So thanks for that. And
yeah, I only wish you guys had 2 hours, but unfortunately we have to move forward. So yeah, no, appreciate all of your inputs today. Thank you, Hal, for moderating. Thank you, Remy, Craig, Jorn. It's been a pleasure.
Thank you very much.
Cheers, guys. Have a good weekend.
Right, next up we have Balfour Capital Group. Balfour Capital Group confidently manage over $250 million in assets. When you entrust your fiscal voyage to them, you gain access to a world transformed in your investment domain.
Hello, my name is Steve Elaine Lawrence. I'm the Chief Investment Officer of Balfour Capital Group. It's the 4th of July, and it's an absolutely great privilege for me to actually present, all right, to this esteemed crowd that's on this venture capital virtual meeting, okay? As a hedge fund specializing in algorithmic trading and mathematical strategies, we really try to keep it really simple. And one thing we always say to customers, the most important aspect of any investment strategy, it's never how much money you can make, it's always how much money you can lose. That's number one, okay? I'm going to be able to actually delineate for you who we are, what we do, okay? But more importantly, the ultimate goal is just that you pick up the phone and set up a meeting with myself and my team, because numbers don't lie, people do. Our rate of return is our rate of return, okay? It's within the documents. I'm just going to go back and just give you a brief synopsis of how I started in the industry. You know, and when I reflect back on how I got involved, you know, I've been in this business since 1989, all right? And that's, you know, I'm an old timer, okay? I've done really well for myself. I currently manage $250 million with operations all over the world. And what I can tell you is I'll never forget how I started in the industry. I started as a runner, okay? You know, when I graduated university, there were no jobs, okay? I mean, we just got out of a major stock market crash. And I started taking a piece of paper from one end of the floor to the other end of the floor. I couldn't even understand the language that they were actually talking on the floor. It was all hand signals. It's the genesis of electronic trading. And it wasn't like I was at the mountain first. Absolutely not. What I was able to learn through my years of doing business is that it's truly about evolving with the business, not only from a customer point of view, but as an intellectual point of view. You need to understand that to be successful and to have a successful institution, it's about the people. And what I was always able to recognize is finding talent, all right? is finding great people to work with, because it's never a one-man show. There's not a great company out there, okay, that someone's alone. And what you're going to see, I've been able to find the right people to work with by having great client support, the best in the business, by having, I would rather work with someone who is hungry, okay, and ambitious than someone who's come from Harvard. And granted, you know, I've worked with some of the best people in the world, and I can actually say that, you know, I've covered some of the best people in the world. All right. And I'd rather take a young businessman who has ambition, all right, and who has discipline. I'm the type of investor and hedge fund that I swim next to the shark, making sure I don't get eaten by the shark. Okay. So we all have our play. There's a big difference between managing $250 million with 100-to-1 leverage as opposed to managing 10 billion. Okay. And we found a sweet spot. Okay. And that sweet spot is people, execution, results, and global markets. And we understand that. And our technology is world-class, but more importantly, our people are the best, in my opinion. And what I'd like to be able to do is something very simple. You can look at the presentation. Past performance is never indicative of future results. Period, end of story. It's what can I do for you today, right now, because the market is strictly about time and understanding price action and understanding how you can hold positions all over the world and be diversified. And I think that's something that the firm can bring to the table, execute, but more importantly, okay, by setting up an appointment and just giving us the time that you need. It's not going to cost you anything to listen to an idea. But one thing I do know is that to earn someone's confidence, you can do that by one transaction. But to gain someone's trust is a series of investment strategies. And that I can definitively tell you Balfour Capital can do for you. So once again, my name is Steve Elaine Lawrence. Please reach out to Dalit Chong, who put this incredible situation together. And like I said, I'm honored to even make a presentation like this. So reach out to us. Love to speak to you and connect you to the right people to show you that you can make money with a real serious institution. Well, I thank you and have a great, incredible holiday and enjoy the balance of your day.
Now we have William George Auction. William George offer a unique suite of circular economy solutions for top-tier retailers.
Hi everyone, I'm Jake and I'm proud to introduce you to WilliamGeorge.com. I was hoping to talk to you about our vision today, but as you can see, in my relentless pursuit of success, I've managed to impair my vision temporarily by diving headfirst from my bike. Nevertheless, over the last 3 years, we have generated £3 million in revenue, selling in excess of £12 million worth of returned and excess inventory on WilliamGeorge.com for some of the UK's top tier retailers, including John Lewis, Boots, Primark, Giacomo, and others. We've reinvested profits into building our own bespoke API-led tech platform, which drives efficiency for our team and for our clients by converting retailer inventory into live auction catalogues in a matter of minutes. It brings transparency to the process for sellers and buyers of retail returns, as well as handling inbound and outbound payments, scheduling, and communications. It's a solid foundation for lean scaling in support of our aggressive growth strategy. During the course of this development, and building on our team's decades worth of industry and transformational leadership experience, we have become intrinsically familiar with both the pain points and the ambitions of our retail clients. Rent, reuse, recycle. These are areas in which any retailer has got to be more aggressive and more assertive in. These are the words of Sharon White, chairman of our client, John Lewis, outlining their commitment to sustainable initiatives, and in particular, introducing a buyback scheme for all product categories by 2025. We're now open to external equity investment to accelerate our journey towards becoming the trusted partner for retailers in secondary market solutions. We're seeking £500,000 to expand our tech portfolio to include the aforementioned buyback schemes, enabling consumers to sell products back to their favoured retailers in exchange for credit. Branded peer-to-peer resale platforms, enabling consumers to buy and sell pre-owned and second life products with each other under the trusted umbrella of their favourite brands. And staff sale portals, enabling retailers to sell non-retailable and discounted products direct to staff. These products bring a whole host of critical benefits to our clients, including higher, more diversified revenue streams, brand protection, improved sustainability, efficiency drivers, releasing space and resources that can be reallocated towards higher margin primary sales channels, repair, refurbishment, and recycling services, currently unavailable data and analytics on second life products, consumer behaviors and aspirations, enabling strategic decision making. And finally, cheaper customer acquisition, retention, and engagement with new generations of increasingly discerning consumers. Timing is everything, with 70% of Gen Z consumers only buying from brands who align with their values. Funds will also be directed towards building out a high-performance team to acquire and service top-tier retail clients, with high-quality industry professionals already profiled and identified. We know the competitive landscape and the threats to our success, and we know how to navigate them with capital efficiency centre of mind. By assimilating our comprehensive suite of solutions, we put ourselves in prime position to corner the £145 billion per year and growing market opportunity. With our USP of allowing retailers to use WilliamGeorge.com as their single supplier for all circular economy solutions. We're excited for you to join us on this journey towards our vision of smashing the secondary market bottleneck and recycling it into a truly circular model. Contact us today to find out how you can be part of transforming the behind-the-scenes processes of retail into a celebrated and sustainable success story. Thank you.
Now we have EpiAxis Therapeutics. EpiAxis Therapeutics is a leading epigenetics company with a focus on developing novel cancer treatments and preventing recurrence.
Good afternoon, or good morning. My name is Jeremy Crisp, and I'm the founding CEO of EpiAxis Therapeutics. And it's my pleasure on behalf of the team to present today. I'm going to talk about epiresotide. And this is a novel epigenetic therapy to overcome treatment resistance and to prevent cancer recurrence. Allow me first to give some overview on EpiAxis. From a corporate perspective, we're established in 2015 out of a Canberra-based academic institution, and we've remained private ever since. We're using epigenetics to control and modulate cancer. We're at the preclinical stage, with epiresotide being our lead LSD1 candidate, and this is a first-in-class asset. It is non-catalytic in its action, and it's nucleus-specific. It allows us to program cancer cells and reinvigorate exhausted immune cells. So it has a novel mode of action. We also run a very lean, variable cost model at EpiAxis. We outsource all our work to leading CROs around the world. We also have a number of collaborations with groups around the world as well. But importantly, we own all our intellectual property, and we've got an internationally experienced group of advisors and directors behind us. And we've raised thus far $4.5 million, which we're now looking to raise a further 12 to get us into the clinic. And I'll explain that a little later in this presentation. At EpiAxis, we're focused on the modulation of nuclear LSD1, as we believe this plays a pivotal role in many cancers. And this is best illustrated by the human protein atlas data on my right. So this shows the expression across many solid tissue types where LSD1 is overexpressed. And our focus has been directed on breast, glioma, colorectal, and prostate cancer. LSD1, or lysine-specific demethylase 1, is a eraser enzyme. It removes methyl groups, and high levels equates to poor prognosis. And unfortunately, with standard of care treatments, whether it's chemotherapy or immunotherapy, cells become enriched with LSD1, and they go on to reseed. This is what we're seeking to prevent at EpiAxis. Our vision is to turn cancer into a chronic disease by modulating LSD1. We believe that this should be added to standard of care therapies, whether it's chemotherapy or immunotherapy, for active disease treatment. We also believe using epiresotide for long-term maintenance therapy, so that if any cells have escaped, these can be treated with epiresotide to maintain them in a permanent state of quiescence. We also believe prevention is entirely possible with this therapy. So we have extensive data sets behind this program. A lot of cell line work focusing on breast cancers and colon cancers and melanomas, animal data supporting this, as well as we've been harvesting immune cells and tumor cells from patients of various types and treating them in the laboratory. Plus, we've now run a pioneering phase 1 biomarker study, the first of its type, using a nuclear LSD1 inhibitor, a surrogate inhibitor called phenosine sulfate, where we've used that in combination with our Braxane for standard of care in metastatic breast cancer patients. We published that in Frontiers in Oncology last year, and it clearly demonstrated we could reprogram these aggressive cancer cells to remove their aggressive phenotypes. As alluded to, we have an experienced team led by our executive chair, Dr. David Fuller. David is a physician. He's a 30-year veteran in this space and has run many studies around the world. He's lived overseas and he's now based in Australia. I'm a physiologist by training. Derek Bowling's our Chief Financial Officer, and Rob McGuinness is one of our directors. He's also a medicinal chemist by training. Dr. Jeanette Wood is a preclinical oncology specialist, ex-Novartis, ex-AstraZeneca. Professor Roberto Pilli is an oncologist epigenetic specialist focusing on hematology. Professor Alfredo Judiligen is an oncologist epigenetic specialist, drug developer in his own right, and solid tissue focus. And Professor Pamela Munster is an oncologist, breast cancer specialist. She runs the phase 1 unit at UCSF in San Francisco. So collectively, we have 4 MDs, 4 PhDs, collectively run just under 300 oncology trials. But importantly, members of this group have brought together over 11 drugs to market thus far. Epigenetics has clearly attracted farmers' interest. Here are some recent examples over the last 3 years covering the spectrum of discovery, preclinical, clinical programs, where substantial valuations have been assigned to LSD1 programs. This is probably best illustrated by the most recent transaction, where Merck acquired Imago Biosciences from California. This was a phase 2 LSD1 clinical program. This deal was completed early this year. Merck paid $1.4 billion US for this program. So the question is, why invest now in EpiAxis? We believe we have a compelling entry point with the naming now of epiresetide as our lead candidate. We have a very modest pre-money valuation of 8.8 and plenty of room for inflection and valuation going forward. This is a first-in-class program with a novel mode of action, allowing us to reprogram and reinvigorate the immune system, and we've got clinical data supporting this thesis. We've got extensive intellectual property with over 14 patents already granted, and we're about to enter, if you like, the emerging epigenetic market, which is a growth segment. We're seeking 12 million in 2 tranches, 2 and 10. 2 allows us to complete our IND program, and 10 to run our phase 1 program, which would commence in December 2024 and run for 12 months when our last patient will be out. So in summary, we're looking for that 12 million in 2 and 10 tranches. This is a highly differentiated first-in-class modulator of LSD1, allowing us to reprogram our cancer cells and reinvigorate the immune system. We've named epiresetide as our lead candidate for IND advancement. The funds will be used for IND enablement and to run our phase 1. We're positioning epiresetide for standard of care across solid tissue and hematological malignancies, plus exploring it for monotherapy for maintenance and prevention. We've got extensive intellectual property, and we've got a highly experienced team behind us. We do believe this is a compelling opportunity. So please join us. Allow us collectively to prevent treatment resistance and overcome cancer recurrence. We thank you for your support and very much look forward to hearing from you. Thank you.
Next up is Zahara Systems. Zahara is a web-based application which enables companies to raise and issue purchase orders, match them to goods received and supplier invoices, synchronize into accounting systems, and finally pay suppliers.
Thank you. So my name is Jonathan Lee. I am a founder and director of Zahara Systems Limited. This will be a brief introduction to the Zahara application, the company, and plans for the future. So so what is Zahara? Is the question I just want to deal with at the moment. It's a cloud-based application. We enable businesses to manage the purchasing process from internal requisition to payment. Its comprehensive functionality includes purchase requisitions, purchase orders, receipting goods inwards against those orders, matching supplier invoices using OCR against orders, and then integration with accounts systems. We are also integrating in the middle of an integration with a payment portal, so we will be able to add payments into that process as well. Overlying all of that is a comprehensive approval system so that internally one can email around and get approvals for purchase orders and invoices. The problem we are trying to fix is the problem that is experienced by most SMEs across the world. We're mainly UK based, but that is a combination of paper-based, email-based, and spreadsheet-based systems that manage this purchasing order system. They result in inaccuracies, result in high processing times, approval delays, lost documents, inconsistent processes. There's potential for fraud and maverick spending, and there's definitely a lack of expenditure control. In fact, there are many more issues than these. Research by Gartner suggests that manual processes can cost 20 times more than an automated system. So how does Zahara help with that? Zahara helps because everything is in one place. All of those processes are in our web portal in one place. So that means that every part of the process can be immediate and error-free. The only break on this is human intervention. So, for example, that might be part of the approvals process where somebody needs to just check something out. There is an audit trail. It's paperless. And one of the key things that we find people love is the user interface is so user-friendly. So where do we fit in the marketplace? Sorry, I'll go back. Where do we fit in the marketplace? We sit in between the sort of low-end providers like Dex and Approval Max, who do some of what we do, but don't do everything. And in between those and the high-end ERP manufacturers. So we have most of the functionality of the ERP manufacturers, but we have a price point just above those of the low-end vendors. Why do we win? I mean, this is the key question, I guess, because at the point of sale, we win because of the user interface I've talked about. We win because we have a variety of price points, and we win because we can demonstrate savings, and this is incredibly powerful. The next slide I want to take you through, if I can, is just something on our customers and partners. So we have some big name customers here. I have to say, to be perfectly honest, we don't deal with all of the processes of either McDonald's, Lush or British Airways Holidays, but we do deal with a significant part of those companies. McDonald's is the UK McDonald's head office. It's not the branches and the restaurants across the UK. But we do have to go through considerable compliance and DD exercises to win those sort of clients. So that should give confidence in the systems and stuff that we run at Zahara. On the full deck, which is available on the website on the CRISP platform, I've got 3 detailed customer stories. What we've got here are some just quotes from the people that we sell to. We have been incredibly successful recently with a number of different clients, increasingly large clients, I have to say, over the last couple of years. And they're seeing significant savings, and we're getting some fantastic reviews on the various platforms, such as the Xero Marketplace, etc. But there's more detail actually on the CRISP platform. So I'll just want to share a little bit about the timeline. We're not a brand new company. It's the normal, I guess, software as a service startup process. So we start off slow and then we start to grow. The first product was effectively launched in 2015-16. And we added in the mobile app in 2020, built in OCR recognition in 21. And we have started to set up distribution in Australia. And we last year launched our version 3 interface. Most of the investment that we have been involved in and has been funded by the recent raises, and we'll talk about that in a little bit, was in the development of this version 3 interface, which is building on what was already a market-leading user experience. And this year, we are just about to finalize launching a partnership with Comma, and we're also looking to launch a partnership with Currencies Direct, and we're in discussions with them about that. So the next slide I want to take you to is our sales forecast and history. This is, we've achieved this in the last couple of years, as you see. I mean, the sales growth is still fairly impressive despite the economic climate. 36% sales growth we achieved in 22 of 21. We're on target to equal or exceed that in 2023, and we're forecasting a slight jump in 2024 based on the integrations that we're working on at the moment. So we'll take to the raise and what we're looking to raise. We're looking to raise in total over this funding cycle 1.5 million. We raised 875,000 in August last year, and we raised 250,000 in March this year. And so we have a small top up that we're looking for. What are we looking to do with that? We're looking to speed up our integrations, and we're looking to spend a little bit more on marketing. We recruited a marketing manager last year, and as a consequence of that, we've learned a lot more about the relationship between spend and return. And so finally, if I can just spend a little bit of time talking about the senior team, so the directors. So Martin, CEO and founder, serial entrepreneur, big understanding of software and run a number of successful businesses, which has given me a real insight into the SME marketplace. I joined him a few years back. My background's in private equity-backed businesses. I was CFO of Planet Holdings, a main list CAD/CAM software vendor we took private and sold it, subsequently making 3 times the private equity house's money. We have 2 directors, non-execs, who Piers is our biggest investor. He's invested multiple times, and he was a partner and head of UK investments at Intermediate Capital Group. And Rolf Nuyens, managing director of Intermediate Capital Group up to 2016, and since then has been advising a number of businesses, including investment funds on the continent. So I think we have a really strong team that understands investment priorities and is, we're there to deliver. So I thank you for your time, and please follow us up on the CRISP platform and get in touch. Thank you very much.
So, good afternoon, ladies and gentlemen. It is an honor to host this panel discussion titled Closing the Loop, the Promise of Circular Economies. It is the last panel of V&C Global. So yeah, as we face unprecedented environmental challenges, the concept of the circular economy offers a transformative approach towards sustainability, one that emphasizes reducing, reusing, and recycling resources to their fullest extent. Today, we are privileged to have with us three renowned experts in the field of circular economy who will share their knowledge, insights, and experience. We have Mr. Todd Mills, Mr. Todd Mills, an M&A Assistant Director at BDO UK, an experienced advisor who has helped numerous clients, particularly in the circular economy sector, achieve their financial objectives. We also welcome Dr. David Greenfield, a circular economy specialist and founding partner of ETSO, with a distinguished career in strategy, planning, and environmental efficiencies. And finally, we are joined by Mr. Richard Pearl, Chief Administrative Officer at Loop and TerraCycle, who brings his vast experience in various fields, including clean energy development and natural products. I'll be the moderator for this session. So without further ado, let's dive into this crucial conversation about the future of circular economies. So maybe starting with Richard, in the context of today's environmental challenge, can you briefly describe the role of circular economies in creating sustainable futures?
Everything that nature makes, it recycles. But nature has very few ways of being able to digest and process as an input that which humans make. And there lies a problem that with our growth, we have created something that doesn't really exist. There's elimination, but there's not waste. Everything is utilized. And humans have created waste and made it an acceptable thing that every time you consume, you're creating waste. And that waste is highly, highly problematic for our planet, particularly when every new single-use package requires fresh extraction of carbon and then more waste and more extraction and then more waste. And it's just become so commonplace, but it's come back to haunt us. So the way out of this, of course, is to emulate nature and do in business systems and commerce systems what nature's done for billions of years quite efficiently and creatively. And so the circular economy is the answer. I don't think that, although the term is relatively new, that anybody doubts that it is the right way to go. The question is, how do we get there? And how do we get there fast enough? Because the situation is dire and there is urgency. And it all ties into climate change. It all ties into the weather patterns that we see today, our food sources, everything. And so how do we get there? There's hundreds of thousands of businesses iterating in that direction. I represent one of them that's on the global stage. My colleagues here are familiar with so many of them. Most investors are. But I guess I'd say you can't get to a positive, sustainable future without moving into the circular economy. And the good news is there's a lot of businesses moving in that direction, a lot of investment dollars to support it.
Fantastic. Thank you very much, Richard. Maybe Dr. David.
Yeah, I think Richard's identified exceptionally well the need. I think in many cases, addressing the waste system and trying to prevent waste is absolutely one of those. But I think what the circular economy also brings with it is a level of innovation in the way that we consume. So different business models, different reliance on materials. And we are entering a critical material shortage stage as a planet at the moment. So when we do waste things, we're wasting things that actually we then have to go and expend more energy to then get back. So a lot of the work that we're doing, we're a small venture studio that is investing in material-based circular economy startups. So we're investing in startups that are creating new materials and waste streams. We're also creating internal companies focusing on those areas that we think are absolutely imperative to put innovation into. And we're doing that on the basis of we are resource constrained. And that resource constraint means that as a business, as a entity, as a planet, we cannot rely on the existing systems that we have in place. We're very linear. We'll take stuff out of the ground, we'll make stuff with it, we'll use it, and then more often than not, we will throw it away. We might even recycle it. We might downcycle it. We might take that really valuable material that has had 200 kilojoules of energy used for the extraction of it from a mine and turn it into a horse training ground, as I heard this morning for one really technical material. Go, really? And we don't value the materials that we currently have in the system. If I was to look around the room I'm sitting in, we've got all sorts of very valuable materials in the electronics that we've got in the computer. I've got somebody's leftover paper cup. They're all materials. They all have value. They all have a potential next life. And the sourcing of those materials, whether it's bio-based or regenerative, whether it's able to be maintained, reused, remanufactured, these are all absolutely essential parts of the circular economy. And coming back to Richard's point again, circular economy for me is an enabler of trying to deliver solutions to slow down climate change. And that's absolutely fundamental to this. This is a solution action-led set of practices rather than a theoretical, let's just come up with a nice way of thinking.
Thank you. Thank you very much. And I guess from your perspective, Todd, yeah, can you just briefly describe the role of circular economies in your context?
Yeah, I think the thing that I find circular interesting about the circular economy from I guess, an investment perspective, to me, it's a framework for kind of allowing businesses to rethink their processes from start to finish, totally from scratch. It's a framework for removing inefficiency. And the reason I think it's so interesting is because for me, the circular economy concept naturally links sustainability impact with economic return. Because if you're looking to create a more circular business, and by the very nature of that, removing waste from your processes and your business model, that should allow you to generate a higher margin as a business. And therefore, it's very attractive to investors who can see somebody doing something innovative in a circular way. But it's also attractive for them to invest in and to grow. So I think it's always much more difficult to encourage people to do something sustainably if it negatively impacts them from an economic perspective. But I think the circular economy lends itself to both environmental and economic benefits. And I think that those being intertwined is what I find really interesting about the concept.
Great. Thank you very much, the three of you, for that opening thoughts. I guess, just earlier we had the climate tech panel, and there was Craig Douglas from the World Fund who was just saying about a new company they had invested in, who was able to generate the company is able to recycle in Europe in-house 88% of batteries, right? Which is something that usually you import and export. I guess the general question is, how does the investment landscape need to change to fully support the transition to circular economies? And I guess maybe, David, you can give us insights into that first.
Yeah, no, I think that's really encouraging to hear of investments into European solution. I work with a huge number of startups that their main challenge is getting funding. They have great ideas. They have ideas that are probably already protected, have the IP. They're at a technology readiness level that means that they can potentially go straight to manufacturing. But the challenges are that scaling up. How do you take a really good lab-based technical solution and scale it up? And a number of the barriers are around financing that scaling up. The other barrier is actually finding the partners to actually scale up with that are willing to trial new products that are outside of the existing products. And that's a much bigger barrier than a lot of people give credit for. We're one of the investments that we're working with. They're currently on the scale-up journey. They're going to be raising 1.5 over the next 6 months, really to look at taking a proven technology and scaling it in the world of disassembly of technical fibers. It's a very exciting area, and there's a lot of people very interested in it. Some of the practicalities are around, okay, where can we get the lab space and how can we find the partners? So I think it's twin track. It's money, but it's also access to the ability to scale.
Okay, great. And Todd, maybe you can give us an insight from your perspective, which is a bit maybe further down the line.
Yeah, I mean, the first thing to say, I think the investment landscape is changing, and over the last probably 1 to 2 years, pretty quickly from my perspective. You know, there's a number of impact funds in the UK and Europe who specialise in investing in sustainable businesses, and circular economy obviously falls under that. And probably if you'd have asked me a couple of years ago, I would have thought that would be the big growth area. There'd be more impact funds. But actually, the way the market's moving is this, you know, pivoting towards generalist investors. Now, ESG is becoming a core part of their investment strategy. So there's now lots more investors who are not only, you know, understanding that it's you know, some positive aspects of sustainability, but actually really understand that they are value drivers. So I think there is real positivity there. I think the way it can be improved even further is for some understanding on both sides, both the entrepreneur and the investor. For me, you know, a circular economy entrepreneur is, you know, almost certain to be driven strongly by impact. And investors, you know, as the main priority, and an investor as the main priority being the economic returns. And just for each of those parties to understand the other and to think about communicating in a better way. So the entrepreneur articulating why their circular business model will deliver value, and you know, and vice versa from an investor perspective, understanding how important you know, the impact element is to the entrepreneur. So communicating those two things and understanding on both sides, I think that needs to increase. But I think there's been some really sort of positive steps in the last couple of years towards a more friendly environment for the circular economy.
Right. I guess, Richard, maybe on the flip side, right, from an operator's perspective, especially since the launch of maybe TerraCycle, have you seen the landscape changing? And if so, like how drastically, how quickly? Is it as quick as you think Todd was alluding to? What's your perspective on that?
So there's a spectrum, right? There's green and there's deep green. And the planet is calling for deep evergreen, right? Investors are cautious. So there is a lot of capital, and it is definitely committed to measuring impact and carbon. Carbon is going to play, carbon reduction, carbon credits should play also another role, along with investors, to sweeten investment in things that are deeper green. I mean, I've been in impact for 40 years. That's a rare claim. I've been at TerraCycle for 15 years, and TerraCycle started 20 years ago. And that's a recycling company profitably operating in 20 countries. Loop is a newer venture, and Loop has huge reuse potential. Think of everything you buy in Tesco or Walmart or Woolies, depending on what market you're in. And instead of it coming in a disposable package, it's coming in a reusable package, milkman model, subject to a deposit. But it's your favorite brands, favorite retailers, same content, just a different package that's not disposable. It's reusable. Now, to get back to your question, Hugo, that is as deep green as you can get, because you're not replacing and recycling one plastic with a package being made now from a recycled material. It's being made to be used 100 times, washed and reused again. Sounds unusual, but if you ever ate in a restaurant, you've drank from a glass that someone else drank from. It was washed. Washing has a long history. It was displaced some when we moved to single use. This is to give the convenience and economics of single use, but it has to get to scale, right? You can't make the numbers work. There's an upfront cost. It's cheaper to make it cheap, use once, discard, repeat. Recycling is more expensive than disposal. So as you move to make recycling work, right, you have to create a justification, an economic justification to someone to pay you the money to cover the true cost of recycling. But it's better for the environment. Is there money in that for investors? Yes. Does it compete with the highest possible thing you could do if you just wanted to make money? Could be investing in petroleum. Who knows? But what I'm saying is when you add a green lens, whether it's a lighter ESG lens or a deep, dark green, high impact lens, there are some upfront costs and they work at scale. But just like with solar, you have a higher upfront cost and then it pays off over time. Investors get it, but most of the funds who are moving in this direction have the same requirements as investors investing in non-green things. And so the motivation and the benefits to investors to invest in things that need to make the money and to dominate scale, as David was referring to, may not be there yet unless you're already profitable. TerraCycle's already profitable, and it's seeding Loop, which is the reuse platform. And we're inviting investors into that. But what I think is most important to say is the climate is definitely coming. And as the world is facing more evidence of climate change and global catastrophe, the imperatives of changing, I think that investment dollars will come in because the returns will be greater and the incentives will be greater. Right now, I think we're in a transition phase. So it's the scaling of the interest in funding the scaling that will get the deeper green things to profitability faster. I hope that was clear, but I think it bridges kind of the positions that Todd and David stated. They're both accurate, and that gives a kind of an empirical example.
Can I add something to that as well? Because Richard, I agree entirely. I think you brought out one topic which, from some of the investors we've spoken to, is still a little bit of a myth. So when we talk to them about circular economy, they go, "Oh, you're recycling." I go, "No, we're not recycling. Recycling is not circular economy. It's part of circular economy. But for us to enable circular economy to happen, we need to be able to move beyond the world of recycling. Recycling is
a transition strategy, in my view.
Exactly. So Loop, brilliant for reuse. With another hat on, I run something called Tech Take Back. We collect end-of-life electronics from residents in Brighton Hove, data arrays them, refurbish them, and get them back to 17 charities from digital inclusion. That's great for the charities, but we've also got apprentices that are now learning how to repair and refurbish electronic devices. We've now got apprentices that are learning the management systems to enable us to track that laptop from Mrs. Miggins' house in Acacia Avenue all the way through to charity Digital Brighton Hove and all of the steps along the way. So when investors are investing in circular economy, they're not just investing in a technology, they're actually investing in green skills and changing the narrative from a very traditional linear-based workforce to a more circular-based workforce, which is an added benefit of then having a system that allows us to really value and keep those materials in value for as long as possible.
Great. I think that you know both are clear-cut examples, and not only that, I think it provides job opportunities, right, as well, new ones that might not have been possible beforehand. I guess coming back to one of the points that Richard was saying, maybe Todd, you can give us the opening thought on this. Is there's an upfront cost, right? So how can companies across various industries effectively integrate circular economy principles into their business models, but whilst maintaining both competitiveness and profitability?
Yeah, I think the first thing I would say is to take the time to plan effectively and to understand the various different ways in which you can make your business more circular. It's not a case of just doing everything you can immediately to get to the answer as quickly as possible. You need to understand the impact of each different aspect that you might be considering on your business and on its profitability. Some of it may have a short-term profitability impact, but you need to understand, well, what is that short-term impact, and then what is the future value having implemented it? Is it going to be? I think I would also say, if you are a business and you're wanting to become more circular in your practices, one of the easiest ways to help you deliver value is to make sure that everybody knows about the circular and sustainable activities that you're doing in your business. It's a real driver in terms of consumers, businesses looking to buy goods and services for businesses that have these sustainability aspects to them. So definitely shout about it. And certainly for larger companies that may be a bit less agile, certainly think about investing or acquiring some of these smaller circular businesses, because this is where the entrepreneur is kind of working. They can be more agile in that environment. They haven't got the constraints of big organizations. So if I was speaking to a corporate looking to become more circular, I would be very much advising them to keep their eye out on that lower investment space, because that's where the entrepreneurs are operating, and where the breakthroughs will likely come.
And can I add to that? A blatant plug. That was one of the reasons why we actually set up Exor, to actually provide a pipeline of well-rounded and organizations that have already gone through a technical due diligence. So myself and co-founders have been in this space not quite as long as Richard, but nearly as long, and have seen a huge amount of ideas that have either worked really well or were good ideas at a time but weren't ready for that time. And so what we're doing through Exor is actually now essentially doing due diligence on early stage startups and then wrapping around support to them to enable them to be ready for scaling up. So rather than just putting a bit of cash and saying, right, tell us when you're ready, it's, okay, here's a bit of cash, here's some expertise, and let's help you build to the next stage. And the two investments that we've worked with over the last few months, one of which has already gone 5x and is now going for, as I said, £1.5 to £2 million raise. And within 2 years could probably be going 5x on top of that. So that pipeline of how do we get big money into small money, I think is a really interesting area. And there's not enough, from my perspective, and I'm slightly biased, but there's not enough integration between the large funds and the smaller startups, and we need a bit more of that.
Right.
If you'd like, I can add to that, or you can change the question, Hugo.
No, go for it.
So I think you spoke about, how do you get consumers to change their practices? How do you make the economics work, right? People like their habits, and they like the convenience of disposability. Circular economy makes everyone happy. No one wants to waste. When people get packages, either because they've gone to a retail store or it's delivered to their home through e-commerce, they are always aware, and it feels like a breach with how much waste comes to get what they really wanted. And that doesn't take into account the energy, the shipments, the pieces, the extraction, the manufacturing. That comes with the product. But just the mere packaging and delivery systems that we have create a lot of waste. No one likes it. But it's seen like a necessary evil. And you want it out of sight, out of mind, flush it, get it away. To move to a circular economy, one where we are truly much more efficient with resources and materials, as David was saying. You do need circular systems, but they have to be convenient, they have to be affordable, or people will say, I'm not doing it. And that's not just making sense for the end consumers. It needs to make sense for the brands and the retailers and the distribution systems. And the answers to survive in this world is scale. So, and in our company, we think globally. Okay. I am in the commercial sense here talking about Loop, which is the game changer, the beginning of the end of single-use plastic. And it's live in France, it's live in Japan with the largest retailers there. I'm not going into details because following this presentation, my understanding is immediately there's a video of me going through slides about that opportunity, which is open for some investment. What's more important about it is you have to let people maintain their behavior at a cost that is comparable with extra benefits and some extra things they need to do, like not washing the materials, but bringing them back so they can get their deposit back, over time making the collection reverse vending machines ubiquitous in gas stations, in retails, in stores, in all kinds of places, in townships, even in residential buildings. And that will make sense over time and with scale. It's the getting to scale where the investors come in, and it was the investors who will reap the benefit of that. Brands have capital costs. A durable package costs more, but they can keep it on their balance sheet. It's subject to a deposit, and carbon credits can also support it. So I think my conclusion just on the way of how do you change the world, you can do things locally, but fundamentally brands are global. And you need national systems. They're not going to put their advertising. They're not going to fill packages for just one region of the UK. They're going to look at the UK as a whole. They're going to look at Europe or America or North America as a whole. And they need to see scale to get the efficiency. And so we're taking on, in our approach, a big enchilada, but we've signed up 200 of the world's largest brands. We have major retailers in, Walmart in the US, Tesco in the UK, Carrefour in France, Aeon largest in Japan. And so we're trying to get there. And I do think there's an imperative. Legislation is behind it. And the brands will move and the retailers will move when legislators move. And the UK and France are ahead in that, and the EU. So my conclusion is it's coming. And if we're going to get there, the ultimate decision makers, who will be the consumers, not only have to demand it, they have to be willing to go through the process of getting to scale, which will not be as convenient as it will be when it is at scale.
Well, I guess that made a good point. Consumer behavior needs to change, and it needs to be at the forefront of that change. Now, the question is, how do you drive that consumer mindset change, right? Because I'll just give you my perspective, right? And I'm 24, right? And a lot of how I order food, right, is Amazon Fresh, for example, because it's convenient. I order it on my phone. 6 hours later, I get delivered a bunch of packaging, food packaging. Now, I don't see myself right now. I don't see how I can use a reuse model that way for the time being, because
until Amazon Fresh takes it back on the next order, but they may not want to do the sorting and the washing and all of that. That's where Loop comes in. For B2B, I mean, you're totally right. But remember, we've done this. We've done trials with Tesco in the UK. It was phenomenal. They want to take it national in the UK, just waiting for the end of the recession. They put sustainability and a lot of marketing on hold out of respect for wallet stretching. But I can tell you that what we observe with UK, with French consumers, as well as US and Japanese, so you got major markets there, is that consumers love not wasting. They do not mind a deposit as long as it's easy to get it back. Where they're buying the same stuff in the same store, the returns, yes, it needs to be easy. And somebody who's super busy, as I know you are, Hugo, the return of the package has to be super easy. Walmart is experimenting, picking it up from the homes just as part of their delivery system, and then getting it to us for cleaning. So I think we're taking the consumer in mind. It's the real barrier where investment comes in and where government comes in, and where government regulations requiring reuse, as is happening in the continent and is beginning to happen in the UK, but particularly on the continent, and carbon credits, is that you need to address the economics that allow people to invest in this. Because if it's going to hurt quarterly earnings, and this is a key point for getting to the circular economy, if some brands do it and it costs them more upfront, whether that's recycling or reuse. And their competitor isn't doing it. When it comes to quarterly earnings, one's going to have more expenses and a lower return on investment, and it can hurt their stock price, which is a no-no. And so literally, the best thing is the legislation because it mandates that it's a level playing field as people move there. It's coming, but you can be sure that the interests, just like the oil interests are fighting legislation, so are the consumer products companies, because it's additional cost and business as usual works. But I know these consumer products companies are sincere about sustainability, and the retailers want to see it. It also creates foot traffic. There's benefits all around, including the environment, not for the landfills and incinerators as much, but that's where it's disrupted. But to you, David.
Well, yeah, thank you. I've just you pick up a really important point, Hugo, which is about convenience. And it's convenience, it's the customer journey. We're seeing a lot of startups which are focusing on how can we be circular whilst being easy. And that's really key. So I mentioned one of the other organizations I'm involved in called Tech Takeback. We run an app called the ZeroNet that allows the residents to request a doorstep collection of a specific set of items at a specific time on a specific day to then be taken away and reused. That, for us, we've been running that as a trial in Brighton Hove across 280,000 households. We've collected from around 10,000 households in the last 2 years, and we've collected over 100,000 small electrical items for reuse. That, for me, is where we've got a transition from recycling, where people just chuck stuff in a bin and hope it gets recycled, because still a lot of people don't trust recycling, to having a deposit return scheme where you can go along to your supermarket or the point where it is, to an actual doorstep, material-focused reuse and circular collection system. And that I think we're in this space where I would be hoping that capital and venture money is going into that end of the solution, where we're looking more at how we can recover the most from the people, because one of the biggest barriers to circular economy is contamination. Contamination or loss of value of a particular item at end of first life. So this coffee cup, for example, has no real second life, unless I keep it in the office and use it every now and again. Whereas if I use this and use the washing machine, that will go on forever until I break it. We need to have that sort of approach with the way that residents do things.
Yeah, no, absolutely. That's true. And to touch upon your point, I have a funny story with regards to recycling. I was at uni in London. I'm not going to name the uni, just a bit, but I saw them take out the bins, and there was recycling paper, recycling cups, and it was just one bin underneath all of that.
Yeah.
Yeah, and then you look at that and you're like, right, okay. So anyways.
That's where I could bore you for an hour on the intricacies of separating waste, but I won't.
Yeah, for another time maybe. But I think I'll come to Todd. In the last few years, we've seen a real growth in climate tech investments, right? So considering that, how have investor attitudes towards the circular economy evolved over the past 3 years?
Yeah, it's been a really interesting time, and I think an exciting time, because so a phrase like ESG has been on the agenda for quite some time. But when I think of ESG, I think of sort of checklisty, corporate compliance, risk, and I think that's been the way that investors have been looking at it. What I would call maybe push factors. So they're either government legislation led, or they're being asked. Private equity firm might be being asked by their big infrastructure fund, who's their main funder, to not invest in riskier investments. So it's kind of almost a negative screening kind of attitude when it comes to sustainability and the circular economy. I think how that's evolved in recent years, and quite quickly, is I think that investors now begin to understand that it's not a negative screening process. There's actually real value to be had by investing in the right circular business. A lot of that's due to the business models that Big Circular promotes, something like a products as a service business where you're reusing an item and selling it to a customer many times rather than just once. That kind of obviously that promotes a longer life for that asset, but also the returns you're getting as an investor off that asset are much greater than that one singular sale. Lots of other examples, but the understanding the business model is really interesting from a value perspective. The other thing is the end customer for the business they're investing in, the consumer, whether it's consumer or business, they're all buying circular or sustainable products now. People want to consume these products. So again, there's value there to be had, which is proving, the penny's kind of dropping here with the investors. One thing that I guess sometimes maybe gets overlooked, I think, the new sort of generation of employees, they want to work for sustainable businesses, for businesses with a purpose, businesses that that have maybe a circular or sustainable angle. And then the final thing for investors is corporates all have these massive net zero targets they need to hit themselves. So there is a natural exit for all of these businesses that private equity venture capital want to invest in, you would think. So it's gone very much from a push, we're being forced to do this, is all a bit annoying having to do all of our checklists, to actually this is a real value driver for us. And I think we're probably not there in terms of how long circular economy has been prevalent in the investing world to understand what the returns are going to be like for private equity compared to maybe more linear models. But certainly, anecdotally on the way in, I'm seeing EBITDA multiples, maybe one or two turns on those multiples when the business is showing really strong, positive ESG, circular, sustainable credentials.
Great. Thank you very much. Look, I'm a bit conscious of time. We have 5 minutes left. I think two more questions. I guess whoever wants to take this one up. What role do governments and public policy play in fostering circular economies? And what are some of the policy changes that maybe you'd like to see? And I know we have someone from the US on this call, and then two Brits. So maybe let's hear from Richard first in the US.
First of all, I do believe that government action is critical, but things can happen without it. And the US is a laggard in terms of major economies, in terms of legislation in these regards. You might have a presidential administration that's forward in those ways, but getting things through Congress is not viable. So it is much more private industry, the investment side, that will lead it there. But Walmart intends to lead this and reuse in the US. And there are tons of companies at Silicon Valley and investment dollars from all over the place that will drive it. But frankly, we're in one world. So if Europe leads, as it is with legislation, and Japan follows with different types of government incentives and pressure, I can assure you that the US companies who need to operate in those markets will also feel the pressure because the globe has become interrelated. But the role of putting a tailwind in that reuse must be, in France, and that'll probably be the entire EU, quick service retail, the McDonald's and all, they're headed into a time when most of the things that they put in single use have to be washed. Whether they wash it themselves or they work with us, we've done successful pilots with McDonald's and Burger King, including in London. And I can assure you, those movements are going to fuel the changes. I cannot say that the leadership will come from the US, but I don't think the US is resisting it, certainly in the executive branch at this time, but it will not be the leader in that regard. It will lead in some other regards, and I think that Walmart and some of the other retailers here can drive the brands and the consumers to have a very strong circular presence in the coming years. We're counting on it, and we're working with them to assure that.
Fantastic, thank you. And maybe David?
Yeah, sure. I think absolutely agree with Richard. I think in Europe and UK, we have slightly different policy and regulations. I've spent the last 4 years working with municipalities in the UK, writing circular economy strategies and action plans that are designed to incentivize private sector to deliver circular. And there are levers that can be used, such as procurement and planning, to incentivize those private sector businesses which haven't got it. But let's remember, circular economy has the word economy in it. So if a circular economy is to be achieved, it has to work from an economic perspective. And as things currently stand and as things are going to currently move forward, we have to ensure that circular economy businesses are profitable. And that's not a bad thing. Let's not try and make out that we're all going to be walking around in welly boots, trying to be really green. This is about making sure that we've got an economic system that can deliver solutions to enable our planet to be able to be lived on for the next 1,000 years. And that we have to make profits from this. And some of those profits can be economic, some of them can be environmental, and some of them can be social. So we have to ensure that the private sector sees this as a realistic business model with added benefits, not something that's, we're going to put a bit of cash into this and we know we're going to lose it, but it's a nice thing to do. So that's absolutely where the circular economy has to play, and it has to be solution focused. Government will help, but they're not actually going to be the ones that do it because they haven't got the skills to do it. And that's where venture and capital into startups, scale-ups, and industry is going to be absolutely critical for the next decade.
Great. Okay. Todd, did you have something to say?
Yeah, I just following on from what David was saying there. To support that, I think what I would always recommend to anyone who's looking for funding in a circular business model, I would say that, look, remember that the investors, they need to see all of the things that they see in other businesses which are not circular, but they've been invested in historically. They need to see, they need to understand the management team, that it's a strong management team. They need to understand the product or the service that's being offered. They need to understand that not only is there a good quality product, but there's an addressable market that's going to support the growth, and ultimately that there's going to be a return for that investor. So yes, it's all, it's fantastic to have a product or service that's going to have real impact, but you really need to be able to articulate why what you're doing is going to be able to ultimately deliver the return for the investor. And I think that's from the businesses and entrepreneurs I see, that's the main pitfall sometimes. It's the biggest challenge, is that they've developed something so fantastic, it's really nifty, it really works, they're super proud of it, but actually they can't articulate how that's going to deliver a return, or there actually just isn't the market for a return. Yeah. So you still need to be concentrating on the factors that investors have been looking at for decades and will continue to look at going forward.
Great. Well, I wish, this has been the recurring theme for the past 7-8 panels, is I wish we had 2 hours to speak about this. It's every topic I've had over the last 2 days has been incredibly insightful, but unfortunately we have to keep to the agenda. So it has been a pleasure. Thank you, the three of you. Up next, we have obviously Richard, who will be discussing Loop, and for Todd and David, I'm sure we'll catch back and we'll catch up at some point. But I'd like to thank the three of you for your time today.
Thank you.
Thank you very much.
Thank you. Great pleasure, and thank you all for your time.
Thanks, guys.
Thank you.
Right. Next up, we have Loop. Loop is a global reuse platform enabled by a multi-stakeholder coalition of manufacturers, retailers, and consumers that aims to eliminate the idea of waste.
Hi, everyone. I hope you enjoyed the panel that we just completed, and it is my great pleasure to present Loop to you. It's a global, game-changing, circular economy, high growth and super high impact and high financial return effort as the beginning of the end of single-use plastic and the return of the milkman model to absolutely everything, not just glass bottles or other things that can be generally reused, but frankly, everything that we buy right now in single use. I'm going to tell you about it, but realize it's a big story. And to do it all, including this part in 8 minutes, is going to be a whirlwind tour. So I apologize for the pace at which we will move forward. But I'll start by just saying, imagine a world where every time you buy something, you don't have to be a polluter. Because when you buy things that are packaged in single-use packaging, it's use once, discard, repeat. And the discard part means that you're extracting, manufacturing, and using once. And the repeat part is you're doing it again and again and again. And the goal of Loop is every package is made for 100 uses, maybe in the beginning, 20, 50, but to get there. And at the end of its useful life, because it's a valuable material, it can be 100% recycled. In fact, that's the rule of Loop. And we're not a startup. We're scaling, but we're in multiple countries with some of the world's largest brands. Okay, without further ado, I am pleased to present Loop. So the first thing to state is that Loop focuses on the problem of use once, discard, repeat, the linear economy, and we move things to the circular economy. And so, as I said before, whether you buy it, and we're focused on UK retailers here at Tesco, and you return it to Tesco, or you return it to Waitrose, or Asda, or Sainsbury's, the point is you can buy it anywhere and return the dirty, empty package anywhere and get your deposit back. It gets washed and returned back to Loop. This is really happening. There are different models for reuse. What is also out there and is a small piece of the market, and we think a small piece of the market potential, is refill stations where people can just bring their own bottles and fill up with the soaps or juices that they want, but it's non-branded and you do your own washing, and it's obviously not in retail stores where you can buy everything. And then, of course, there's concentrates, which applies for things like window cleaners, but not everything. If you want to get it all, and people want generally branded products, their favorite products in packaging that they don't need to discard, that's where Loop has not only the commanding lead, in terms of a global focus, we're the only game in town. Reuse is not new. If you've eaten in a restaurant, then you've drank from a glass and put a fork in your mouth that someone else has used. And back before single-use plastics, things were made to last because when you own it, you build it to last. But then in the 1950s, people came up with plastic and they weren't sure what to do with this substance, but someone figured out, liberate mother from washing, use once, discard, repeat. And this was an actual advertisement. And indeed, the whole purpose was single use as convenient, as a progress in life, but it's had its repercussions and they're coming to haunt us. But one of the things that's really interesting is when the milkman owned the bottle, that bottle was an asset. But once it moved to passing ownership to the end user, meaning mom and the family, then it became a cost of goods sold to the manufacturer. And how do you make more money from a cost of goods sold? You make it cheaper. So this is what's happening to packaging over our lifetimes globally. And what Loop is about is the restoration of the package to the manufacturer. But you do know when you put money in a package to make it last, it's a valuable package and you need to have it subject to a deposit or the economics don't work. And so that's also part of Loop. Take a look here at the current prevalent Haagen-Dazs container, and the one that they created as a 1.0 version for Loop in stainless steel. Not only does it keep the ice cream frozen for a couple hours at room temperature, major carbon savings associated with the package and functionality. At one use, it's 10 cents versus $3, but at 100 uses, it's $10 versus $3. Plus, if it's 100 uses, 99 washes. Washing was disrupted, but if you're going to have 2 uses or 100 uses, it's got to come back, and it is coming back. And the key is getting washing and reverse logistics to scale, and that's exactly what we're doing. We've already signed up at Loop 200 brands to join the program, and more are coming. And while they're not all in store where we have stores now, and I'll show you that next, the beautiful news is that Loop is real with major brands, and it's been tested, and consumers love it, and there's more. So if it's in blue, it's where Loop is launched or will be launched soon. If it's got a bubble, you can see the countries where we are launched or close to launching. Right now, the leader is Japan, with the largest retailer there, and we're in over 110 stores and growing to 500, as you'll see in a couple slides. The next right now is in France with Carrefour, largest retailer in France. They're at about 70 stores now, but by April of next year, they've committed to be at 400 stores in anticipation of the Paris Olympics in July of 2024. And very importantly, just last week, late in June of 2023, the French government passed a law that's saying that all glass, starting with glass, must be washed and under deposit by 2025. This is big. It's going to go throughout the EU, and that legislation will drive a lot of activity for Loop. The biggest retailer in the US, and I think the world, Walmart, has committed to Loop. They're a little behind Europe. They're getting started, but by 2026, they're planning to take it further, as are other retailers. Giant Foods is already in 20 stores in the Washington, D.C. area. Moving on, the way Loop works is brands produce a package as they normally do and sell it to the store, but this package is subject to a deposit. The store pays the deposit, the consumer pays the deposit, which refunds the store, and basically it goes around and around. The consumer returns the dirty, empty package to a location where we have reverse vending. Could be the same store, different store, same change, or to a different store that has Loop. Our goal is to have it ubiquitous, and that seems to be the direction. The dirty, empty packaging comes back to Loop, but we subcontract washing and reverse logistics to global brands like Ecolab and DHL. Then it goes back to the brand or their co-packer for refill, and it happens again. This is just quickly to show you really fast that whereas the ice cream, the X curve goes from, the store, the manufacturer to the store, and the store to the consumer, the package has a cycle. And we've even addressed VAT in Europe, which was a big piece, live in Carrefour in France. And you can see the momentum to 500 stores, including 400 next year. Here at Aeon in Japan, with a small reverse vending machine, again, the largest vendor in Japan already at 115 stores. You can see it going nationally, and a larger reverse vending machine pictured. Here was our pilot in Tesco of last year, and they told us then they were going national. Of course, with the war in the Ukraine and the recession that was declared in the UK, it's on hold, as are all other marketing and sustainability efforts, until after the recession. So we're looking to 2024, probably second half of the year, for Tesco to begin their expansion to national programming in the UK. But the UK, Tesco did a big report that's available in our data room, which I'll come to in a couple minutes. We also have Walmart in the US, Giant Foods also in the US in Washington. We make money on fees charged to the brands based on a per-use basis. So as the beginning, it's higher amounts on smaller volumes. And importantly, over time, as the price comes down, our fee comes down, but the volume goes up. Ultimately, the numbers are great. We did a Series A, raised $25 million, and we've achieved all kinds of things. We're now in a relatively small $20 to $25 million Series B to get at and beyond break even. Some very favorable trends in the recent months promising what's ahead. And of course, these are our goals for the Series B and what we believe we will achieve with it in the next couple of years. Really fast, how are we going to do this? TerraCycle is the parent company that launched Loop. It focuses on global recycling, 500 people, 500 people, about $80 million in revenue. It's profitable and behind Loop. And for years, it's been working with brands and retailers, collecting and recycling in over 20 countries, recycled things that no one else can recycle. We do involve the brands paying us for things that have their name on it and their competitors' names on it to enable the funding to actually recycle what on its own no one could afford to recycle. And of course, we work heavily with retailers, which is why they're the right company to bring Loop to the world, which involves brands, retailers, and consumers. So I guess I conclude this presentation to say to you, thank you for your interest. And should you have interest in knowing more about Loop, just go through the Wholesale Investors website portal. You can access us, get into a data room for great details, of course, an NDA, and I'm happy to speak with you and introduce you to the colleagues also in the leadership of Loop as you explore your possible participation in this groundbreaking opportunity. Thank you so much.
Next up, we have Odondo. Backed by VC firm Hambro Perks, Odondo has reimagined customer service delivery for SME and growth businesses in a £100 billion global market, with a platform that matches a network of remote working gig economy customer service agents to clients on demand.
Hello, I'm Amir, the COO and one of the two co-founders of Odondo. I'm here to talk about Odondo, which is a technology-enabled customer service outsourcing business that's backed by the leading venture capital firm Hambro Perks. The global market for customer service is enormous at around £270 billion. But while customer service outsourcing to large businesses is a well-established practice, it is almost completely unserved for the £100 billion SME market. And that's the market that we focus on. If you run a large business, you'll have long-term forecastable needs, which lend itself well to working with a traditional outsourcer on a long-term contract. But the problem for SMEs and growth businesses is that their needs will flex and vary. A traditional outsourcer just isn't flexible enough for them and will almost certainly be too expensive as well. Their quality may be low as well because of the age and experience of the typical agent that works for them. I experienced these issues firsthand in my previous business, where we had a 150-man call center in the UK and a 100-man call center in Bangalore. We offered energy price comparisons, and it was a highly seasonal business. We couldn't outsource our call centers as the options available to us at the time were inflexible and of a high cost. And just like other call center operators, we spent most of our time recruiting because of agent churn rates that hit the 30% mark. We founded Odondo to open up customer service outsourcing to the untapped SME market. Our business model was designed with SMEs in mind. It's a marketplace gig model that matches agents to clients on demand. Our platform lets us organize an agent's schedule, sets them up with a secure working environment, provides our clients with a call center system to take and make calls, monitors agent performance, and generates forecasts and invoices for the work that we've done. The benefits to our clients are that they get flexibility through our gig model and higher quality agents because of their age and experience. We're also up to 40% cheaper than traditional outsourcers. A great example of a client of ours that works the model to their benefit is Arbor Education, an EdTech software business. Arbor provides software to schools, so its customer support volumes are particularly high during term times. Our model gives them more support at busy periods and lets them dial down during the holidays. We've proven the model. We generated 2022 gross revenues of £1.7 million. We're currently live with 20 clients. We've worked in 8 languages and across 3 continents. And we've built up a network of over 150 agents acquired at a negligible cost. Even though we focus on SMEs, you can see from the list that there's quite a range. From a FTSE 250 business and high-end global luxury brands, all the way down to small niche businesses. What we've achieved so far has been with a tech-enabled business model. But real scale comes by us launching a self-service version of our platform. This will bring together all the different tools and resources that an SME business needs to build and manage their own world-class customer service operation, and will be completely unique in market. Our vision for this product is to become one of the building blocks in the business building ecosystem. So, for example, an e-commerce business might use Shopify for its storefront, Stripe for its payment gateway, Salesforce for its CRM, and Odondo for its customer service solution. The business is led day to day by me and my co-founder, Bobby Devons. By way of background, I successfully exited my previous business, Energy Helpline, to private equity firm Inflection, which I helped build into one of the UK's top 3 energy price comparison services. Bobby began his career in investment banking, spending over 10 years in M&A for banks, including Morgan Stanley, HSBC, and Lehman Brothers. He left banking in 2011 to co-found an e-commerce business, which he ran for about 5 years. And it was that experience that sowed the seed for what later became Odondo. Our technology ambitions are driven through by our CTO, Zach Brady. Zach has nearly 15 years of experience in a range of businesses, including in several startups. We're very excited about how he is driving the next phase of our technology development. And completing the senior team is our chairman, Simon Champ. Simon is a serial founder and investor, the CEO of Newstead Capital and a former investment banker. We're also lucky to be supported by a highly experienced advisory board, with each advisor curated with a specific area of our business in mind. We'll shortly be launching a £1 million fundraising round. The round will fund our growth plans for the next stage of our technology roadmap and provide capital for expansion into the Middle Eastern market, an exciting growth region where we already have good local connections and expertise. This will provide runway through to break even. Thank you very much for taking the time to look at this video. It was a pleasure introducing you to Odondo.
Now we have the Places app. Places app is a platform/marketplace helping food and drink businesses to build relationships with customers via promotions, digital loyalties, cashback, digital menus, and events.
Hi all, this is Vlad from Places app, and today I'm going to walk you through our pitch deck presentation for our next round. So, Places app is a marketplace for food and drink, where on one side we have restaurants, coffee shops, pubs, and other types of these businesses. And on another side we have customers who are looking to eat and want to find the next place to eat out. So we start with the problem. Obviously there are 2 sides of the problem. On one side, customers. So those are people who don't want to install dozens of apps, which are appearing more and more these days. Those are people who want to save money and save time. They look for better deals, and that comes even more frequently with the current situation of the market. And the big problem, which was always there, is tons of new places, especially in big cities. Some places are closing, some places are opening, and if you are, for example, a fan of truffle pizza, you always want to know when the next place with this pizza is opening in your neighborhood. On the business side, as I mentioned, the amount of services restaurants are using is growing from year to year, especially after COVID, when they decided to digitalize even more. And managing the customer relationships becoming a problem, because data is coming from different services, and restaurants have to manually do a lot of things. Moreover, restaurants are occupied with big screens on their desk, which becomes a problem as they don't have enough space. Small businesses, they don't really have time and money to build their own apps if they want to use some loyalty solutions or show their menu digitally. We offer a solution, Places app, where for consumers we focus on saving time, saving money and building relationships. And for businesses we talking about saving time again, so they can avoid any distractions and focus on what they do best. They can earn more money by using all of the services we have or integration with their existing services. And lastly, analyzing the data. Data is, as I mentioned, is one of the most important parts of Places app, where we help to see everything on one place. Why now? The consumer behavior is changing and they are even more digitalizing these days. Restaurants are competing for customers in digital arena even more than before. And in 2023, both sides have to deal with dozens of apps. On consumer side, they have to install apps on their phone. On business side, they have to deal with different services to show their digital presence. A few words about the market. Restaurant revenue in 2020 was 35 billion and it's growing. Consumer spending is more than 100 billion GBP and it's growing as well. And number of restaurants and food and drink locations in the UK is more than 120k. We did our research. We were visiting quite a few businesses in London at least, and we identified that there is more than 50 digital services those businesses are using, which is a lot. And in average, every restaurant has to deal with at least 5 services for their digital presence. So talking about the competition, there are quite a few markets competing in this area. So number one is POS solutions, POS systems, where Places app has their own solution to have all-in-one place for businesses. We deal with the table management. However, table management is not our primarily focus. That's why we integrate other solutions to help customers to do their reservations. With delivery platforms, we actually identified some existing problems with the major players, which is very high fees. That's why we want to disrupt this market a little bit by offering self-delivery or delivery on much lower fees. Loyalty and promotion platforms, as I mentioned, it's quite a big market these days, but customers have to install different applications, and businesses have to deal basically with different services. And that's where Places app provides, number one, their own solution, and it will help to integrate other solutions as well. The menu services is important for the digital presence, as customers want to browse the menu from their homes. They want to make an order without waiting in the queue, and that's where we offer our click and collect solution and entering delivery market as well. Going through Places app, so we offer Places app as for consumers as iOS and Android applications. When you open the application, we will help you to discover your places around, and we're not talking about the businesses we only work with. We will show everything you have in your neighborhood or in a city you're visiting. You will get your recommendations. You can browse through existing collections of interesting places. With that, you can discover best deals for loyalties, you can discover coupons, you can find where you can collect your points or where you can collect your cashback. If you're visiting one of our partners, you can find the QR codes on a table, you can scan and make an order instantly without waiting for anything. With all of that, obviously, you will earn cashback and you will earn your digital points. There is no need to pay extra for delivery, as we're offering self-delivery for businesses, which will dramatically cut the fees for the end consumers. Also, we offering the delivery partners who can manage the delivery, and we also compete with existing market players with lower fees. In general, you will see all of the aggregated restaurants around you with data starting from opening hours till all of the Instagram or Facebook pictures they have. It all comes down to the data we work with. As I mentioned before, we want a single place. We offer a single place with all of the data about your customers. As you can see, key insights, customers are very price sensitive, especially these days. That's why one of our primarily focus is loyalties and cashback. A few metrics data. So we working with more than 300 businesses since the end of 2022, and almost 20 businesses are on gold or platinum subscription. And our current focus is small and medium, and we are planning to work with bigger businesses in 2024. We started in the UK and entering Saudi market in a few months. After that, the plan is to cover more countries starting from 2024-2025. Revenue model is quite simple. Number one is freemium subscription with 3 different packages. Also, we have transaction fees for orders, either click and collect, online, or delivery. More revenue model coming soon. We have 8 people in London and 12 people in total, having some people around the world. And we are looking for $4 million to improve our marketing presence, finish covering UK market, and enter the new European and US markets. If you have any questions, feel free to reach us anytime. Thank you for your attention.
Now we have Nevomo. Nevomo is a European deep tech company, the developer of a next-generation high-speed railway, improving inefficient legacy infrastructure and taking it to the next level.
Hello, everyone. I'm Ben Patrick, the CEO and co-founder of Nevomo, a European deep tech company which is revolutionizing the railway industry. We're a deep tech company, very pan-European. We started in Poland about 6 years ago. We're heavily Hyperloop inspired and maglev inspired, but the difference between us and other companies, other solutions, is that we retrofit existing assets, existing infrastructure and rolling stock with maglev booster, where we implement remote propulsion to increase capacity and flexibility of operations, and with full maglev, which comes as the next step, where we additionally integrate navigation to increase the speed, and we introduce it on existing lines, but for new vehicles. Our technology is widely adapted by the major players in Europe and in the Middle East. It's completely unique globally, very strongly supported by the European Commission. Unfortunately, I'm recording this from the Brussels airport because I cannot reach my home in southern Switzerland by train yet. Hopefully with this technology, this will be one day possible. And we have a full-scale functional prototype. Our ambition is to transform existing railways, which are 200 years old, in the core principle technology, into a fully digital, efficient, automated system. I guess you all travel, so you know how congested and delayed are all transportation means. There's a lot of hope for rail, but rail has never really delivered so far on its promises. And the main reasons for this are rails. It sounds controversial. They are a perfect interface, steel wheels running over steel rails for maintaining cruising speeds, but this is a terrible interface for acceleration and braking. The braking distance for 300 kilometers per hour, it's 4 kilometers. It's insane. If we combine this with speed limit that no conventional high-speed railway is able to operate faster than 350 kilometers per hour, we're getting to a point where it's really limiting the competitiveness of railways towards aviation, which, as I said, I have to use now, and many of you probably for any international travel at this moment. It's super super expensive and time consuming to add capacity because every time we have to build new lines. And at the same time, the railways are facing extreme pressure from automotive and aviation, which are now becoming much greener than ever. And at the same time, there's a huge political expectation to double capacity in very short time. That's why we are introducing linear motor propulsion, optional magnetic levitation to basically increase capacity speed by twofold, and all happening at 1/3 of the cost of building any new high-speed lines in Europe, and much faster, so that railways can become much more attractive to carry more traffic from road and air, and this way indirectly cut emissions. We do it by implementing linear motor and two parts with the booster solution, attaching parts, electromagnets to the sleepers and parts to the vehicle, and the same propulsion stays for the levitating version, where we also attach some elements to the sleepers and we introduce new lighter vehicles to levitate. The pathway is very flexible. It allows the operators, the infra managers, to choose on which line they want to implement which version of the system, and always designed in such a way to be fully interoperable with the future Hyperloop, which is extremely important. All this approach to reach network effects at reasonable costs and very quickly. There's a lot of use cases. We're going to start with freight solutions and then move step by step towards high-speed passenger. The moment is perfect now. I'm just coming from a super important meeting at the European Parliament where we discussed how this technology can become European answer to the Asian domination in maglevs. And there's so much pressure and so much money available that the timing is really, really perfect. This solution is much faster to market than Hyperloop, but it's also a bridge towards it. We have a full-scale functional prototype of this levitating version, which means we can start industrializing and implementing the propulsion system, because the levitation will be possible to add it later, and it's going to work on some lines. And this week we are starting to test the first freight wagon, which is a fully automated system, not requiring any locomotive. And we do it together with our partner, which is one of the big GATX, one of the biggest owners of freight rolling stock globally. Concerning the market, we've been active, super active in European Union so far, and in the Middle East, we're getting a lot of traction. Implementation-wise, we start with freight because there's an immediate market need, and then we move into passenger implementations. And here you see all the players that got interested into this technology already, and we are moving next year to pre-commercial pilots, which will already start generating revenues. And some of the benefits that have been already analyzed with major users, huge increases in capacity, in CapEx, and we are moving into first pilots next year. As I said, already growing industrial partners, some new very strong players to be announced in the coming weeks. IP extremely strong, super unique technology, system-wide patents and specific improvements of subsystems. We've been very efficient in fundraising, so in spending money so far. So we've spent just about 12 million euros to get to that very advanced point. Now we're raising a pre-series A, which will be extended from this initial 4 million to 7. We have still about 2 million left available. The rest is committed or already executed in first closing. And next year, we're going to raise a proper Series A of about 20 million, where 10 million is already committed as co-investment from the European Commission. And the team is a great mix of railway and finance expertise with some great advisors like Johannes, who was responsible for building the Shanghai maglev 20 years ago. Wrapping up, completely unique technology, very strong IP, strong market traction, and really cost-efficient team. Happy to answer any questions later on. Thank you very much.
Next up, we have Clean Vehicle Solutions. Clean Vehicle Solutions is a clean energy transport solutions company covering clean fuels, technology, vehicle design, marketing, and finance to emerging market sector.
Hello and good day. We're Clean Vehicle Solutions Limited, a Hong Kong limited company with global aspirations in the electric vehicle sector. Cleaner air for a healthier future is a mantra that many aspire to, but very few can actually deliver. We've adopted the premise of a three-wheel electric tricycle built to German, UK, and international certification standards, meeting all community needs. We're using the Philippines as our initial project, and we're replacing 3.5 million vehicles. We won't get all of the market, but we'll get a chunk of it. We're replacing 2- and 4-stroke gasoline vehicles, which are both polluting, dangerous, unsafe to society, and there are just plain too many of them. This is also an unregulated sector, and it is only recently that the Philippines is adopting global regulations for the treatment of public transport, pollution, and health. Our portfolio has 4 vehicles, all on the same engineering platform. The passenger vehicle will cover everybody. It's 6 seats, 8 children. Our ladies only is the same vehicle, but for ladies only. And we are promoting lady drivers as well. Our PWD and seniors vehicle is for obviously those with afflictions that none of us wish we had, and they are vastly underrepresented and under attended sector of society. In the Philippines, 95% of wheelchair users don't leave their house more than 3 times a year. Our last mile delivery and custom vehicle will act as a backup to the major courier companies where they don't have offices or vehicles in rural areas. And this is our portfolio in a little more detail. Our passenger vehicle, ladies only, PWD, and last mile delivery and customs with 3.5 cubic meters of luggage space. We are 100% battery operated, lithium-ion batteries. We have raw materials which are renewable in every case for the body panels and for our chassis. As I mentioned, we're engineered and certified to meet international road safety standards. Unusually for the Philippines, and I'm sure this is the case in other emerging markets, we provide a monthly salary to all drivers. We pay their social benefits, their public health, and their pension for the government, but we pay for the employers and the employees sector from income. And with 400,000 vehicles planned for by 2030, we'll create 1 million new jobs. In summary of the opportunity and the social responsibility that we're adopting, we provide family security. As I mentioned, the driver receives a salary. He has incentives as well, which will increase that. Tap and pay through our own e-wallet, so it's cashless. We have an app-based booking service. PWD, as we've said, are securely seated in the vehicle along with their attendees and other passengers. Ladies only, the courier support, as I mentioned, and customized units for small businesses and franchises where they require a low-cost vehicle within their relatively limited market audience without the cost of having a very expensive 4-wheel van. Our telematics is groundbreaking in its application. It is designed for the operator and for the passenger. We have profit sharing with the operators. As it's a wallet, there's no cash involved with the driver, so we share the costs with the operator and we share the revenues, which is at the moment unheard of in the Philippines and in most other economies, I would suggest. We offer investors ownership. We can provide vehicle finance on a planned basis with local lenders and financiers, as well as the international lending community. We have our own charging infrastructure. We guarantee that there will never be a lack of power in the battery during the operation because we planned and conducted research, particularly during the pandemic, which has showed us that how to operate is the most efficient way of producing a vehicle that will operate. And for retail, small investors, as well as the private equity sector, we can forecast and predict with some stability good dividends through investment of large and small numbers. The regulation of tricycles, public transport in the Philippines is erratic to say the least. It is not very well applied, and we're making sure that we have the support of local government as well as the federal government in meeting safe and equitable operations. This is a summary of our telematics and our information technology that we will manage. This has been designed specifically for our operation. More details are available on request. The environmental impact is considerable. We have manufacturing capacity for 400,000 electric vehicles by 2030. That will save 900 million litres of gasoline, 2 million tonnes of CO2. That will produce revenues at current prices of $200 million of carbon credits. And from our part, for every electric trike we put into the market, we will provide 20 fruit trees. They will mature and produce bearing fruit within 4 years. 8 million of those will be in the society, urban, rural, and the marginalized communities as soon as they get their trike. Our social development goals are very strong. We, as you can see, apply ourselves to gender and disability concerns. We meet the known demand because we've been researching the market, and we have letters of intent already for a considerable number of trikes in both rural and urban areas, not just the main cities within the Philippines. We can deliver 1,000 units this year and 50,000 a year thereafter, possibly by doubling up on shift management, etc., even more. We have a lot of experience in our team from the automotive sector in both design, management, and marketing. There's our team, a mixture of young and some older. But we are very happy to have local Filipino engineers of considerable experience and young strategy officers who have a vision as us for cleaner air for a healthier future. Thank you very much. Before I go, I'd just like to say that we are looking for an initial investment of up to $5 million, and that will produce 200 vehicles for us to launch in Q1 next year. That will be a mix of our portfolio where we have a known demand for those 200 vehicles. We are also registering all of our technology and our intellectual property. We've got to run the business, and we've got to employ the drivers for the operation. We operate 20 hours a day, so we have a lot of drivers to pay for and support in the market in their daily and monthly welfare. So 5 million is going to get us off the ground, but our revenue stream we predict will enable us to break even within 18 months. Thereafter, we can expand our production to a level that we can then self-support through cash flow. Thank you very much indeed. Drop us a line if you've got any concerns, or deal through Wholesale Investor. Thank you very much.
Now we have MyFood24. MyFood24 is a personalized nutrition management software using machine learning to address diet-related disease. MyFood24 is uniquely developed with scientific rigor and validated for accuracy with biomakers.
Hi everyone, my name's Keith Nurkham. I'm CEO of MyFood24, which is a personalized nutrition and management software which uses machine learning to address diet-related disease. The problem of diet-related disease is huge globally. Around 20% of all global adult deaths are related to diet and what people eat. And to make that specific to the UK and the NHS, the NHS spends around £10 billion a year on diabetes alone, and that is a hugely diet-related disease, as we know. So there is a huge amount of money spent on this, and a large number of people that diet has a massive impact on their lifestyle and their length of life. This is a quote from a GP practice that we've worked with. Around 50% of the patients we see have a health condition where diet is a factor, less so or more so in terms of the scale of that factor, but nevertheless a factor in their treatment. And there are a number of key areas that are focused. The amount of fiber that you're eating and understanding whether you're eating broadly enough. Most people don't. How much saturated fat you're eating. Most people eat too much saturated fat, and that has implications for them. Same with sugar. Most people eat too much sugar, and equally too much salt. And all of those have an impact on your diet and the conditions and your health and well-being. So what have we built to support that? We've built a B2B SaaS solution, which is a combination of a patient app underpinned by machine learning and a healthcare professional portal. Because we're delivering this in the B2B space, this would have somebody supporting and overseeing that patient using the product, and that's the healthcare professional portal. MyFood24 tracks over 100 macro and micronutrients, including vitamins and minerals. So this isn't just about counting calories. It's about really understanding what the patient is eating and consuming and the impact of those elements. And you can see here how we track nutrient intake versus goals. So this, in this example, has been set by the healthcare professional, and you can see how the patient is doing tracking against those goals over a number of days. And you can see here patients consuming a specific meal. You can see how many calories that is, but most importantly, you can see what percentage of the goal that is, and you can also see the nutrients that make that meal up and the impact that has on the patient's intake. So what's our traction so far? We've got over 100,000 research users in 10 countries, South America, Europe, and we now have a food database in the US. But our focus for the last 18 months has been around B2B healthcare and building a scalable technology platform, using biomarkers, validated biomarkers, which are never crowdsourced. So we check all our own data. We don't use patient inputted information about food. We have a number of early adopter healthcare customers secured, both on the NHS and the private healthcare side. And we have our first, what we call healthcare channel partner sign. So this is where an organization is using our product inside their offering that they're taking to their customers or consumers. And that's really crucial for us as a channel. We've also been recognized in the Health Tech 50 Award. We were fourth in that last year, and Yorkshire's most exciting company. So we're being recognized not only by our customers, but we're being recognized externally as well for the organization that we are. Our partnering opportunities that we spoke about are large, and we've got a number of ongoing opportunities with organizations like private hospitals and wellbeing providers, providing those for others. Weight management programs where they're already got large numbers of consumers, but they may not have as accurate a database and food database as they would like, and they're able to use ours. Medical device providers where, particularly in diabetes, they're providing information to their patient, but they could look at providing further information in terms of the food that patients are eating and the support that that gives their patients. Providers of activity tracking that do really great job around tracking activity and often have food elements, but don't have particularly accurate or comprehensive databases, can use ours and place ours in their offering. And also clinical trials where tracking data and in terms of the amount of food you eat is crucial and important. And we do this in two ways. We deliver this both as a branded MyFood24, so the patient sees that within the offering, or increasingly white labeled, where the patient sees the offering from the end organization, and MyFood24 is the database that's powering that inside. This gives a view against a number of our common competitors in the market, Weight Watchers, Noom, Carbs and Cows, etc., and MyFitnessPal. And as you can see, in all of the areas, we have developed a very specific product for B2B, very comprehensive database, validated by biomarkers, with that real-time healthcare professional link and a food and data set that's never crowdsourced. So we only validate our own data and make sure that it's fully validated. And we've been very successful against our competition in the B2B space. Financial terms, we're coming from a small base in research and teaching and expanding over the next 5 years as we build into the healthcare space. The addressable market is huge in healthcare around diet and diet-related illness. We're targeting £14 million worth of revenue in 4 years' time. And our first 2 markets in the UK, which is the NHS and private health and wellbeing, represents a £100 million opportunity for us. So there's plenty to go at in terms of that opportunity space. We then have additional revenue opportunities beyond that from EU and international partnerships, and some of the organisations we're talking to are global organisations, and therefore that gives us scope into new markets beyond the UK. We are also considering and have in the back of our mind a direct consumer offering potentially from 24-25 onwards. We don't currently deliver our services direct to consumers. It's all B2B. And we have a SaaS plus a growing interest in that subscription to data set model where providers are using our services as part of their offering to their consumers. The team is very experienced, highly experienced team. Professor Janet Cade is a world-renowned epidemiologist who founded the business. We're a spin-out from Leeds University, and Andy Julie and Leeds continue to be involved. Stuart's an extremely experienced finance director. I've got over 30 years experience and built 2 startups and successfully scaled and sold those. And Steve, who started the business with Janet and still works now on our partnerships, again, has significant early stage scale. Our ask is 1.5 million. Deepbridge, who've supported us since 2019, will lead with £500,000 on a 2.7 million pre-money valuation. We have a further commitment already for 300,000, which we will close in the next 4 to 6 weeks. And then we're looking to do a second phase of this round by the end of Q3 2023 to take that up to and find the other 750,000 for that original ask. On our exit, we're heading for 2 to 4 years for private equity or possibly a trade sale to a larger healthcare organisation, specifically one who would like that accuracy and database and the customer base that we're building. Thank you very much, and happy to take any questions.
Now we have Waterfilled Glass. Waterfilled Glass's mission is to cut carbon emissions and save energy costs while enabling more access to daylight and clear views, regardless of the building type or location.
Hello, everyone. My name is Matthias Gutai. I'm the CEO and founder of Waterfilled Glass Ltd. And today we would like to talk about our new innovative technology that uses water in the windows as an invisible layer to create an energy efficient buildings with glass. Our mission is to cut carbon emissions, use water to save energy costs, but also enable to access to daylight and clear views in a building without any compromise to thermal comfort or energy bills or carbon emissions. Our vision is to create the most energy efficient glass system in the world, which I will show you in a few slides how actually that happens. Create and design buildings even without shading, making these elements obsolete in terms of energy efficiency and thermal comfort, and also become the world leader product for retrofits. So what is the problem? Glass is a beautiful but invisible element in the buildings that has a much bigger impact to environmental impact than people would normally think. It is responsible up to 45% of energy cost in a building. Conventional buildings do not block radiation, so that's 66% of the energy exchange. It's a big problem, but there's nothing we can do about it because we want our buildings to be glass to be transparent. Existing retrofits options are difficult and expensive. 30% of the budget goes to elements that you don't need, like scaffolding, permits, window replacement. And carbon taxing and legislation will mean that this problem must be addressed now. So what does Waterfilled Glass do? It introduces a water layer that it's invisible. It's a perfect absorbing layer. So it prevents room overheating. It blocks the heat before it would get in. It provides, but it doesn't block the light. So daylight can go through. Water is obviously a transparent layer. And it saves much more energy than any other element in any other technology in the competition. So how does this work? This is a normal window. So you would see radiation, conduction, and convection as the main culprit of energy bills when it comes to a window. Radiation is being the biggest. It's usually 2/3 of your energy bills. It gives a problem during summer when the heat comes in, and the problem during winter when you lose heat through the window. So water-free glass is an absorption layer. It's not an insulation layer, it's an absorption layer. It absorbs the heat before it would come in the summer, and it absorbs heat before it would get out in the winter. And this way it saves a massive amount of energy because it addresses exactly what the problem is, radiation. Why are we doing this now? The reason is because carbon emissions need to be lowered, and CO2 emissions are causing irreversible damage to our environment. Retrofitting is becoming a major concern in the construction industry, and there are tax credits are now available for both house owners and developers to change to address the market. How do we make money? Water-free glass is not a glass producer. We are offering licenses to glass factories and construction companies, and they are selling the product and pay license fees to our startup. And this way we can grow globally very quickly and scale up and reach a lot of markets in a very short term. What are our products? So we have a new build solution, a new build water-free glass panel for new buildings. It's typically a triple glass unit that is compatible with existing off-shelf frames, off-shelf mechanical systems. So it's very compatible with existing solutions. And we have a retrofit option, which is a secondary glazing. So it can be installed behind existing facades. So in that way, you don't have to remove the existing structure. You can just build it behind it. And that saves costs and hurdles. Tenants don't have to move out and so on. It's just much easier to do. We already have about 200,000 pounds of projects in the pipeline, signed LOAs. We have already received payments for our first jobs. We also have huge market traction. So for example, we were on the top visiting stand at the Future Build in London, and we have license agreements in regions. So we are ready to go out and compare the market. The addressable market is really big. So obviously it's a construction industry. So in that case, in glass industry. So even just the SOM is about in the value of 1 million, even if we at least reach 1%. Our competitors, we outperform them not only in energy savings, but also because we have much lower embodied carbon. So we pollute less when the product is manufactured, and we can be retrofitted from the inside as a secondary glazing, which our competitors cannot do. We have a team ready for the startup with combined skills of engineering, technical studies, but also business and financing. And we are fortunate to have a diverse, experienced team of mentors who we are meeting at least once a month, starting from in fields of facade engineering to business strategy, construction, and manufacturing. We developed the technology for over 700K of grant funding that we use for R&D. So our product is ready, our patent is granted. We already did pilot projects to address all technical risks. So you're investing in a company that is ready to sell. We use existing technologies for building, but also manufacturing. So it's very simple to adapt for a glass factory to do this. The patent and the fluid is where actually the magic and the secret happens. So with that is actually not something that necessarily we have to give out. So in that case, we can protect the IP, but at the same time, we can expand through the markets globally. We work with energy retrofit companies, architects, individuals, commercial greenhouse, and so on in our first projects. We are aiming to break even by 24 and reach at least 10 million by 27. We are currently raising 450,000 pounds that we are working, we will use for marketing, promotions, operational costs, R&D, and to enhance our sales and project management team. We have grants in the awards. So this is a tested technology. It's published through peer-reviewed journals. It's patented, and it has been developed for scientific grants without giving up equity to universities. So it's all still with the founders. And we have not just attraction from markets, but also for the media, published in leading journals like CNN, Japan Times, Design Boom, and Design. So this is very much in short. I hope like the technology, and we would be more than happy to answer any questions that you have. Please feel free to visit our website, waterfreeglass.com, for further information, or reach out to us directly through the platform or by email. Thank you.
Good afternoon, evening, morning from wherever you're joining us. This is our last session of V&C Global, and what way to finish it but by having Chuck Brooks. Chuck Brooks is a luminary in the world of technology and cybersecurity. As the president of Brooks Consulting International, he brings a wealth of experience to every engagement. His role as adjunct faculty at Georgetown University in the Cyber Risk Management Department underscores his deep expertise in the field. Previously serving at the Department of Homeland Security's Science and Technology Directorate, Chuck's knowledge and experience spans across the public and private sectors. He's been recognized as one of the top 5 tech people to follow on LinkedIn, and in 2022 was hailed as a Cyber Person of the Year by Cyber Express. An esteemed contributor to Forbes, Chuck's insights into technology and security are highly sought after. With over 105,000 followers on LinkedIn, his reach and influence are expansive. A 2-time presidential appointee, Chuck continues to shape the tech landscape through his expertise, leadership, and vision. So without further ado, I'd like to present to you Chuck.
Thank you, Hugo. It's a real pleasure to be here and participate in this really important investment conference. And today, I'm going to present an overview of some of the key issues that are facing investors right now, and that's the emerging cybersecurity landscape. Cybersecurity touches every little aspect of every technology, every business. It's really important to get an understanding of what the challenges are, what the threats are, and what some of the technology components are. So without further ado, I'll go into this PowerPoint, which will give you an overview and hopefully help your understanding of these issues. So the reality with cybersecurity is that we're now in a digital era. And this digital era is transforming everything we do in every parts of our businesses, whether it be in healthcare, whether it be in financial, whether it be in transportation, pretty much retail, anything you could think of. The problem is that when we constructed the internet, it was really not built for security, yet we've made it virtually the backbone of all private sector and government operations, as well as our communications. So we're stuck with it. It's expanding rapidly. There are billions of people now connected. And the problem is, of course, that now that we're doing business online, our crime and state actors and many others, which I'll get into, are also targeting us because they go where the money is. And the money is now in digital. So there's really a slide I'd like to share, which is really about cybersecurity wisdom. It's all too true. There are 3 types of people in the world: those who have been hacked, those who will be hacked, and those who are being hacked right now and just don't know about it yet. And the latter is probably the most with most businesses, although a good portion of businesses have already experienced some breaches. There are a lot of small and medium businesses out there that have not understood that the implications of being hacked, or the fact that probably there's someone lurking in their database. The problem is, again, that we're playing catch up. Adversaries have had an advanced start. They don't have to be lucky all the time. They could do many attacks. Only one may work, but that one work is profitable for them. So we're in a world of precarious and yet interesting possibilities, which I'll now explore, which is really more of the frightening factor, which I call the cybersecurity stats that we're all facing now is a civilization that's called the yikes factor. And the reality is that everyone and everything is a target in a digitally connected world. There are over now 500 million types of malware online. This may be actually a conservative estimate because now with artificial intelligence in ChatGPT, a lot of the hackers are creating their own malware. So it's really difficult to keep track of. Similarly, the estimates were that a cyber attack happens every 39 seconds. I would say that is information is probably also now dated with ChatGPT and artificial intelligence enabled threats. So pretty much every few seconds there's a hack. And this is true that over the next 5 years, it's estimated that 146 billion records will be breached. This is a report by Juniper Research, and that predicted in this year alone that more than 33 billion records will be exposed via criminal data breaches. And I'm sure that you've all experienced the fact that your information may be flagged, that you're now you're one of the the organizations or companies that you were following, their database was breached and your information is now on the dark web. Pretty common. That's why it's always important to change your password, because as it said earlier in the slide before, that everyone will be breached sometime. Even if you have the best fortifications, there's still a possibility of a breach. And this is important for investors that cybercrime is really an institution to itself, a 6 trillion annual institution. So it's larger than most GNPs. And unfortunately, it's a very big cost to economies too. And if you put it on the cost of the global GP, the cost of cybercrime makes up actually 1% of the global GDP. So that's a huge amount to consider. So what are the global cybersecurity trends you should know as investors or if in mergers and acquisitions? You should know, first of all, that worldwide spending is going up every year. This last year, it reached almost $134 billion. That's according to research from Gartner. It's going to be much more this year and probably exponentially more in the next few years. You should also know that the threat actors, especially state-sponsored ones and criminal enterprises, are taking advantage of this ever-expanding cybersecurity attack surface by using the resources to employ more sophisticated means of discovering target vulnerabilities. They're automating their phishing attacks, which I'll go into a little bit, and they're finding new deceptive paths for infiltrating malware. So they have a huge canvas to work with, and they're doing it in a very good way from their perspective. They have well-paid hackers. They have all the tools, and one of the other factors is now they're collaborating. There's much more greater collaboration among cyber criminals and nation threat actors too, which often sponsor them. So they're leveraging the underground market. They're partnering and purchasing hacking as a service. They're using hacking kits. They're sharing them. They're also sharing tools in the dark web, websites and the forums. So the problem is some of these hacking tools are pretty sophisticated. They're stolen from intelligence agencies and corporations and even the manufacturers. So they have the tools readily available to do these hacking. So they're also targeting not just only businesses that may be retail or in healthcare. They're attacking industrial. They're going after what is called as operational technology systems, such as a Colonial Pipeline. It happened last year, where they attacked the IT portion of the network, and the OT portion of the network had to be turned off because it didn't know if it was corrupted. In turn, that basically sidelined all the gas deliveries on the East Coast of the United States for almost a week. So the danger there is really, really scary. And also, if you look at the news recently, now they're hacking satellites too. The Wagner Group allegedly, if it was, we don't know sure if it's Ukrainian, hijacked a Russian satellite earlier last week. And then, of course, the Russians have done the same with Viasat satellites last year during the attack. So everything that we have up in space, it's monitoring us and looking at the sensing and predicting where the weather patterns are, how we communicate, is also vulnerable to attack. So these trends are very scary, but I had to share them that they're real. And I think if you're investing and looking at any business, you need to know about them. So who is the threat actors out there? Well, there's several. There are, of course, the nation states, primarily 4 larger countries, Russia, China, Iran, and North Korea are doing a lot of the hacking. Their motives are usually economic or military, and they're going after infrastructure, as I mentioned, like satellites. They're also going against, energy grids, etc. Very problematic because predictably they have impact on the economies of many countries, and they've basically infiltrated all of them. The SolarWinds attack a few years ago is a good example of the Russians, actually, allegedly Russians, getting in the network and system and getting into a lot of different networks, government and private sector networks globally. So this is a big threat. With China's predominantly they're going after intellectual property. They've done this for many years and gathered a lot of technological know-how by stealing it from Silicon Valley and through Europe, all different places where it's being created and manufactured. Then there's the biggest really part of cybersecurity is organized crime. 87% of the crimes are financial, and they're for financial gain. And they're attacking financial communities, the banks, but they're also attacking other places like educational institutions, particularly with ransomware, who have to pay, or healthcare institutions like hospitals and healthcare facilities that also have to pay. And unfortunately, many of those healthcare facilities don't have strong security because they invest in technologies for healthcare, and they don't have the know-how. They're playing catch up during the recent COVID outbreak. Attacks went up over 300% on healthcare, and particularly ransomware attacks. So even though everyone was suffering, hackers and organized crime were going after the most vulnerable part of our institutions. And then you have what is called the terrorists and extremists. Of course, you know, their causes, or they're highly visible. They want to be showing off. It's a weapon of war. Hackers, hacktivists. A lot of the times, the most capable hackers are actually the guy that's a gamer, or a girl that's a gamer sitting in in some sort of basement, the stereotype in a hoodie. But they like to do it for the attention. They're pretty good at it. And even the Central Intelligence Agency's former leader was hacked by one of those hacktivists. So it can happen to anybody. And then one of the other big aspects of the cybersecurity that most companies really need to pay attention to is really what is called the insider threat. There's really two types of insider threat. There's the one that a disgruntled employee that leaves and steals information or sabotages or does something for financial gain with another company. Then there's really called the insider problem, which is basically negligence, where a lot of insiders have access to data that should be sensitive. They leave something open, a port, etc., and it's compromised. So insider threats is a very difficult one to recognize because you have to deal with behavioral, and you have to also look into your employee behavior, which is not always easy to do, particularly when there's a dearth of really cybersecurity practitioners in industry and in government. So what is a landscape? This is from ANISA. The landscapes are pretty strong. It's crypto jacking, which is really a side issue, but a lot of the currencies now being put into play. You know, they're not necessarily regulated or protected by governments, so they're a target of crypto jacking. Threats against data, business email compromise is still the biggest problem for businesses. Malware, as I mentioned, is everywhere. There's other aspects of disinformation, misinformation. Now that everyone's on social media, you can put anything on. Deep fakes are a reality too. There are also, ransomware, which I'll get into, and supply chain third-party attacks, which is really another big issue with business. A lot of businesses operate in vendor chains for good reason. You know, you don't do everything as a company. And these vendors that you're working with or partnered with may have vulnerabilities in their own networks that in turn compromise your network. So third-party supply chain is a really tough issue to protect against. Now that's a real focus of a lot of governments to try and shore up their networks, with zero trust. Look who's there, who's connected, who has accessibility, who's has privileges, etc. But it's a real issue. So one of the most scary issues that I'm sure a lot of you have seen is malware. And malware has been around for decades, but it's really been more recently where these 125 or so malware types are being used. The problem now is for businesses is it used to be very difficult to get paid because you have to go through banking and you can usually trace them. But now with cryptocurrency, and also with prepaid cards, which are often used to pay, malware is now being employed as a weapon of choice by a lot of the criminal hackers. And as I mentioned before, they've been very successful on the worldwide stage, particularly against healthcare institutions, but also against others and educational institutions. And this statistic came out actually just this week, that now that 75% of consumers are ready to shift to a competitor should a company suffer a ransomware attack. So that's interesting because now you're dealing with reputation, and your buying audience or the success of a company that you invest in depends upon the reputation of obviously to be able to do business and go out and sell their products or services. Now, if you have consumers saying that they don't want to do business with someone who's been involved with ransomware, that has a significant impact on the investment and the market. So this is a really interesting area to watch. And malware is again, there's a lot of ways to remedy it, but it's a real problem and it's a hassle. This is just an overview of some of the costliest types of cybercrime. This is a couple years old, but it really hasn't changed much. And as I mentioned earlier, business email compromise for good reasons is a large target. Sensitive data in businesses, and that's something that business will end up paying for. Actually, investment area is another targeted area. So if you're in the investment area, you know that you're dealing with private individual monies or even public monies or hedge funds, etc. They're a big target now of cyber attacks. And surprisingly, a lot of hedge funds and a lot of investment groups do not have adequate cybersecurity. So this is a real issue. The other factor, which I have to talk about, really is that now a lot of the companies that are subject for investment by investment groups, one of the elements that is looked at often, or more often than the past, is do they have cybersecurity expertise? Doesn't matter what industry they're in. Do they have someone on their board that understands the implications of what happens if they get hacked? Do they have an incident response plan, someone that could implement that? Do they look at who they're connected to, where they're going with the risks associated with emerging technology? So this is an area that really impacts everyone. So business really needs to look at it. And there's the other list of the other ones, of course, that have been at least from 2021 and 2020 have been targeted, but pretty much all those are of targets. Credit card fraud is one of the areas that it's mentioned, but I think a lot can be said with banking, and credit card institutions have done a lot now to monitor the behaviors of their consumers who are using their cards, and they've put a lot of security elements inside their operations and their transactions. So I think this is not that they're being more targeted; they're just better at handling them. So where does this all mean for venture capital? Well, as I said before, cybersecurity was once an afterthought for most private investors, but now with their portfolios, it's really a priority. According to Stacy Scott of EY Parthenon Technology and Cybersecurity, companies want to avoid business disruption, be prepared, to have the right access management, security, and controls in what they invest in. And M&A advisory firm Houlihan Lokey found that private security companies' functions were basically at risk between 9.4% and 26.9 billion between September 21 and 22. So you're looking at obviously being a threat target. So that's really important to understand. And then, of course, you need to know, if you're an investor, the security needs around software development, what the applications and data are. So startups have to continue to battle against a new fundraising reality as 2023 dawns. So security is now a strong element. And industry experts expect a continued softening of the fundraising market in cyber, despite 2022 being the second best year ever. In terms of raising venture capital, this is really not against cybersecurity as a percentage of investment. Still very high. It's just that the markets have gone softer because of economic uncertainty on global terms, inflation, et cetera. But despite all this, the cybersecurity market is expected to grow to $300 billion by next year. So cybersecurity is still a very important and viable area for any kind of investment and any kind of consideration in M&A. So this is an interesting chart of where the investments have gone in the last few years and going up to 2023. In security services is a huge part of it. Network security equipment, integrated risk management, infrastructure protection, identity access management, and data security, which are really all bundled under cybersecurity. So there is a strong growth, steady at 9% going into investment in cybersecurity. This is just an overview. I won't read them all, but there are a lot of cybersecurity venture capital firms out there, but these are some of the largest ones and the most recognizable ones. You probably see this slide and you recognize a lot of them. But one of the things interesting about cybersecurity is that you don't need a whole lot of investment, and you don't need a large firm necessarily to invest in a company that can be actually turned into a very strong and viable product or service company in cybersecurity. Actually, some of the best ones are small businesses that grow. So, the due diligence involved in a lot of these top security venture capital firms is pretty strong and also time consuming. So a lot of the smaller companies and inventive ones have looked at other ways to finance and also looked at angel investors and looked at smaller firms to be part of. So I think when you're looking at the market for cybersecurity venture capital, it's a very broad one. And there's a lot of opportunity for everyone, any investor, small, medium, and large. So also, when you're looking at one of the elements of cybersecurity, which is often overlooked, is really the threat to the businesses themselves. And this is not just to any business. This is also to businesses that operate in investment world too. That 43% of attacks have been on small and medium businesses. And most small and medium businesses don't have a dedicated employer or vendor monitoring for any of these cyber attacks. That's 57%. That's more than half. The scary statistic, again, is that 60% of the small and medium businesses will go out of business within 6 months of a cyber attack. So if you're looking, again, for a reason to have cybersecurity as a part of any group you invest in, any company, institution you're investing in, this is reason enough, because your money will be lost if you don't have the right cybersecurity protections. Again, I mentioned supply chains because they're particularly vulnerable, not just for small and medium business, but also for large business. So as a business or anyone looking into cybersecurity, industry needs to have some priorities and some tasks before them when they're looking at anything when they're doing due diligence. And first thing is, of course, is define and monitor the threat landscape, particularly if it's industry specific. If you're in a healthcare, you have different threats. If you're in retail, you have different threats, et cetera. So no two industries are the same. There are actually a lot of good risk management applications that can be used. For example, really the premier framework is called the NIST framework. NIST is a part of Department of Commerce at the United States government. And they have a framework that basically works on the premise of identify, protect, detect, respond, and recover. And they put out specific industry frameworks for industry, every industry, from critical infrastructure to just about anything you can think of. The good news is they're free. They're advisories. And there's a lot of other ones too. There's a MITRE threat. There's all kinds of different frameworks that could be used. But I highly recommend for any business to understand the risk management aspects of a company, not just in operating a business, but operating the security of the business. So protecting critical infrastructure through rapid prototyping of technologies and public-private cooperation has become a trend. The reason is because most of the critical infrastructure around the world is not necessarily owned by governments. It's owned by private sector. Particularly in the United States, 85% of the critical infrastructure is owned by the private sector. So private sector is facing these attacks from nation states and all this emerging technology. They need help of government. So there's a lot more cooperation now going. Obviously in the United States, Department of Homeland Security and CISA do a lot of work on this, but there's a lot of bilateral cooperation through European countries, including through NATO. So it's becoming a global issue, and you're seeing more and more public-private cooperation on a global level. And one of the aspects, of course, for everyone is modernizing security architectures. We haven't been in the computer age that long, think about it, but still a lot of the legacy systems are still around, the main drive computers, et cetera. So a lot of them are being modernized right now, and it's costly, but it's necessary because they were not built with cybersecurity protection in mind. Other aspects were being looked at for companies. Okay, encryption. A lot of our data is being stolen. How do we make sure it's not being exposed? And encryption is a good way to do that. There are different levels. There's military grade encryption. There's stuff you can buy off the internet, but they're really important. And of course, there's biometrics too that can be attached to encryption to make it more your facial recognition or thumbprint, et cetera. So not everyone could use that data. How you set it up, and then with Department of Defense in the United States, they're requiring quantum encryption to be a requirement for any kind of procurement now for intelligence community and Department of Defense companies doing business there. So we're looking ahead. Quantum is not that far away if we're finding quantum computing, but quantum encryption is just algorithms. So that is something you can work on right now. And then I mentioned automated network security, correcting systems, self-encrypting drives, protecting endpoints. A lot of stuff is happening is being automated because of machine learning and artificial intelligence, and also the fact that we just have too few cybersecurity people out there to be able to do the job, and too many false positives to analyze. So, and then with with Europe, of course, you have very strong privacy issues involved. So you have to know best practices, compliance, know what GDPR involves, and how not to get fined. So privacy is also an aspect of cybersecurity. So what can be really done? Well, there's more than this, but these are the predominant really risk management strategies that are being now used. A lot of them are actually pushed by again the civilian element of the Department of Homeland Security, CISA. But as I mentioned, security by design. You need to build agile systems with operational cyber fusion to be able to monitor and recognize and respond to all the emerging threats you have, with include intrusion prevention systems, detection systems, and et cetera. That's really important, but that again is when you have the opportunity to invest and build new things, like the CERN reactor, for example. It's built with the highest security involved. But a lot of the legacy systems are basically already being protected by what is called defense in depth. And that is really just the technologies, processes, and people, the air gapping, hardening, encryption, the flow of sensors, the segmentation of OT, operational technologies, and information technology. The problem with that is that there's a lot to orchestrate. There's a redundancy, it's costly, and there's still a lot of vulnerabilities. But defense in depth has been really what has been used for the last decade. And then more recently, there's been a push what is called zero trust. And really, zero trust is really complements everything. It's a security model that uses the identity verification of every person or device connected to a network. And most of us don't know what we have in our networks. If you're a business, you may not know what's attached, what IoT devices are out there. You may not know what people have still have access that may have left the company. So this really makes a lot of sense. So zero trust is really a way of looking at assuming that, there's probably something already wrong there. I maybe have someone that's already breached my system or operating and just waiting for the right time. And let me clear everything and identify everything and make sure that whoever has the right administrative privileges is the only one that has those privileges. So zero trust is a prudent way to go for any company, any industry, and any government. So this is just really a summary of quickly. I'll leave with this presentation with Hugo. So if you want it, you can request it from him, and you can have access to it. But this is a good slide to know what to do for your company, or if you're investing in a company, to make sure that they have is strong passwords. And it'd be surprising how many people still get breached because they use their pet names or their family name or 123. Multi-factor authentication, just another barrier to make it more difficult for a hacker to get to you. Separate your work devices from personal devices. Makes sense now, particularly that we're in a remote working environment. A lot of us are doing hybrid work. Update and patch regularly. That is something that really suffered under COVID because a lot of administrators couldn't patch regularly. A lot of the computers that were part of the network that were operating outside the offices. That's really important because vulnerabilities found every day. Secure Wi-Fi, again, I always recommend don't use a public Wi-Fi because you don't know who's lurking on it. Do not click on unknown emails or links. Still, of all this, phishing is still the easiest way to get into a company. It's not the same as it was a decade ago when you get these basically misspelled emails from some prince in a far-off land saying that you've made an inheritance and you just need to give them their bank account. They're basically, emanating your bank, maybe even the company you work for, or perhaps Amazon delivery, et cetera. But the graphics out there and the language now are really good. So you have to look at who the sender is. Monitor identity on public websites. One of the things that happens pretty regular now in social media is a lot of the state actors or even criminal hackers, they'll steal your profile, not necessarily by going and stealing your profile. That does happen too, but just taking your picture and then looking to find out who they can open and who you're connected to and start a new basically social media identity under your name. Back up your devices. Makes a lot of sense, right? Because you don't know what happens if you get hacked. And then another one is have incident response and resilience plans. If you're investing in a company and they don't have an incident response and resilience plan, I mean, what happens if you get hacked, but not just on the technical cybersecurity part, but who's the spokesman for the company? What is the impact does it have on the marketing and the brand reputation? What are legal aspects? What are lawyers supposed to do? Do you have something planned for ransomware, et cetera? And then, do not overshare on social media. I think that's hard to do because everyone does that. But you don't necessarily have to have everything about you and where you're traveling when you're not home for other criminals to find out. And then, of course, be vigilant. And these are more specific, but I think you should know them. Cybersecurity tools protections to use when you're looking at a company. And, first of all, do they have the right cybersecurity hygiene practices and their risk management? Do they have the multi-factor authentication? They have firewalls, intrusion protection. They have the right antivirus, anti-malware, anti-spam, and the encryptions. They have that. Web application controls, patching, data loss prevention if something does get leaked. Vulnerability scanning. They look and do see what their regularly see what penetration testing to see what they have and may not know about in their network. Security information management. Air gapping, separation. A lot of these you may not know about, but keep this list and look at it when you're investing. Red team, blue team. One of the things that's often done now is you take a team of two different ends and you look at one trying to hack in, one trying to defend it, and see where they're enabled and where they can't do, and what you have, how fortified your network is, your company is. And then incident response, I mentioned, really, really important because it's not whether you're going to hack, it's whether likely you're going to get hacked. So one of the things I'd be remiss if not talking about is, again, we're in a new digital era. We're moving out of the industrial eras from physical to digital. It's been happening, but now it's happening in Malthusian terms, the exponentially changing our environment. And, the next decade will lead us into an era of scientific breakthroughs that will change our way of life as we really know it. And we're on the cusp of accelerated technology advancement. And that is really being displayed every day. If you read MIT or look at some of the other emerging technology publications, you see amazing breakthroughs in health and physics and science that are really changing the pace of innovation. And again, things that we didn't expect to be happening are now happening. And futurist Dr. Mikao Kaku characterized this blazing technological shift as moving from the age of discovery to the age of mastery. And that is what we're moving into at a very fast pace. So what are these technologies? Just a quick overview. You should be looking at them. And again, every one of these technologies has a link to cyber. Automation and adaptive technology networks, artificial intelligence, very hot area, of course, for investing. And now that I think it's at 76% of companies that are doing cybersecurity have artificial intelligence helping them do cybersecurity. And then there's interesting areas of human-computer interface, neuromorphic computing, et cetera. Machine learning, which is really part of artificial intelligence, recognizing patterns, cryptography, encryption, blockchain, which is a distributed ledger, maintaining some security, simulation, virtualization, and gaming being used also for cybersecurity. Cloud and edge computing trend, should really mention it up front, but everything's moving now to the cloud or the edge, and your device that you have, your iPhone or your Android, now has more computing power that would send the astronauts to the moon in the 60s. So pretty impressive stuff. Photonics and sensors, big data, real-time analytics. And especially what I think is going to be really interesting in the next decade, we're moving into an era of quantum computing. And there's already stuff that's being done with photonics and quantum computing. But they thought this might be 2 decades away, but there's a huge competition going on between the West and China on this. And obviously it's very important because whoever has this capability of quantum computing will have the ability to decrypt all the information out there or protect without being ever able to be breached. So it's a real important area to look at. This is just another chart that I'm going to leave for you, but the top 50 emerging technologies, and the categories are interesting. Information and communication technologies, health and wellness, medical devices, advanced manufacturing automation, sensors, instrumentation, microelectronics, chemical and advanced materials, energy and utilities, and energy generally, particularly in the battery area. So all those areas, and I won't go into each of those technologies, but it's really exciting era. And then to bring it back home, with artificial intelligence, really is what I call the fusion of emerging technologies. And artificial intelligence is a fusion with every technology. But in terms of cybersecurity, the shift from artificial intelligence or the help that it will give, it will enable cybersecurity teams to focus on designing and actualizing strategies such as cyber hygiene and zero trust networks. The entity, it'll help them mitigate false positives. It will augment their security operations teams. It'll help them also remediate after they've been hacked. They can be able to identify what it was and stop the repeatable activities, where the vulnerabilities are, the gaps are. So it's really an enabler. However, the problem with every technology has dual implications. And with cyber threats, bad guys are already using technology, artificial intelligence and machine learning particularly. They use it to automate their attacks. Now they're sending thousands, and if not hundreds of thousands of phishing attacks simultaneously, automating them. They use it to evade detection. They can have malware actually morph now with artificial intelligence, and also have the impact be much worse. They're leveraging it for spreading the digital threats, and they're using it to disrupt anti-malware and facial recognition systems too. So again, the problem again with most of us out there is we don't have the understanding and expertise of artificial intelligence yet. And while some of the bigger companies are investing in it, medium and small business will need it too to stay protected. So artificial intelligence certainly is an area to look at. So one final slide that before I leave you, because this is something that you all need to know. As I said, we're in a new technology economy or a new era, and you have to have understanding of what this tech is, and learning it's really key. Hopefully some of this gave you some ideas of where to look, some of the areas of technologies in quantum, artificial intelligence, materials science, and cybersecurity that are being shaping basically our destiny. And of course, you have to have now is also, if you're looking at board people or looking at people running companies, do they have the right leadership skills for this era? Are they innovative? Do they have adaptive and critical thinking? Are they creative problem solvers? Can they negotiate? They have design thinking. So this is a new trend. This is technology-enabled leadership. And now you're also seeing a lot of virtual collaboration platforms and social intelligence platforms. That is another big trend. And now with people to understand things, they have to have more disciplined project management skills, and to work across a lot of different verticals makes everything potentially part of your network. So you have to look at that and also look what your product or services are touching. If you need literacy, this goes back to learning, but there's a lot of opportunities to learn things, even on social media. There's a lot of courses that are free. So you need to have stronger communication skills to be able to communicate what these new technologies and the tech economy means. And you have to have some sort of understanding of computational thinking analytics, because one of the things that has been changed so much is the ability for predictive analytics and to be able to decipher things at a rapid speed with supercomputing, and even the computers we have now. So you need to have that kind of understanding. And of course, network and information security knowledge, which I've just talked about, really important because, again, can't reemphasize this too much, is that, cybersecurity is such an elemental part now. It's no longer a cost item for companies. It's really whether they're going to stay in business and profit and whether they're going to be viable in the new tech economy. So cybersecurity really is the glue that holds everything together. And finally, I think, just like everything else, and particularly those in the investment community already know this, you look for passion, people who believe in what they're doing and want to do it and enjoy doing it. And that is where you find a lot of particularly inventors. Sorry about that. It was just a thunder storm or a fireworks for 4th of July that someone let off. It's more like a bomb. But anyway, thank you for having me here again. It's really a pleasure. I look forward. My dog is barking here, but I think every dog barks when they hear a loud noise. But he's a great dog. So anyway, thank you again. Pleasure being on. Thank you, Hugo. Terrific to be here, and I want to thank everyone for having me.
Thanks, Chuck. Thank you very much for that and for those insights. I think you laid out that the cyber crime is really big at the minute. And if you don't mind, I have maybe one or two questions I'd like
to be happy to.
Yeah. I think in terms of the current cybersecurity threats, I know you mentioned them, but how do you think they'll evolve, and how do you think companies should respond as well, and how do you think companies will evolve based on the recent development of AI, maybe blockchain technologies? I know you touched upon it, but where do you see that going? Do you see the number of threats increasing and like the seriousness of it increasing, and do you see companies matching it?
Yeah, certainly the seriousness is growing. The artificial intelligence, machine learning capabilities give them a capability that hackers have not had in the past, and they're using it with great accuracy. One of the biggest threats that's very difficult now to detect and is very worrisome for people out there is what's called a polymorphic threat. You have ransomware or malware basically changes its form, so it can't be detected and stopped very easily. So I think companies need to look at, of course, most of them don't have the expertise. They need to obviously hire board people, but they also may want to consider managed security services, which are being more and more readily available out there. And those are something that everyone could access, or they may want to consider using a strong cloud provider for their data that already has built-in security. Of course, there's risks there to a cloud. You don't have necessarily giving up a lot of your data for someone else to protect, but those are at least avenues they can explore. And again, it's a scary environment. It's getting worse. And you mentioned blockchain is a component now. A lot of the cyber remedies people are putting in, mixing blockchain into to protect some of their key ledgers. So I think all of the above really is true. We're really looking at a really interesting but very precarious threat landscape.
Thank you. And I guess maybe the last question, right? For small companies, small startups who are maybe they don't have that much cash, right? And they're maybe not that technical. They don't have a technical founder who can focus on this. What would your biggest single advice be when it comes to cybersecurity?
Sure. Everyone could do something at low cost, which is called cyber hygiene. And I urge us, small medium businesses to do this. And the cyber hygiene encompasses a few things. One, obviously, is strong passwords. Passwords that are easily corrupted are a quick way in. And again, I mentioned the multi-factor authentication. So you may want to have a facial recognition, a thumbprint that's readily available on a lot of desktops now and laptops. Or you may want to have a call in, make sure this is you. You can do that. That doesn't cost much. You can also separate your sensitive data in a different computer. So if you do get hacked, you're not going to be put out of business. You can get back up on there. And then there are a lot of business encryption softwares out there that do a decent job. And the reality is that hackers will go for the lowest hanging fruit. They don't want it. They're just looking for easy strikes for the most part, unless you're a critical infrastructure where the state-sponsored group is going after for political reasons or strategic reasons. Most companies are looked at. Can they pay us money? Ransomware, will they give us money? So I think just basic cyber hygiene again, and maybe even have firewalls, which are not expensive either. There are a lot of companies you can look at that. If you go back to that one slide, you can look and see what the costs are. But and again, managed security service, if they don't have much of a budget, there are probably some groups in their area that offer reasonable services to protect and go and look at what you may have in your network, because even if you're starting up, you want to know if you've already been compromised, and some of the databases may be compromised. So by just doing a penetration test, from a local may help that out.
All right. Well, I think that's all we have time for today, Chuck. And I really appreciate you taking the time today to provide those insights. And to everyone watching, this brings us to the end of Venture and Capital Global. So yeah, thank you, Chuck. Thank you for
that. Thank you for having me.
Thank you very much. And then, as Chuck mentioned, I think he'll send me his presentation. If anyone wants it, you can reach me via email and I can send that presentation over.
Great.
Thanks, Chuck.
Thank you.
Good morning, afternoon, evening, from wherever you have tuned in from. As the curtain falls on this exhilarating chapter of V&C Global, it fills me with immense gratitude to see the resonating energy that each of you has brought to this event. These past 2 days, we've embarked together on a journey through the shifting landscapes of SaaS, fintech, AI, climate tech, and so much more. We've learned from the brilliant minds driving these sectors, shared our own visions, and discovered new possibilities in the pursuit of innovation and an inclusive future. We are at a pivotal moment in time where our challenges are the catalysts for new and groundbreaking solutions. It's this sentiment I'm reminded of when I think of the words of Biz Stone, the co-founder of Twitter, who said, "Timing, perseverance, and 10 years of trying will eventually make you look like an overnight success." This quote encapsulates the spirit of our gathering, a spirit of perseverance, relentless innovation, and steadfast optimism. As we wrap up today, I want you to carry not just the wisdom and insights from our speakers, but also the inspiring energy, the passion, and the meaningful connections we forged here. I urge you to continue these conversations and collaborations on our in-house networking platform that will remain open for the next 2 months. Although we're closing the door on this event, the dialogues ignited, the partnerships formed, and the innovative spirit sparked here will continue to shape our shared future. It is now up to us to embody that perseverance Biz Stone spoke of and make our own overnight success. On behalf of Wholesale Investor and our dynamic team, thank you for being a part of V&C Global. Your participation and insights have transformed this event into a remarkable nexus of ideas and opportunities. We eagerly await our next rendezvous to further explore and drive this world of endless possibilities together. In closing, remember to stay audacious, remain inspired, and continue to challenge the status quo. It has been a privilege, and here's to our collective future. Thank you, and good night.